That you are now hearing from various media outlets that both Santander and Barclays are looking to put in bids for TSB. That's the UK subsidiary of Banco Sabadell as well. So we're going to keep a lot of our eyes on what's going on in the banking sector. Sainsbury's as well. So sales rising highly. We'll see how that is interpreted at the open. And of course, JDE Pete's also in focus, Guy.
Okay, here we go. Time for Tuesday's session. Let's figure out what is happening. And the answer is probably absolutely nothing, but at least we're going to work our way through the process. It is a step closer to some of the catalysts that we are going to be seeing coming down the pike towards us a little bit later on. As anticipated, nothing from the FTSE. We're up by a staggering 0.1%, actually slightly more than anticipated. The Spanish market doing something similar. I'm trying to sound excited because actually there's not much exciting on the screen right now. But I suspect actually later on today, as we work our way into tomorrow's session as well, there are going to be things that could get this market going. It could be on the fiscal front, or it could be what is happening with trade. There are things that are going to be worth paying attention to. Plus, of course, Francine's panel coming up with the central bankers a little bit later on too. So there are things happening later. They're just not happening right now. So the FTSE is now up by 0.2%. I would argue maybe this is a slightly more positive open than maybe we were anticipating, but it's not that positive. Cruddy, sectors.
When we're looking at some of the movers to this side, I'm seeing a little bit of a defensive tilt in these markets. So it is quiet perhaps, but if you are looking for where the bid actually is, broadly positive, but the outperformers this morning are going to be technology, are going to be healthcare. To me, that screams defensive right off the bat. But take a look at what's lagging. No surprise there. It's the banking sector. Banking consolidation seems very much on the table. Media sector is also dropping as well. You're continuing to see drops across the board. But to me, Guy, from the individual movers standpoint, SAP, Novartis, Novo Nordisk, Roche, your four biggest contributors this morning. It feels like there's some something happening in the healthcare sector, even if it is tiny, tiny moves.
Yeah, precisely. A little bit of a rotation. I think this is all about what is going to be happening in terms of the catalyst later. I think the market is going to wait and see exactly what that is going to look like. Remember, you've got the VIX on the floor right now. You've got markets largely becalmed. Last quarter was turbulent, to say the least. A little pause for breath, maybe as we move on into the next quarter. What are we going to be seeing? I don't know where the catalysts come from. Is it the central banking story? Maybe we're going to see that in Fran's panel a little bit later on. Is it on the trade front? We're counting down to the 8th, 9th in terms of the deadlines there. Does seem as if we still have a significant lack of clarity on that front. Are we going to see the big, beautiful bill getting passed later today, or are we not? And if we don't, what are the implications of that? How does this fight between Elon Musk and Trump develop? And what is happening here in the UK? That's worth paying attention to as well. I think if the bill passes here in the UK later, it's a bit of a non-event. But if it doesn't, then that's quite a big left-hand tail risk, maybe for both the gilt market, the pound, and by extension, maybe some UK stocks as well.
Well, I think it's fascinating. You're drawing the connection between the United States and the UK, both talking about what's happening domestically to try to tackle some of the volatility internationally. Both the UK and the US, Keir Starmer and Donald Trump, trying to balance the books of both countries with, again, infighting from within their own party, as opposed to whether you're looking externally facing. I think that's a really key piece on both sides. But to your point, what does that do to valuations? What does that do to the stock market? We talk a lot about whether U.S. exceptionalism is over. Well, a lot of that surrounds the valuation story. BlackRock's Helen Jewell challenged those conventional assumptions. Take a listen to what she had to say.
25 times the US feels really high. But what's to say that actually people aren't prepared to pay 26, 27 times if they continue to see that growth in that market? Maybe what we have to start thinking about is what is the right multiple that people are prepared to pay for that market? I can see a situation where I can see, assuming we don't have a recession, I can see a situation where I'm sitting here a year from now saying 25 times is a new normal for that US market.
Joining us now, Marina Zavalok, Chief European Equity Strategist over at Morgan Stanley, joining us around the table. Marina, Helen thinks that there could be a situation where in about a year's time, 25 is a new normal in terms of stock valuations for the U.S. market. What is the current normal for European markets right now?
I mean, the European equities market is on about 14 times PE, so well below the U.S. We do think that Europe can go up from there. So we think we can get up to 15 times multiple. We think that the discount versus the U.S. over time can narrow as well, but 25 is very far away for Europe.
But even 15 is historically
it's above average
for Europe. Talk to us about how the valuation standpoint kind of comes into that. And specifically, I mean, my focus has been around the defense sector. We talked about it today with Guy was talking about kind of Keir Starmer and this vote that's coming in. If you have to kind of return some of the funds that have been allocated to defense into welfare costs or vice versa, does that undermine the case for defense that's been driving this market higher?
Yeah, I think for the defense sector, I mean, we're still overweight. It's a long-term story for us. But I think the market at this point, investors are waiting for these long-term earnings upgrades to come through. I don't think there was a lot of optimism around the UK to begin with, but it's really more about Germany, about the Nordics, about Scandinavia, and the rises there. And then within Europe, you have some companies exposed to the German defense spending, which is just huge. It's going to impact broader than just Germany. But what I hear from our analysts is to get the earnings upgrades, especially the longer term earnings upgrades, you need the details around the project awards. And we probably won't get those details until the fall, maybe later this year. So in my opinion, dips in the defense sector will be bought because long only still don't own the sector or have very underweight positioning. But is it going to break out and have the kind of momentum that it had earlier this year? Not for now.
Is Europe cheap, though, at the moment? We're on 14 now. We could get to 15. 15 would be above average. So Europe...
It's already above average, actually.
Yeah. So we're not cheap at the moment. Is it... What is the attraction of money coming out of the States towards Europe? What is the case right now to be made for moving money out of the States or not allocating as much to the US?
Well, one of the big aspects is just diversification. So I think investors have kind of woken up to the major policy changes, the uncertainties in the US, and thought to themselves, well, if we're allocating to global funds, some of these asset allocators, that's actually 72% U.S. So is it really diversified? Is it really global? So you see more appetite to invest in international, which is global ex-U.S. And then you have in Europe, you have what I call the foundations of a bull case being built. So it's not going to impact earnings this year. Yeah. But in the longer term, you have savings and investment union. You have AI adoption, which is taking off. You have fiscal changes, defense spending, fiscal changes, especially, as I mentioned, in Germany. That will start to have an impact into 2027, 2028. And then lastly, and we could talk about it more, but the euro, I think the euro's strength and the implications it has for constant currency growth comparison to the U.S. is really underappreciated.
Okay, just walk me through that argument a little bit more, because in some ways you could argue that the euro is a tailwind for Europe and for investors, particularly outside the euro area, putting money to work there. But also it's a headwind for European equities as well. A lot of European companies earn money in the United States. That's obviously going to be impacted by this. So I'm wondering what the offset of both of those two factors are.
Yeah, so we just did a really in-depth analysis on FX, and it's amazing to me how differently everybody looks at FX in Europe, because I come from an EM background where you just looked at things in dollar terms. Yep. But basically, in general, people look at European earnings growth in local currency. And because Europe is so geographically diversified, only about 40% of revenues actually come from within Europe and the UK in MSCI Europe. We get, as you mentioned, these translational impacts. And so local currency earnings growth, as euro strengthens, just keep coming down. Now it's about 1%. We think it could hit below 0. So optically, it feeds this narrative of Europe has no growth. But in reality, a lot of investors do not hedge FX. And if you're, let's say, a global fund sitting in the U.S., your fund is in dollars, you should really be looking at European earnings growth in dollar terms. In dollar terms, European earnings growth is now 7.6%. not 1. It's 7.6% in dollar terms. The S&P XMAG 7 is 6%. So we're above S&P XMAG 7 in dollar terms in our growth, and yet we trade at about a 30% discount. So I think investors are starting to realize that if this strength in the euro is more structural, then actually there are attractions in constant currency to investing in Europe.
How prepared are European corporates for a swing in the other direction? Being short dollar is a very popular trade right now. Being long dollar was a very popular trade, but in the short term, it's a trade that a lot of folks are saying has gone too far when you're looking at a euro dollar of 117 or potentially higher. How prepared are European corporates for a swing in the other direction?
I mean, we've just done this analysis of how corporates hedge, and in general, corporates, they don't really take a directional view. What they do is they hedge primarily their transactional FX mismatches. Transactional, so things like cost revenue mismatches, balance sheet mismatches, things that could really cause a risk to the business. They do not take active calls on translational impacts, which is primarily what you have when you look at what I was talking about, local currency implications. Most European corporates actually try to match their local-to-local exposure. So what we found is that most of the exposure that Europe has is just translational, and there's not really a way you can be prepared for that. But if things move in the other direction, you'll see local currency earnings go up.
Are European investors, or global investors, invested in Europe ready for tariffs? How big a swing factor could this be? And is it possible at this point to make a judgment, do you think?
On whether they go up.
How do I hedge that risk? Should I be hedging that risk? Should I be thinking about that risk? Do I make the decision to invest in Europe after maybe the decision has been made in terms of what the tariff narrative looks like?
Yeah. We've been talking about this for a while, that basically the European tariff risk is far more idiosyncratic than broad-based. So if you look at Europe's overall exposure to the U.S., it's about a quarter of revenues. So I think initially back in December, there was this perception that entire 25% is going to be dramatically impacted by tariffs. When you break that down, most of it is either services or local to local. So European companies producing goods in the U.S., having manufacturing there, selling into the U.S. The portion that is goods exported to the U.S. from outside is less than 6% of European revenues. Those stocks have already traded down dramatically, and they're just kind of hovering at lows, those highly tariff-exposed stocks. So if we go up on July 9th, if tariffs go up, that pocket of stocks will go down again. But I would say investors are already, pretty underweight those stocks.
If the tariffs are more benign, are better than anticipated, is that the area that I want to go fishing in terms of where the benefit could be?
Well, it seems like 10% is pretty likely to be the baseline. I guess in certain sectoral tariffs, maybe you could get a deal. I'm not that optimistic. But yeah, you could. I mean, there have been some investors that have taken the view that the worst is already in the price for those stocks. Those stocks tend to also have a lot of China exposure.
We're talking about luxury basically here, aren't we?
Luxury is one of the big part. Autos, so we don't like that group of stocks.
Is 10% priced in, though? Like, is it priced in, the stock 600, 100%? What's not priced in, 25?
20% is not priced in. I mean, we have a scenario where, let's say on July 9th, we go back to 20%. Theoretically, that could cause more than 10% downside to the European equities index. But I think given that the market has gotten used to things coming into play and then being taken off, probably investors would not price that 10% downside fully. It would be more like a 3 to 5% downside risk.
I'm going to find out in a few days, maybe. We'll see. Marina, great to see you. Thanks very much indeed for stopping by to come and see us. Marina Zavalok, Chief European Equity Strategist, joining us from Morgan Stanley. Let's take a look at the Core 6, figure out what is happening this morning in terms of the centre of gravity here in Europe. This is the picture, as you can see, a very becalmed market. We're looking for catalysts. We're trying to figure out which one of the significant catalysts which are out there right now is going to come towards us next and impact this equity market. But at the moment, you've got some of the pharma stocks on offer. You've got some of the chip stocks on offer as well. LVMH is actually catching a bit of a bid, but net, not a lot of movement this morning. Where else are we watching for some movement? Let's find out with Joe.
So we have got a little move higher in Sainsbury's this morning, Guy, after the quarterly report from the UK supermarket. Now, the numbers actually look pretty much in line with expectations, but potentially not as much of an impact from the discounting that we've seen in that sector recently. So a bit of a relief on that. And the volume's pretty much holding up over at the UK company as well. So that one gaining around 2% in the early trading for Sainsbury's. Then we've got Sodexo. That one was bouncing around in the open of trading in Paris. This is a catering company, of course, but a lot of exposure to the US. Now, it does look like a bit of weakness in the airports business and also offices as well. However, that has already come down a lot recently, that stocks. It's actually recovering a bit, as I say, a little bit volatile in the open of trading for Sodexo, one that's had a bit of a rough run. We're coming back into green territory for now on that one. Then batteries, electric vehicle batteries is the focus over in Belgium today. We've got Umicore, a company that makes a lot of the materials that are used in the complicated process for making electric vehicle batteries. And they've upgraded their guidance after the close of trading yesterday. So getting a decent boost on that stock. One of the best performers we've got on the whole European market today for Umicore. It's only around a 4 billion market cap company, but looking pretty strong in those opening trades. Then we've got another car related, a good segue, staying in the car space. We've got Renault, this one a little bit lower, however, because they've given a bit of a complex update on their investment in Nissan, saying they might actually do a bit of a loss in terms of an accounting loss, potentially more than 11 billion euros on that was the headline I saw. So Renault actually hit a little bit weak on that one, coming down around 2%. Of course, there is a bit of a CEO change going on over there as well, so a lot of uncertainty on that one today. Then in terms of the share placing, we've got a bonanza. All the share placings keep coming. I think people trying to tap into the rebound in stocks that we've seen in the recent months. So we've got share placings all over the place today. We've got Wise in the UK, probably the most interesting one, because this one is being sold down by Peter Thiel, the US billionaire tied to PayPal and Elon Musk. He owns a stake in that. He was an investor in that in the early days, and he's selling a bit of a share in that one. It's coming back to unchanged now at the moment. But also Mediobanca, Impost, Vusion Group, all of them getting decent share sales. Mediobanca actually one of the biggest decliners by points in terms of the index because of those share sales this morning. So that is a big focus for the market. Then finally, to finish on the best performer on the Stock 600, when I stepped away at least, it was Zealand Pharma over in Copenhagen. Now we have got an upgrade. This is over at Exane. So Zealand makes obesity drugs, but it's not GLP-1s, it's amylin. And I had to really Google and try and actually learn the difference between amylin and GLP-1s before I came on. But this is a suppressant for appetite, essentially, in terms of the reason why that stops people eating too much, and that is gaining because Exane upgraded the stock. I've completely overcomplicated that one. Exane has upgraded Zealand Pharma today because of their exposure to the obesity market, and the stock is gaining at 5% this morning.
All right, Joe Easton from our equities team, we thank you so much. Lots to digest there. Of course, we're going to keep an eye on these markets. Coming up on the program, Bloomberg learns that Apple is considering outsourcing AI for Siri. We're going to bring you our scoop on the topic next. Stick with us. This is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
Good morning. good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
Welcome back. 20 minutes into the session, and thus far we have very little movement in terms of the indices. As you can see across Europe, we are largely becalmed. Nothing to see here. What comes next, though, could certainly shake things up quite a lot. You've got what's happening stateside, you've got what's happening here in the UK, you've got the tariff story that we need to be factoring into our thinking as well. There's plenty going on. The currency market probably has been more exciting recently, and continue to monitor what is happening with euro dollar this morning. But the Euro Stoxx 50 is absolutely unchanged right now. Nothing going on. So let's turn to some of the other stories that we're watching so carefully here at Bloomberg. A scoop coming from Bloomberg. We have learned that Apple is considering using artificial intelligence technology from Anthropic or OpenAI to power a new version of Siri. It's a move which could sideline Apple's own in-house models. This as the company looks to turn around its flailing AI efforts. Peter Ostrom, Bloomberg's executive editor of global technology, joining us around the table this morning. Great story.
Yeah, this is a Bloomberg scoop, and it's very big news. I mean, Apple, of course, is known for its cutting-edge technology. It's done that in smartphones, it's done in music, it's done in computers, too. And now what we're seeing is that with AI, it's fallen behind. And this is really a concession. Big picture, this is a concession that the company is struggling in AI. They're talking with Anthropic, as you said, and OpenAI. They've asked them to come in and see how Siri would run on top of their platforms, the LLMs. And they're running tests. They found out that Anthropic, in fact, has worked out quite well. So this would be a pretty big strategic shift at this point. Yeah. It's very early. I mean, the status here, it's important to emphasize, this is early. They're looking at changes that they want to make next year as they introduce products. They are also still continuing to work on their own AI efforts, and they'd like to be able to use that. They'd like to be able to see how that team can evolve their own internal AI, too.
Is this temporary? Because Microsoft did this. Microsoft, before they invest in their own AI offering, said, you know, we're going to take that stake in OpenAI. We're going to invest in, or at least take advantage of investment or stakes in other companies while we develop our own in-house product. And then ultimately, you were starting to see that shift away from it. Is this Apple's strategy? Take on what Anthropic or whoever has to offer while you also build your own strategy?
Well, Apple hasn't talked about this at all strategically, but you make an important point. They do want to test the best of breed right now internally to see what they can run on their iPhones. They want to see how well it's going to run internally. But I think they are acknowledging now, by letting these companies come in and work with Siri and see what kind of experiments they can run, they're realizing that Anthropic and OpenAI, at least for now, are ahead of them. When they introduced Apple Intelligence, as they called it, they had hoped to be able to do this internally. This is a concession that now they need some outside help to test whether this is going to be
Where's the
effective.
value in Apple now? If they're relying on others for their AI, which is where everybody sees the value going forward, Why is Apple this
Aren't you an Android user?
$1 trillion company? Yeah, we'll punk that one for a minute. But where's the value in Apple?
Interest. Well, of course, Apple still has an amazing smartphone business. They also have a very strong ecosystem with the App Store, where they take a cut of all the apps that you're putting onto your phone, everything that you're buying on those apps too. That, of course, is under assault too. There are some people that think they have too much control there. But now they need to move ahead in AI in particular. If you believe that AI is this super important technology that you're going to need to have incorporated in your devices, Apple recognizes that it needs to take a couple of steps forward here.
All right, Bloomberg's Peter Elstrom walking us through those Apple dynamics. We thank you so much. Let's talk about another major heavyweight, of course, in the S&P 500. I think we can call it a tech company. Tesla shares are falling on TradeGate after President Donald Trump lashed out at Elon Musk, accusing the Tesla CEO of benefiting excessively from government electric vehicle subsidies. Now, this comes after Elon Musk slammed the U.S. Senate's latest version of Trump's multi-trillion-dollar tax bill, warning that the cuts to EV and other clean energy credits would be, quote, incredibly destructive to the country. Let's bring in Bloomberg's Global Autos editor, Craig Trudell. What is Elon Musk thinking here? How does Tesla move forward without those subsidies?
So I do think that there's an attempt being made here on the part of Trump to kind of turn this into, he's only criticizing this bill and this budget on the basis of the removal of EV subsidies and how he puts it, the EV mandate. I think Trump, I think to be fair to Musk, his criticism is more than just that, right? He's concerned about, okay, if you're going to do away with these subsidies, with the support, also do away with other subsidies, oil, gas. I think he wants more of a level playing field, and I think he's also very concerned, maybe without saying it so explicitly, that he invested all of this capital, this sort of political capital, on this Doge project. Has spent all this effort and time and sort of sacrificed his reputation only for the Republicans to come in and introduce this bill that adds to the deficit so significantly. So I do think there's a real concern here. We talk a lot about tax credits for consumers. I think the other sort of underappreciated aspect here is also the doing away with California's mandates for electric vehicles. The doing away of fuel economy and emissions standards. All of these things will combine to hurt Tesla pretty significantly, and have been real sort of tailwinds for them in the past few years.
Just in a few seconds, what's your latest take on the tariff story? It looks like the EU is prepared to accept a 10% baseline tariff as long as it gets carve-outs for cars. Is that going to happen? Is that something that we should expect to happen? Because the EU doesn't sound quite so convinced on this.
Yeah, I think there's a real concern that Trump is going to budge on this, because when you talk with him about trade and about tariffs, this is the sector that he goes to immediately, right? And so I do think that the European car industry is going to have a really hard time, to the extent that there are some sector carve-outs, that they get in on that action.
It's interesting, the Japanese are looking for the same thing. You do wonder whether Trump is going to budge on this. Craig, thank you very much indeed. Craig Trudell, Bloomberg's Global Autos editor, joining us on, well, many aspects of this sector right now in play. Coming up, we'll discuss the risks to the global economy. So many risks right now. The market is watching all of them very, very carefully. Freya Beamish, chief economist at TS Lombard, is going to be joining us next. We will discuss what is happening stateside, what is happening here in Europe, what the trade story looks like, what the fiscal story looks like. All of that coming up with Freya. That's next. This is Bloomberg.
Welcome back to the circuit. This time, we're taking you to the frontier.
Do we have a camera, or do we don't want to lose you, Emily, in all of this. Stargate, put that name down in your books.
What we're undergoing right now is sort of the largest infrastructure bill in human history.
To meet the people rewriting the rules of code and culture.
How do you personally grapple with the pace of it all?
It does feel like it's going very fast.
When did you realize, oh my gosh, my life is never going to be the same?
The day I got engaged, I was like, whoa, what have I bitten off here?
Where the future gets real.
How confident are you that AI's promise will outweigh the perils?
I'm not confident.
So the tech companies are lying or fudging.
And a little weird.
What's the point of this?
What is the point of any of this?
Tune into Season 3 of The Circuit with me, Emily Chang, Thursdays at 6 p.m. Eastern on Bloomberg Originals and Bloomberg TV.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
This is the opening trade. Welcome back. About 30 minutes into today's session. Not seeing a ton of movement on these indexes. Guys, we really talk about this idea of what the next catalyst is. Is it trade? Is it the budget vote when it comes to here in the UK? Or is it ultimately monetary policy, Sintra? Lots going on there.
They're all the same catalysts, but they're kind of morphing a little bit.
Whose voice matters the
and
most.
we're going to, you're wondering where they're going to crystallize. So let's talk about what's happening stateside. We'll talk more about the UK maybe in just a moment. Senate Republican leaders are struggling to gather enough votes to pass Donald Trump's $3.3 trillion tax and spending bill. Speaking to Bloomberg, US Treasury Secretary Scott Bessent, who has been heavily involved, of course, in the negotiations, said he is optimistic that the Senate will pass the bill in relatively short order.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like.
Okay, how does the market react to this? Because there's some big numbers involved here, particularly when it comes to the deficit. And that's where Valerie Teitel steps in.
Yeah, $3.3 trillion. That was the latest CBO estimate of how much the Senate bill can add to the deficit. Now, Guy, this is substantially more than the House version of the bill, which was around $2.8 trillion. The question on my mind is when that House bill price tag came a few months ago, there was a big puke in the long end of the Treasury market. 30-year yields were breaching 515. Why isn't there the same reaction this time around to a bigger price tag from the Senate bill? We are, substantially lower in the 30-year yield, not at 515, but at 475. To me, this is the market saying that the U.S. government is dealing with the debt problem, not by cutting spending, but by pressuring the bank to cut interest rates, pressuring Powell to cut interest rates. And the Treasury market is seeming to read that as one and the same. It's also pressuring the dollar lower. We hit a fresh year-to-date low for the U.S. dollar yet again overnight. And now year-to-date, in the last 6 months of the year, the Bloomberg Dollar Spot Index is down some 11%. Its worst start to the year in over 50 years, Guy.
Valerie, thank you very much indeed. Joining us around the table to carry on the conversation, Freya Beamish, Chief Economist at TS Lombard. How are you viewing what is happening in the States right now?
Even the House bill was already sort of problematic on a kind of a 12 to 18 month time horizon. We think probably that yields will get up to that 4% mark over the course of next year. But the Senate bill, as was just said, sort of expands on some of that, on some of the more kind of, the expansionary side of it is just a little bit more in your face with the Senate bill. What I don't like about any of this is that the liability that the government is trying to issue here, they're trying to issue more of it, and in the composition of these bills is a deterioration of the quality of that asset, particularly as a hedge for equities, because a lot of the spending is being done on deterioration of the supply side through deportations, which is a real significant shift from that sort of improvement in supply side conditions that we've seen over the past kind of since over the course of the global financial crisis and over the course of hyperglobalization. These were all kind of slow burn demographic dividends being added to the U.S. Economy, and now we're seeing the reversal of that with lower immigration and greater deportation, and that's really a very important shift that we're seeing here. So we've got two shifts happening. One is that there's a pro-cyclical element to this, and the second is that there's an element to this which is deteriorating the labor supply of the U.S. economy, and those two things can fundamentally shift the correlations within the macroeconomy and to the market.
Stagflation?
It's stagflationary at the margin, so I have to be careful not to be too doom and gloom. I do think I do think that real yields will be better than in the 2010s. I do think that real growth will be better in the 2010s. I do think that inflation will be higher than in the 2010s, so perhaps not so great for the bond space, but some of that improvement, that increase in inflation will be a demand-led story, so there'll be some positive story coming out of that for equities, talking big picture here. But in terms of the House reconciliation bill and then how it's coming through the Senate, the shifts here, you're not really getting that much in terms of positive impulse from growth. We're talking about big tax cuts for people that already have a lot of income there, so low marginal propensity to consume, so not a great multiplier on the tax cut side. And then on the spending cut side, there is a strong multiplier there, so that's a bigger drag. And then how are we offsetting this expansion of the deficit in the first year? Well, there's a tariff revenue there, which is a negative supply shock again. I'm very kind of hyper-fixated on negative supply shocks because they deteriorate the hedging quality of bonds for equities. So the spending that is coming through is about reducing the supply side capacity of the economy. Bad for bonds and bad for equities at the same time. Term premium should be higher. And the revenues that are supposed to be offsetting this expansion of the deficit are also negative supply shocks, which is tariffs.
So you talk about the marginal, one economics lesson right there.
Wow.
We need like a flow chart, but you talk about the marginal propensity to spend from some of these moves. Let's talk about the marginal propensity to save here, because I think what we're waiting for is for some of the data to actually show a hit, and it hasn't yet. Is that because Americans are saving more? That's unusual.
Yeah. No, I think you've hit the nail on the head as to why this is not actually coming through at this moment in time. The difference between the House reconciliation bill reaction to that and what's being done in the Senate at the moment is the data just do look a bit softer. The hard data coming through on the consumer just do that. Those data do look a bit softer, and so there's a little bit of this is all happening under the guise of will the Fed be able to cut rates? Is the economy deteriorating? Is there a greater sort of propensity towards saving as a result of the greater uncertainty that's being exacted upon the U.S. economy? So they're almost kind of creating savers for the expansion of the deficit and mopping that up on either side of the flow of funds there.
Yeah.
But the bigger picture is we haven't seen the inflation data, the tariffs coming through in the inflation data yet, and that's likely to come through in the second half of the year. So yeah.
Well, speaking of Freya, it keeps coming back to the tariff story. Torsten Slok, this was on a couple weeks ago, June 21st, put out this piece on his blog. And if you'll indulge me, I just want to read out a piece of this to you. He says, maybe the strategy is to maintain 30% tariffs on China, 10% tariffs on all the other countries, and then give all countries 12 months to lower non-tariff barriers. This would seem like a victory for the world, and yet would produce $400 billion of annual revenue for taxpayers. Maybe the administration has outsmarted us all. Does that math work, Freya? If we talk about 10% tariffs on the rest of the world, which is looking likely, by the way, when it comes to the European perspective, is $400 billion of annual revenue enough?
It may be in the first year, so that those numbers add up to probably about 0.6% of GDP. In the House reconciliation bill, you've got tax cuts that are about 0.8% of GDP, and then spending cuts take about 0.2 off of that, and it's no coincidence that those both add up to an expansion of 0.8 and a contraction of 0.8, and so it actually probably evens out in the first year. That coincidence is there because those numbers need to add up to square the politics in the Congress between those that are up for re-election in the midterms and those that are more fiscally conservative. But it's a bit of a charade because the tariff revenues are just not going to stick. If those numbers are in the system, then imports probably will start to decline, and so your tariff revenues are gonna decline as well. It's not like smoking.
Freya, I want to bring this back to your comments about the labor market. I was reading a note from Bruce Kasman at JP Morgan, who actually sees that the U.S. economy is going to slow, but the unemployment rate isn't going to rise because of what you just mentioned about immigration keeping the labor supply tight. How do you see that situation playing out? Because in that situation, I mean, the Fed really can't ease if they don't see this labor market weakening.
It's really hard for me to understand how there can be like a nice type of a cut in September. Like either the inflation is going to come through and the labor market doesn't crack, in which case they're not going to cut, so that's not great. Or the inflation comes through and the labor market cracks, and that's even worse because that's sort of stagflationary. You don't know where to go, bonds versus equities. Or the inflation doesn't come through, and I think what people aren't understanding is that the tariffs are in the system. We know that in the data. The tariffs are there. China's not paying them. We know that from the PPI data and the import price data. So that means if the tariffs don't come through in CPI, it's because the U.S. consumer has actually finally cracked, and the labor market will follow.
Yeah, there was some discussion previously about, the fact that services inflation makes up 65% of CPI. Yeah. So goods inflation, it can really be dwarfed by moves in services inflation, which could be caused by a weakening consumer. So that's something that you could definitely see play out?
Yeah, I think in the first instance, you'd probably get a bit of pass-through from tariffs to services inflation as well. So maybe the PCE gets to above 3% year-on-year by Q4, but it'll probably reverse very quickly as well. All of this provides quite a lot of trading opportunities because as a macro investor, what we're really talking about is the debate, not my kind of like pontification as to whether tariffs in 3 years' time will actually leave US inflation higher. It's sort of what's going to be validated in the next 6 months or so. And I think probably the inflation data will start to come through and show that the tariffs, probably also in services initially, but that will also undermine the real spending power as we go into next year.
Fred, before we let you go, Rachel Reeves, how's she going to balance the books?
Oh, I like to reframe it slightly because I think we're so sort of focused on this fiscal headroom, and she's given herself a little bit more fiscal headroom. But honestly, like if she but at the moment it's front loaded, right? The budget is front loaded. We've already on a OECD comparison, we've already got a very large fiscal drag as compared with other countries. And then we do have a general election in a few years' time. And if we're myopically focused on balancing the books in over this period, we know who's going to come in the next general election, and then what's going to happen to the debt ratio. So it's almost like we need to sort of. I hope that wasn't too elliptical, but there is a sort of a.
But your point is, don't worry about balancing the books.
Well, the point is that she's
the bond market going to be okay with that?
Maybe not in the first instance, because there is a strong correlation in the UK between bond issuance and the detrended movement in yields. The reason why I focused on emphasized detrended there is because in the longer term data, there's actually a negative correlation between the change in the debt ratio and the change in yields. That means debt ratio goes up, yields go down, because in most of the time, it's actually the private sector that is more important for driving yields. And there's a flow of funds identity which suggests that private sector surplus increases and the deficit increases at the same time. Yeah. When does the private sector surplus increase? It's when the private sector is weak, and therefore growth and inflation are declining, and so yields should be declining as the deficit is rising. That's the correlation that is in the data since the 1950s. The only exceptions to that are when you have negative supply shocks. So 1973, 1979, and 2022. So big negative supply shocks. switch the correlation between debt issuance and yields.
Yeah.
And so spending to protect the supply side is actually the smart thing to do.
All right. Freya Beamish, Chief Economist at TS Lombard, talking about the math on both sides of the Atlantic. We thank you so much. Coming up on the program, we're going to speak to the CEO of Rank, the German tank supplier set to play a key role in Europe's push to rearm. That exclusive interview coming up next. Stick with us. This is Bloomberg.
Break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that three-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Probably a moment to talk about the European defence sector, a sector that is firmly in focus right now, and a number of companies are at the heart of this story, one of which is the German gearbox maker Renk. It makes gearboxes for armoured personnel carriers, tanks, this kind of kit. And it's out with a note saying that the Bundeswehr, the German army, will need up to 1,000 new wheeled tanks and as many as 600 MBTs, main battle tanks, by 2035. It follows an announcement of a 5% defence spending commitment by NATO members at the recent summit in The Hague. Renk says it plans to invest close to 500 million. Let's get some more details from Ollie Crook.
Yeah, that's right, Guy. I mean, listen, all the talk of last week was the big, beautiful number, the announcement that we got from NATO, the 5% defense spending that everybody had been anticipating. It is what has prompted billions and billions of dollars to flow into these defense companies. We've seen record high after record high. The problem is that now it's the hard part, right? It's actually executing on this stuff. There was a note from Goldman Sachs that actually summarizes quite nicely that in the period from 2006 to 2020, if NATO had hit its 2% target, that would have meant 1.1 trillion euros more investment in this industry. The fact that you didn't get that is the consequence of what we're dealing with today, which is you lack the scale in Europe, you lack the capabilities, you have massive gaps on that, and now it's up to these companies to basically execute on this. Rank is one of them, as you mentioned, Guy. You know, they make the guts of the tanks, the transmissions, the suspensions. They're in the Leopard tank, they're in the Leclerc in France, they're in the Challenger in the UK, the Bradley in the United States, and so we're very pleased to be joined now by the CEO of Rank, Alexander Zagel from Frankfurt, to discuss a little bit about the execution. I'd like to start, Mr. Zagel, if we can, just on what we got from NATO last week and what your reaction there to the spending commitments are and your sort of baseline assumption before we got these formal commitments with annual growth of about 10%. Does that now change?
Yeah, good morning. I think last week's decisions on the NATO summit in Den Haag were, from my point of view, truly groundbreaking and milestone setting, and clearly giving us, from the defense industry side, a clear mandate to improve and to boost European and NATO's defense capabilities. If I just look on Rank, which is my first duty, of course, I can only say that from Rank point of view, we are ready to deliver, we are prepared, and we are also ready to invest further in order to support the ramp up of the needed capabilities.
And in terms of ramping up, one of the big constraints for many of the European companies has been capabilities. There have been some announcements that you have made that you can actually boost some of your capabilities in your existing facilities by 50%. Well, you have to expand those further. What does your footprint look like going forward?
It's a very important question, and I'm happy to answer. We have a well-invested industrial base currently at Rank. On top of this, we have a clear plan how to scale up by using our European footprint, by increasing, for example, shift models, and by a constant annual investment into capacity in the range of 3%. On top of this, it's very important to have the supply base under control, and here we are really taking care in order to keep this control, to support our suppliers, and even to build up carefully some needed inventory in order to be ready to produce in the next years when the new contracts from the 3.5% GDP spending is finally coming.
Alexander, good morning. It's Guy. Where are the bottlenecks right now? Where are the challenges? Is it in terms of the supply chain? Is it in terms of staffing, labor that you're finding issues with? Where are the issues that you need to focus on, and how quickly can they be resolved?
Our strongest focus is clearly on the supply chain. Happily, Rank and our products, we are not so much dependent on electronics, on chips, etc., etc. So we are not so much depending, not at all, to be honest, on rare earth metals. So the clear focus is to make a health check on our supply chain, to support our suppliers in order to build up the needed capabilities. And on the other side, of course, it's important because we are growing, we need to have people. But so far, we had not a problem to find the appropriate personnel in Germany.
Is it an offset? I keep hearing this argument. As the auto sector struggles, the defense sector grows. How easy is it to train somebody coming out of the auto sector, building a gearbox for a truck or a car, which don't have gearboxes anymore, certainly in the EV world, and transfer that skill into building a gearbox for a armored personnel carrier or a tank?
I think there's a certain source coming from automotive industry of capable workers, but I think it's fair to say that at least from the Rank point of view, we are not having these high demands. I mean, for example, if you just talk, for example, about a headcount increase during the last 12 months, 18 months, we increased our headcount in our lead plant in Germany by 10 to 12%. So we have a moderate increase because at the same time we are realizing production efficiencies. So of course, I mean, if it comes to specific technological requirements, if we talk about digitalization, hybridization, we are looking for sure in the automotive sector get experts out of this, but at least from the rank point of view, we are, if you want to call it, too small to absorb that massive demand from other sectors like for automotive or steel, for example. But to train a person to assemble automotive transmission, to assemble in the future tank transmission should be not a problem. It's a question about the demand and the absorption rate if you look at rank.
Alexander, it's Kriti in London. If I could just take a massive step back here, one of the big conversations we're having, at least on today's show, has been the question of how sustainable the promises around defense spending actually are. There's a big vote happening here in the UK at the moment that has to deal with some of the allocation of those resources. It's also the bear case, by the way, in terms of the European equity market. From your perspective, what is the biggest risk to getting that defense spending that's been promised to the actual inner workings of a company like yours?
Very good point. I think it depends pretty much on the financial capabilities, on the debt exposure of the different nations. If you take, for example, Germany, I'm very convinced, and there's a clear commitment from the German government to spend in the next 5 years in the range of 160, 170 billion in defense, and to ramp up to 3.5% spending in the year 2029. I think that some other countries, if you go to France, if you go to Italy, for example, will have a longer lead time in order to reach this level. And they need some support, for example, from the European Union to build up a kind of European defense bank. I think alone it's not possible.
And looking at the future of sort of tank building within Europe, I mean, this is the oft-cited statistic that I mentioned. It was mentioned in the Draghi report and by many others that the Europeans make basically 12 battle tanks, the U.S. makes 1. Where do you see that going? Are we going to see consolidation in terms of the kind of hardware that is being produced? And what does it mean in terms of, for rank, in terms of sort of how you're going to cater to those things? Is it going to be just one battle tank within Europe?
Very important question. I mean, if I could just start by rank and to explain the rank situation. If you take the European transmission market for tracked vehicles or for armored platform, it's quite consolidated, and rank is clearly the leader. But you're absolutely right. If you look on main battle tanks, if you look on armored personnel carrier, we have a lot of different types of platforms in Europe. So from my point of view, it's mandatory and it's absolutely important to have a consolidation. However, I do not believe that politics are the main driver for this consolidation. The consolidation must come from the industry, and if you look back during the last 1, 2, 3 years, I think there are some good examples, but it must be driven more and we must be faster, because at the very end consolidation is needed in order to improve overall competitiveness of the European defense industry.
And also just sort of looking at your stock performance, obviously it's up about 250% since the IPO, about down 20% in basically the last month. There's a fairly large short position that's been put out. How are you dealing with these sort of volatility and the fluctuations of valuation? Would it be easier for you to have sort of larger sort of anchor investors? How are you dealing with that challenge?
I mean, first of all, the market price or the share price is determined by the market. All what we can do from rank side is provide performance on our financial KPIs and performance to our customers. Generally speaking, of course, we have a business model as being an independent global supplier of mission-critical drive systems. So we welcome, of course, every kind of shareholder who is supporting this independent, profitable and growing business.
Alexander, we're going to leave it there. Thanks for taking the time to stop by and see us this morning. We really appreciate it. Come back anytime. Alexander Sagel, the CEO of Rank. And of course, our thanks to Oliver Crook. The debate today, this is a story that sits at the heart, you could argue, of some of the debate that we're going to be having around Europe as well this morning. Yeah. And in the United States. Where do spending priorities go? Where should they go? There's a guns or buster kind of debate that's happening here in Europe. But it was also interesting listening to Freya Beamish a little bit earlier on talk about the idea that actually in some ways governments can't put fiscal drag into the system at this stage, because there's a danger that actually growth slows and actually you end up with a slow growth trajectory, which therefore impacts your debt sustainability story. So there's a kind of argument that says spend, spend, spend. Yeah. And that's the debate we're going to be having in Washington so much a little bit later on.
But the problem here ultimately is that if you do that, at what point do the markets kind of whip you back into shape? And that's something we've seen under the Trump administration. It's also something that monetary policy officials in Sintra are paying attention to. At 2:30 p.m. London time, Francine Lacqua is hosting a policy panel with the world's top central bankers. Stick with us. This is Bloomberg.
morning. This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm Jemana Bersetchi in Doha, Qatar, and this is Bloomberg.
Our global headquarters in New York, I'm Danny Berger. Welcome to Bloomberg Brief. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday, only on Bloomberg. Context changes everything. Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg. Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Asia is at the forefront of some of the world's biggest stories. I'm Sherrian in Tokyo.
And I'm Heidi Stroud-Watts here in Sydney, where the trading day begins. We're here in the center of all the action to get you set up with the numbers, news, and knowledge you need for the day ahead.
The demand is indeed recovering. We've been waiting for this moment.
The opportunity of a century.
Join us on Bloomberg The Asia Trade. Weekdays only on Bloomberg TV. Context changes everything.
Newsmakers and market movers. This is The Pulse with Francine Lacqua.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua at the ECB Forum on central banking here in Sintra, Portugal, and these are your top stories. Bloomberg understands the EU is willing to stomach Donald Trump's 10% universal tariff, but with some exemptions. The U.S. president threatens Japan. Trump's $3.3 trillion tax and spending bill faces roadblocks as Senate Republican leaders continue to scramble for votes. And here in Sintra, Jay Powell will speak with other top central bankers as the White House steps up attacks on the Fed chair. Now, Bloomberg has learned that the European Union is prepared to accept President Trump's proposed 10% universal tariff, but it wants exemptions for key sectors in return. Now, the EU has until July 9th to clinch a trade arrangement before tariffs on nearly all of the bloc's exports to the U.S. jump to 50%. Well, we're now joined from London by Oliver Crook and Ross Matheson, our EMEA news director. So, Ollie, let's start with you. What do we understand about the EU position going into these negotiations in Washington this week?
Yeah, it seems to be that they have sort of come to peace with the fact that that universal 10% tariff is something that the Trump administration is effectively, basically totally unwilling to negotiate on, which is something that, arguably they should have come to the realization a lot earlier, because this has been fairly clear from the outset in terms of these negotiations. What they would like in return, that means that they're willing to accept in their minds some kind of unfairness and imbalance in the relationship. What they would like to see in return is a reduction slightly either through quotas or a headline reduction to the current tariff that exists on the automobile sector. That's now at 25%. They would like to see that come down, but they also want to get clarity on some of the other sectors that are still being investigated by the Trump administrations. For the Europeans, the ones that are the most important are the pharmaceutical industry, the chip sector, and the aircraft sector in terms of planes and getting those tariffs. Because what they're doing now, until they have clarity in those other sectors, is basically paying a down payment on something that they don't fully understand. So they'd like to get clarity on that. That's how they would like to make progress. And that is, of course, ahead of that deadline that is July the 9th, where we're expecting, if there is not a deal, that the Trump administration will impose those 50% tariffs on the European Union.
So, Ollie, what's at stake if these 50% tariffs are actually imposed?
Yeah, whenever you speak to sort of trade ministers and finance ministers, as I have over the last couple of months, when you talk about a figure like 50% tariffs on goods from the European Union, that is basically a sum which of the impact on the economy is entirely incalculable. Just to remind people, this is a $1 trillion trading relationship. It's the biggest in the world. Very much is at stake both for the United States and for the European Union, which is why they're going to take their time in negotiating this so an outcome that both sides can live with. That is why I suspect, I'm not sure that we're going to get that full trade deal by July the 9th. Plus, you look at the sort of first 4 months of this year, the trade deficit with the United States and Europe has completely blown out because everybody has been trying to get those sort of goods in and out of the sector before the tariffs come into action. So I suspect what you're going to get is potentially a sort of broad agreement, maybe some consensus, but really get that negotiation that goes past July the 9th. And I think that's probably the base case for a number of European policymakers.
So, Roz, what's the status of the other trade deals?
Well, what we're seeing, interestingly, is suddenly Japan is the country that's in the crosshairs. It was Canada a few days ago over this digital services tax, announced Japan over rice, and Donald Trump really putting his focus there and saying, hang on, Japan won't take any of our rice, and yet they've got a rice shortage in Japan. And that's leaving Japanese officials scrambling to work out how to respond. Of course, Donald Trump had a great relationship with the former Prime Minister, the late Shinzo Abe, but he doesn't have that anymore. And so who does he go to in Japan to get a deal done? And how does Japan engage with him to avoid being the one country that really gets his eye here? Is rice the new digital services tax? And so what we're hearing is that Japanese officials are playing it very low key at the moment. They don't want this to spark into a big public argument, but they're a bit perturbed. How can they respond in a way that will satisfy Donald Trump? Because agriculture, rice, is a really sacred industry in a way in Japan. I mean, decades and decades of protecting agriculture and particularly protecting rice farmers. That's bound up in a lot of identity culture, but it's also, frankly, bound up in votes for Japanese governments. And so that's got to be a factor for them. And so now suddenly Japan is the country out of all that seems to be having the problems.
Roz, if we also touch on what's happening on Capitol Hill, senators are voting on Donald Trump's signature tax and spending bill. Like, where are we? This seems to be going straight to the wire, right to the wire.
Well, yeah, so it could go very much into the US morning. It's ongoing, an awful lot of amendments, most of which have no chance of getting up. But there are some key issues here that remain. And so far, it seems there are at least 2 senators who are adamant in their opposition to this bill. If one more peels away, then Donald Trump has real problems in the Senate getting this passed. And there are fundamental disagreements, mainly at this point, over the pace of which to roll off some of these green credits. This is for EVs, for renewables and so on. At what pace to do those to help those industries. And so that's where we are at this point. There could be maybe an up and down vote later today, but it's bound in a lot of amendments and disagreement at the moment. And we can see that even Elon Musk is now weighing in again. Of course, he and Donald Trump had a massive dust up a few weeks ago. They papered over that dispute where they were really shouting at each other on social media. They've both been up in the wee hours taking pot shots at each other to the point that Donald Trump is saying, well, hang on, Elon Musk has benefited a lot from these subsidies. I don't like these subsidies. And perhaps I should have Doge have a look at Elon Musk in all of this. So that feud is bubbling away again, it seems, on the sidelines of this. And we're seeing an impact on Tesla stock going into the US day as a result.
Thank you both, of course, for the terrific update, Roz Matheson and Oliver Crook. Now, the U.S. Treasury Secretary has also played down speculation that President Trump could name a new Fed chair early, suggesting a name may not emerge until October or November. But Donald Trump is also continuing to put pressure on Jay Powell to lower rates.
The president sent this note to the Fed chair. It says, Jerome, you are, as usual, too late. You have cost the USA a fortune and continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars are being lost, and there is no inflation.
And the Fed chair will be among the central bankers who will be on a policy panel that I'll be hosting a little bit later on. Now let's bring in Adam Posen, the president of the Peterson Institute for International Economics. Peter, thank you so much for joining us. Adam, thank you so much for joining us. Look, there's quite a lot going on, right? And I have to say that Jay Powell is constantly under threat. Do the markets, care or wake up to the fact that the next Fed chair could be a little bit different?
I think the markets are making one mistake and one mispricing, Francine. I mean, the mistake is they are too dismissive of the idea that Trump could actually try to disrupt the Fed not just who he appoints, but try to disrupt its operations in a more aggressive way. I think the mispricing, though, is not understanding that the threat from a bad next Fed chair, to be blunt about it, is not so much about short-term inflation. It's about making the wrong decisions or getting incoherence in the committee at a critical point. So if it turns out there's high inflation, which I still think there's going to be, it really doesn't matter who's Fed chair. They will raise rates. If it turns out AI starts to come in, the fiscal starts to expand, and it's unclear what's going on, that's when having a bad Fed chair gets to be a problem.
But Adam, is there a danger actually with the constant, pressure from President Trump that actually Jay Powell, skews policy because he needs to be seen as independent? It's like the ABC of central banking.
Yeah, of course. But there, I think the markets and everybody get it right. Chair Powell is independent. The courts have curtailed the independence of the Fed, but not specifically with respect to monetary policy. And ultimately, he's the chair of the FOMC by vote of the FOMC. The president only gets to appoint the chair of the Board of Governors. The person who's chair of the FOMC has to have the support of the full committee, including all the 12 Reserve Bank presidents. And Jay Powell has that support. Most of all, Jay Powell understands the institution. I may disagree occasionally with him on regulation or on a specific monetary policy move, but he's devoted to rule of law. He's devoted to the independence of the institution. He's devoted to being a fair umpire.
Yeah. But when you look again at market moves, I think last week there was talk about having a shadow Fed chair, and markets moved on the back of that.
Which is noise. I mean, again, the question is, does the shadow Fed chair, if they create one, which Scott Bessent floated before the election, as you know, starts to really try to interrupt the news flow out of the Fed, tries to create confusion. So if the shadow chair tries to be obstructionist, again, ultimately it's not going to change policy, but it will create noise.
Okay, what else is noise out there? When you look at markets, expectations, and now also the trade concerns with Japan, is it noise, or could actually these trade negotiations change the trajectory of a lot of economies?
I think the Japan negotiations actually are very significant because, Francine, they're the most surprising holdout. The idea that China or the EU would bargain hard with the U.S. always made sense because they're the most diversified and largest. But Japan always, one would have thought, would be like the UK because of the deep economic, national security, political ties that they would want a deal no matter what. And if it turns out Trump cuts Japan a much worse deal than he's supposedly offered the UK but isn't implemented yet, that's a really negative sign for the rest of the world. So I think more attention should be being paid to the Japan negotiations rather than less.
I mean, how should the BOJ deal with this?
That's much harder. I mean, as you mentioned, we're going to have a panel later today with Andrew Bailey, Jay Powell, Kazuo Ueda, and Christine Lagarde. And Governor Ueda and the BOJ have a real dilemma. And because the tariffs are, or the threat of tariffs are creating a recessionary dynamic in Japan, but it's really stagflation because they've got rice and other things driving up the prices. So they're on the horns of a dilemma. I think, like Powell, they're in the end going to try to do the right thing on the economy and block it out. Yeah. But you have to allow for the fact that there's real shocks coming for Japan. Yeah.
But so, again, if you think about the BOJ, none of the options are good.
No.
What would you do if you were in charge?
I think I would do largely the same as what they're doing right now, which is staying on their very slow rate hike path. I would back off some of the discussion of normalization, which that rhetoric still keeps coming back, and not so much because they're worried about the fiscal sales, but because the outlook now, if anything, I think is more negative. They stand a real chance of an externally shocked recession.
Adam, I want to come back to your inflation expectations in the U.S. Why are they so slow to materialize?
I don't think they're that slow. I admit that having 4 months in a row of inflation prints that were a little below consensus and below where I was thinking is information. But as Fed Atlanta President Raphael Bostic said in a speech I think yesterday, there's just plenty of reasons why there might be a lag, including just literally, and we know this from the auto industry, that they were burning through present inventories. And once those inventories are gone, you're now seeing prices go up. Now, the MSRPs, the official sticker prices, are not, but all the major companies, even Ford, are lowering incentives, lowering the financing deals, lowering the availability of certain models. These are all forms of inflation, and the actual price transacted is going up. These tariffs are already hitting the U.S. auto industry. It's harming supply chains. It's causing inflation that we're already going to feel.
So without the tariffs, either a threat or real, do you think the Fed would have cut rates?
I think they might have, but I think it would have been a mistake because even if the tariffs aren't there, but they are, the anti-migration policies in the U.S. are also inflationary, if not stagflationary. The fiscal policies we're going to get, we talked with your colleagues about that bill's going to pass. And so the only question is just how much short-term stimulus does it hold? But the bias is going to be to the upside because people are going to stop paying taxes. There's less enforcement. So ultimately, I think, and this is something you and I talked about over the last year, I think the Fed is understandably but making an incorrect forecast. The forecast is more likely to be inflation than not.
Okay. The ECB has an easier job. Yes. Actually, they did okay.
Yeah.
But what would it take to go into, to cut another? If you cut, it starts becoming stimulative.
Yeah, and again, I think if the ECB makes this deal that we're talking about with Trump, which is not optimal, but medium term is probably smart for Europe, and sorry, it's not the ECB, it's the European Commission. Yeah. The ECB should basically stay on its path. And I agree with you. The ECB of the major central banks has by far the easiest situation right now. And rightly, a lot of the attention now is being paid to digital euro, stable coins. I mean, these are things that used to be solutions in search of a problem. Well, now we have the problem, which is reduced faith in U.S. treasuries. And so Christine Lagarde and a number of the other ECB leadership, governing council, are right to be focusing on that issue now.
I mean, apart from gold, there doesn't seem to be an alternative, actually, for central bankers around the world.
Yes and no. I mean, you can get into small other currencies, relatively small other markets like Japanese yen, Swiss franc, Norwegian krona, but of course those get overbought very quickly. Yeah. They're not as liquid. You can issue more debt in Europe. That's the best way out for everybody, essentially. And that's, of course, out of the ECB's control, but I think they're right to indirectly and directly say deepening European capital bond markets, capital issuance is a good thing.
Adam, thank you so much for joining us today. That was, of course, Adam Posen, president of the Peterson Institute for International Economics. Now, coming up, our interview with the chief executive of the S&P Dow Jones Indices as U.S. stocks end the first half at a record high. That's next, and this is Bloomberg.
Up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
Africa, a region rife with potential for growth and opportunities, but not without its challenges. Bloomberg highlights the biggest stories, interviewing key players, and reporting on the issues impacting the region. Join us as we get to the heart of African business, politics, and economics, and ask the question, what's next? I'm Jennifer Zabasaja, and this is Next Africa. New episodes every month, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg. Welcome back, everyone. Now, U.S. stocks have ended the first half of the year at a record high. Now, equities have soared since April's meltdown. That's amid hopes that the U.S. is moving closer to reaching deals with top trading partners. Well, let's get more with Guy Johnson in London with a guest. Hi, Guy.
Yeah, it's only at a record high if you're a dollar investor. If you're a euro investor, the picture looks very different. So let's discuss that aspect of what we've seen over the last quarter. Dan Draper, CEO of S&P Dow Jones Indices, joining me around the table. Good morning. Nice to see you on this side of the Atlantic.
Hi, Guy.
The perspective from different sides of the Atlantic looks very different. If I'm a US investor, the S&P's had a great quarter, done really well. Markets have bounced back from the lows. If I'm a euro investor, I'm looking at a pretty big headwind here, and actually I'm not at record highs. Are we moving into a different position now when we think about US markets, and that is one that has to be currency adjusted?
Yeah. Well, I think, yeah, as you mentioned, I mean, the U.S., if you look at the S&P World Index that we have, global equities, yeah, U.S. equities still are about 64% of that index. So it's a still big constituent. But what you've had is the currency movement you've been reporting on, continuously, has been sharp. I mean, this is over a 10% decline in the dollar versus a basket of other currencies. That's the biggest decline since 1973. Right, going off the Bretton Woods gold standard. So that's a big movement. Hasn't been it's kind of been done over a couple of months here, but that adjustment has made the market less attractive. But overwhelmingly, what's kept the market high are the domestic wealth management investors in the United States. As foreign investors, when the dollar started weakening in April, started moving funds to Europe, Asia, to the home markets, those were institutional flows, more than made up by domestic flows.
And is that something that you think is going to carry on? Because the retail investor, we're getting to a story where you used to never bet against the US consumer. Now do you never bet against the US retail investor, because that demand has been insatiable. There's a lot of muscle memory that exists from the last few years. If there's a dip, you buy it. There's an opportunity there, you take it. Is that something you think is going to be tested, or do you think we're still in that kind of a world? Yeah, well,
just on the U.S. domestic market, what has changed among wealth and retail investors is the rise of fee-based model portfolios. Over half of ETF inflows last year, and certainly on track this year, will go into these model portfolios, which automatically rebalance. The Vanguards of the world and others who provide the robos. So that is kind of giving more systematic dollar cost averaging. Now, I think looking, like I said, abroad, you have the U.S. earnings, the companies that are, compared to, say, the dot-com bubble where you had a lot of promises but didn't deliver on earnings. The tech giants that are delivering, their performance now, certainly in the last 2 months, are also delivering earnings. U.S. earnings reported in Q2, 77% of the reported companies have outperformed. That's versus 73% historically. So you're starting to see the delivery. Where can you get that earnings growth and momentum in the world? Again, it's the U.S. is kind of leading, again, offset by the weaker dollar for foreign investors.
Does the market feel too narrow, though? That's always been the concern. And you look at the fact that the S&P outperformed the equal weight over the last quarter.
Yes.
That tells you the market's a little tight, maybe.
Yeah. Well, if you look at Q1, when there was fear, obviously you moved to a very defensive posture in the equity markets. You did see the momentum trade, the concentrated, Mag 7, massively underperform. The equal weights, but even defensive sectors, low volatility equities. So you saw that if we face another correction period, you're going to see the underperformance. But as you've now seen the more normalization, momentum, the S&P 500 momentum index has outperformed substantially the last 2 months, the normal S&P 500. So momentum is a strong factor, and it seems to indicate, and particularly when you close at all-time highs as we did yesterday, there's a 92% chance historically, looking backwards, that you're going to have another all-time high within the month.
Okay. In terms of the scenarios you see going forward from here, does volatility pick up? Momentum is great when you have a reasonably stable environment and that kind of trade works. But do you think we are moving into or are in a more volatile period, despite the fact we've got the VIX at kind of 16, 17 right now?
Well, clearly, we live in a world of headline volatility, right? Every day and intraday. But if you look, the VIX index, which we look at, has come back down to 17, 18. So it's kind of, mean reverted to closer to historical levels. But beyond that, implied volatility, looking forward, and dispersion are actually reasonably high. So that means that, arguably, if you're looking to tactically rotate or even, frankly, active management, this should be with the higher dispersion levels. And again, that won't be seen in the VIX itself. Those are still elevated. So again, the negative sentiment, that is still overhanging the market is actually, I think, a positive, considering we're closing at all-time highs. There's not a crowded trade, at least sentiment-wise, in these closing highs.
In terms of the rest of the world now, do you think we are going to see a more diversified, balanced world going forward? We've been through such a period of US exceptionalism. Can we stretch that model any further? Or do you think, actually, we end up in a position where we do see some of the narrowing that we've got? US equity markets are trading on, 23, 24, kind of really high multiples. Europe's trading on 14, which is high for Europe, but nevertheless, we've got this incredible kind of gap that exists across the Atlantic. Do you see a world in which that does start to narrow, that does start to even out, that we see more even flows around the world?
Well, again, if we go back to kind of Q1, and certainly with the April original tariff announcements, you did see valuations matter, and you saw kind of the mean reversion. You saw flows, and you obviously saw the outperformance, certainly in local currencies, Europe, emerging markets. So those valuation gaps did close. I think the U.S. exceptionalism, it's the entire capital markets ecosystem. If you start with the venture capital into private equity, all the way through the listed companies, and what's emphasis, these aren't just necessarily U.S. companies, it's the foreign growth companies that are listing in the United States. So if you are a tech, communication giant or a unicorn and you want to list, you're increasingly looking to list New York Stock Exchange, NASDAQ, and so it's bringing even global companies into those listed markets.
Do you think America wants everybody else's capital, though? I think it has done. Does it continue to want it? Because the flip side of the trade story is a capital story.
Yes.
And if you change the trade story, you change the capital story. Can you see a world in which trade does get more restricted and therefore capital does get more restricted? Is that a desirable outcome, do you think?
Well, look, I think balances, matter over time. And again, we saw when there was kind of the fear in early April, that became an issue, right? You saw, kind of the inflationary worries, the steepening of the yield curve, and the focus on the U.S. fiscal imbalance, right? So being able to think about when you have such a large consumer-based economy, the offsetting kind of capital flows, the financing of that, that's what we've been in. The question is, does that, break over time? And again, we've seen over shorter periods when there's been that dislocation.
We will watch with interest.
We shall.
Dan, great stuff. Thanks for dropping by to see us. Dan Draper, the CEO of S&P Dow Jones Indices. Back to you in Sintra, Francine.
Guy, thank you so much. Guy Johnson speaking, of course, with the chief executive of S&P Dow Jones Indices. Coming up, we speak to the chairman of Société Générale, Lorenzo Binismaghi. That's next. We have a full roundup, of course, of the markets. We talk trade, and that's ahead of our big policy panel here in Sintra. That's at 2:30 UK time, 2:30 Portugal time, where we'll be speaking to Andrew Bailey, Christine Lagarde, Jay Powell, of course, Governor Ueda of Bank of Japan and the Governor of Bank of Korea. They all have very different trajectories when it comes to inflation, when it comes to growth. So don't miss the policy panel live from Sintra.
Bloomberg launches our inaugural 25 African startups to watch list.
About 2.5 years ago, we created a solution. We are able to generate refrigeration using the sun and water. We're able to store energy in the form of ice, as opposed to storing energy in the form of lithium batteries. We integrated in every refrigerator a pay-as-you-go technology, allowing individuals and small businesses to be able to pay as low as $10 to own a refrigerator.
Uncover is a women's wellness brand that is specifically made for women of color. It's based in Africa, which is the most underserved beauty market in the world. We are making Africa a priority and not an afterthought. We believe that the population on this continent deserves to be formulated for, heard, and we are giving this consumer a voice.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here at the ECB Forum on Central Banking in Sintra, Portugal, and these are your top stories. Bloomberg understands that the EU is willing to stomach Donald Trump's 10% universal tariff, but with some exemptions. The U.S. president threatens Japan. Trump's $3.3 trillion tax and spending bill faces roadblocks as Senate Republican leaders continue to scramble for votes. And here in Sintra, Jay Powell will speak with other top central bankers as the White House steps up attacks on the Fed chair. Now, earlier we spoke with the Bundestag president and ECB Governing Council member. Of course, he is Joachim Nagel, who said the ECB has brought inflation under control, but must not become complacent due to high volatile geopolitical backdrop.
Trade front loading is here the most important factor that gave us these good numbers for the first quarter. Now we have to take into account what comes from the tariff side, how this is evolving over time. And the point that I have here, we need, let me say, decision. We need more stability. We have to reduce uncertainty. And so I really hope that this tariff discussion is coming to an end, to a good end.
To a good end. How do you see it playing out? And again, because of front loading, could you see it then fall off a cliff, or is it gradual, or is it just very difficult to model it?
If you want to bring yourself into the shoes of somebody who's doing an investment in a very uncertain world when you think about the tariff discussion. I think for those we have to give clarity. We have to give them an orientation point where the tariffs are going. So I'm not putting like this that we are falling off a cliff, but financial markets, they need certainty. If there is uncertainty, then we see high volatilities. And so I guess it has to be of utmost importance to bring this whole discussion to an end, to a good end.
But given the uncertainty surrounding trade, could it still change the economic outlook for Europe?
Yeah, absolutely. It can change the economic outlook. I think if the tariffs are coming out at a very high level, I think this will be a burden on the economy. This is absolutely clear. And this is in a situation where you already alluded to that the economy in Europe is picking up. Taking my own country with the fiscal package, I think this year it looks around a little bit above zero growth, and then the next year we will see we'll see 0.6, 0.7, and then in 2027, maybe then it's maybe here 1.2 or something. So what I would like to say with this, that we are in a fragile situation, and when there is this, let me say, situation where we have this uncertainty and you are in a fragile situation, this is a burden to the economy.
Yeah, I mean, given all of this uncertainty, is that why it makes sense to have scenario planning, so that it's a lot more nuanced when you look at the risks going
I think this is part of our new strategy review, that we are doing this scenario analysis. We did it in the past, now we're doing it a little bit more, let me say, more intense, because we take into that now we are checking all the different all the different possibilities. And so I believe this is an important exercise, and this review was important to do because we came from a situation where inflation was way low. Then after the pandemic and this Russian war of aggression against Ukraine, we came into a situation where inflation was much too high. Now we know a little bit better how the instruments are working, and we realize that we have a rich tool that we have here available to tackle all the different situations.
Joachim Nagel there, President of the Bundesbank and ECB Governing Council member, speaking to me a little bit earlier. Now, we're also joined by Lorenzo Binismaghi. He's chairman of Societe Generale, former member of the executive board of the European Central Bank. Mr. Binismaghi, as always, thank you for joining us in good weather, actually, this time. Yes, so this is a positive. When you look at trade and when you look at all of the uncertainty that central banks like the ECB have to face, what is the right way forward for them?
Well, certainly, I mean, the situation is very different in Europe from the US. I think in Europe, indeed, inflation has been brought back. Expectations are aligned. Actually, if you look at the forecast of the ECB, there is maybe a risk that inflation is too low. So the ECB has to be careful not to repeat, if I can say, the mistakes of 2014, 2015, when it let the inflation come down and did not act sufficiently strongly or delayed action before getting into quantitative easing. So that's something you have to look at. On the other hand, you know, oil price may increase and, you know, you can have some kind of other. So life is not easy for central bankers right now, but I think the ECB is in a better position, certainly, than the Fed, which faces many different shocks, the fiscal policy, the trade shock. So that's, I think, much more complex environment to navigate.
Do you worry more about inflation going down to 1.6 instead of 2% and reaching that target?
If I look at the forecast of ECB in 2027, inflation is 1.6. And if all this uncertainty, I think it's very difficult to forecast the impact of uncertainty on consumption, on growth, and therefore on inflation. But intuitively, the higher the uncertainty, the lower is the investment that companies are going to make, and consumers are going to wait and see. So this means deflationary forces, and that's much more complicated to contrast than inflationary forces.
We were listening yesterday to the speech of Madame Lagarde yesterday evening, where she, talked also about the strategic review by the ECB. Now, to put it very simply, the idea is that instead of giving proper projections, is you have a base of scenarios. I mean, is there a concern that actually scenarios gives you different outcomes, but actually could be even more confusing than what we have now?
Well, scenario is a way to look at possible margins of maneuver Clearly, for instance, if we go into a deflation scenario and interest rates are already very low, you're going to hit the zero lower bound, and that's a risk you have to take into account. Now, the key word in this strategic review is forcefully. You know, the central bank has to ask, the central banks need to act forcefully. But what does it mean, forcefully? I mean, learning from the past, I have the impression that the central bank should understand that some of the actions they took in the past were not forceful enough. If I think about 2014, 2015, the deflationary impact that the ECB was facing, it started by lowering interest rate into negative territory, then forward guidance, and then only at the end QE. I really wonder whether that kind of path was the right one, whether they shouldn't have gone directly to QE without, you know, going beyond the forward guidance, which didn't really work, and negative rates, frankly, were not optimal for the economy.
But isn't this time even more difficult, given the wide range of unpredictability when it comes to trade policy from the U.S.?
Yes, but learning from experience and looking what the Fed, the Bank of England have done, for instance, they didn't go negative on interest rates. And in Europe, I think this certainly hurt the banking system. It prevented the banking system. It reduced profitability, so banks had to shrink their balance sheet. So actually negative rates didn't have a great impact on credit growth, for instance. And that's something that I would have expected to see. So while quantitative easing, maybe it lasted too long, but it started too late. That kind of self-criticism I'm missing a little bit. Hopefully they will learn from experience if it happens again. I mean, this kind of deflationary forces.
Do you worry about deflationary forces?
Well, again, I mean, you know, if we face a long period of uncertainty, companies not investing, consumers waiting, I think that's going to drag down the economy, and not only in Europe, all over the world. And you know, and if savings goes up, that's a deflationary. Now, you know, other things can happen, but that's something that you can see may happen again.
We talk. I mean, we hear a lot from Christine Lagarde in you know, Europe and the euro actually taking a bigger role, given the global imbalances and question marks surrounding the dollar going forward. I mean, in this scenario, what roles do European banks have to play?
Well, I mean, there are great opportunities in Europe. I mean, we just need to act. We need to create a capital market. We need to create a deeper market. We need to have...
Crazy we don't have it yet.
Well, I mean, you know, everybody's committing to that, but then when it comes to taking decisions, you have the bureaucracy, the national competences, what I call, you know, turkeys don't vote for Christmas, you know, all those who lose power by creating a European capital market, they fight for their own survival, which is, you know, which is not the right thing to do right now. I think we have to look at the European banking system, European capital market, also having the courage to go for technological changes also in the financial sector. I mean, all this discussion about stable coins and, you know, I mean, Europe sometimes is too afraid of change rather than embracing and mastering change. I think the central bank has a big role to play here, not only to regulate, but to make sure that the system is resilient and is able to supply the global system, the global financial system, with assets that are in euro, are stable, and are liquid.
Yeah, we saw Bank of Korea actually yesterday, you know, stopping some of the experiments with stable coins. Do you think Europe should go ahead and do it properly?
The digital currency, or because the digital currency, frankly, is it's going to be used by retail. It's not going to be. I think the stable coin is a technological innovation which is huge, and it's going to be global, and will allow people to really transact without cost immediately. So it needs regulation, it needs support, and if European banks won't do it, the American banks will. So again, do you want to be in the competition and be there and you know, regulate because you need to regulate and to supervise, but in the end, you have to take some investments to enter these new businesses and not letting it only to your competitors.
Lorenzo Binismaghi, thank you so much for joining us today. That was, of course, the chairman of Societe Generale and former member of the executive board of the European Central Bank. Now, coming up a year after his landslide election win, the UK Prime Minister Keir Starmer is under pressure as he faces a revolt over plans to cut welfare spending. Details next, and this is Bloomberg.
From our studios in New York and San Francisco, our expert hosts have the data and analysis from the companies you know and the startups to watch, plus the interviews you don't want to miss. Watch Caroline Hyde and Ed Ludlow on Bloomberg Technology, the only daily business show dedicated to tech, right in the middle of the trading action. Live every weekday, only on Bloomberg Television. Context changes everything.
Good morning. This is Bloomberg Surveillance.
Welcome back to the opening trade. Watch Bloomberg Tech. This is the Asia Trade.
This is Wall Street Week. Welcome to Balance of Power.
This is Bloomberg Television.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business. The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
It's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
The level is not the problem. I think that this is perfectly, acceptable according to our projections. Here the question is, that we should try to avoid any sort of overshooting. It's much more, the speed of the adjustment than the level. But I think that 117, even 120, is not something that we cannot. We can overlook a little bit. Something beyond that, it would be much more complicated. But 120, I think that is perfectly acceptable.
That was Luis de Guindos, Vice President of the European Central Bank, speaking to us a little bit earlier. Now, the UK Prime Minister Keir Starmer working to contain a rebellion in his Labour Party ahead of a vote on his flagship welfare policy. Now, the bill has provoked widespread internal criticism and cast doubt over Starmer's leadership. Well, we're now joined by Ruth David, our London Bureau Chief. Ruth, good morning. So great to speak to you. How likely is the bill to pass, and how close could it be?
Good morning, Fran. Love your new office. Now, in terms of the bill passing, it is still too close to call. We just had an update to our story that said about 39 Labour MPs have signed a new amendment at sinking the bill. We're hearing in other media, and we're hearing from us as well, that that number is between 40 and 50. And we don't know whether that number could rise to about 80 that they need to sink it by the evening. So the vote is expected at around 7 p.m. and there'll be a debate in the House of Commons starting at lunchtime. So there's still a lot of way to go, and there's furious back-channel negotiations going on to ensure that this bill passes, but it's absolutely too tight to call right now.
So what does it say about Starmer's position, but also the position of his Chancellor, Ruth?
It's a really grim anniversary for Starmer, who came in last year with, a 165 majority this huge win for the Labour government, and then there's been a series of missteps and backpedaling. So we estimate that the Treasury will have a loss of about $4.25 billion from this and the backpedaling that they did on pension reforms. And we're talking about all of this, even if the bill goes through. There's so many other challenges. The Chancellor, who promised not to raise taxes, who promised not to increase borrowing, is seeing all the other measures that they're trying to put in place being stymied by their own party. So I think for both of them, even to get this through is not going to be the end of a long road ahead and plenty of struggles. But we still got 4 more years, so let's see.
Let's see, indeed. Ruth, thank you so much. Ruth David there, our London bureau chief, with a terrific briefing on some of the rebellions, of course, that we could see this week. Now, let's also bring you a Bloomberg scoop. We've learned that Apple is considering using artificial intelligence technology from Anthropic or OpenAI to power a new version of Siri. Now, it's a move which would sideline its own in-house models as it looks to turn around its flailing AI efforts. Now, for more, we're joined by Peter Elstroms, Bloomberg's executive editor for global technology. Peter, congratulations to you and the team for this really, really incredible story. So why is Apple doing this?
Yeah, this is a Bloomberg exclusive, as you say. Yeah, so Apple has been struggling in AI. The company, of course, is known for its cutting-edge technology, for its ability to integrate hardware and software and put them in together in these very elegant packages that, you know, we all spend $1,000 on. But in the case of AI, they've really fallen behind. Of course, we heard about Apple Intelligence last year. We've heard about some of those details. But now what we understand is that they're talking with OpenAI and Anthropic about possibly using their AI technologies in the iPhone in particular. What they've done is they've had talks with these two companies, and they've asked them to try customizing their LLMs, their models, to be able to run on Apple infrastructure and then use them with Siri and offer these products to customers. At this point, the talks are still quite early. They're still experimenting with those two different models. Internal tests so far suggest that Anthropic is quite attractive to them, but they also have an internal effort to do their own AI that they're still working on. They plan on introducing these technologies sometime next year.
How will Apple's AI team actually be impacted?
Well, this is a big deal for them that their leadership has decided they have to look outside the company. So, big picture, this is a tremendous setback for Apple that they're struggling to catch up in AI. If you believe that AI is very important technology, a once-in-a-lifetime technology, as some have described it, then you need to believe that you have to be at the cutting edge of this, and you have to be able to deploy these services to offer them to your customers. And for the internal teams that have been working on this at Apple, they have been struggling to catch up with the leaders, particularly OpenAI, Google, Anthropic, and some of the others out there. Of course, there are a lot of Chinese competitors out there. And the important part, I think, for the Tim Cook and the leadership team, they realize that they can't fall behind in this technology. They need to figure out some scenario, whether it's using some of these outside vendors or whether it's doing it internally, to be able to catch up with the leaders and incorporate into the iPhone and other products AI technologies that's really cutting edge.
Peter, meanwhile, Meta has announced it's developing an AI super intelligence group. So what's the purpose of that?
Yeah, it's interesting. We're seeing a lot of big moves from big tech around AI. There's a lot of jostling to get into places where they can actually have leadership positions. It's not just Apple and Meta, it's Google, it's many of the others too. So in Meta's case, we had Mark Zuckerberg, of course, spent a lot of time investing in the metaverse and what he thought was the next big thing a few years ago. And now he's pivoting very hard into AI. What we heard most recently is that he's been recruiting this team for superintelligence. They call it the Meta Superintelligence Team. They're trying to recruit a lot of talent from the outside. They announced 11 of these people just yesterday, including the leadership team is going to be headed by Alexander Wang, the guy who had been at Scale AI. Meta invested $14 billion into Scale AI, and they took the CEO on to help lead this team. In addition to him, this guy who used to run, this guy Nate Friedheim, is going to also help run the group internally. He had been running GitHub in the past. So those two are going to kind of guide the AI efforts of Meta as they try to catch up and they try to also compete with OpenAI and some of the others out there.
Peter, thank you so much. As always, Peter Elstrom there. Terrific briefing. Peter, of course, manages our global technology. Now, also making news, Boeing says its chief financial officer, Brian West, is stepping down. Now, West helped orchestrate one of the biggest capital raises in U.S. history last year to steady the plane maker. He will leave in August to be replaced by the former Lockheed Martin executive, Jay Malave. Now, Standard Chartered is reportedly facing a $2.7 billion lawsuit over the 1MDB scandal. The Financial Times says liquidators have filed a claim in Singapore, which argues that the bank failed to conduct the anti-money laundering checks required of it. Now, the bank has told the paper that it will vigorously defend against any lawsuit brought by liquidators. And European bank stocks just completed their strongest first half since 1997, and in doing so extended what has been a golden run for the sector. Well, we're joined now by Paul Davies from Bloomberg Opinion. Paul, thank you for being with us. Have traders, well, actually, what stood out in the first half?
Yeah, thanks, Francine. So it's they've performed very well, obviously, as you say, and a lot of that is down to interest rates remaining higher than expected, and also the trading environment has been incredibly strong. Ever since we saw the Liberation Day kind of tariff war throw markets into a bit of chaos in April. There was some kind of concerns then that traders might sit back on their hands, investors might sit on their hands a bit because of all of the uncertainty involved around how that would develop. But in fact, that's continued to be very strong. Now, investment banking had been quite weak, and even only at the start of June, a lot of the executives were talking at various financial conferences and being quite cautious about the amount of fees, about M&A activity and so on that we would see. But as the quarter closed, everything has turned out better than people expected, I think. And we had a story yesterday about how global M&A in the first half finished with about $1.8 trillion worth of deals, which I think was the best first half in about 3 years.
So Paul, have traders effectively bailed out investment bankers?
Yeah, to a degree, yes. I mean, as I say, the investment banking side did recover as the quarter went on, and especially in just the last few weeks. But trading has been particularly strong.
So, going to some of the deals, like why is BBVA going ahead with its bid for Sabadell when the government is so obviously against it?
Yeah, well, this is very interesting, actually. I mean, a lot of the consolidation that we're seeing in the sector is kind of running into difficulties. There's a lot of political opposition. I mean, especially in Italy, it's been incredibly difficult, and it looks like the whole complex of deals there is going to hit a bit of a stalemate. BBVA has always said that they were confident that they would be able to achieve a lot of the cost savings, a lot of the kind of synergies, especially on the IT side, with or without the ability to fully merge these two banks. Now, the government, in a pretty political move, has turned around and said you're not going to be allowed to merge Sabadell and BBVA for at least 3 years. But as I say, they're pretty confident they can get the savings anyway. So they've decided to, I think, go ahead with the offer.
Is the rest of the European banking consolidation over, Paul, before it's even begun?
Yeah, well, this is going to be an interesting question. I mean, especially in Italy, we've got, a lot of political opposition, a lot of, conflicting interests, people competing against each other to try and get influence over. I mean, ultimately, Generali, the insurance company, is kind of at the center of a lot of this. But the biggest and most surprising sort of development, I suppose, in the last couple of weeks is Brussels and Italian authorities starting to look at the original share sale, or the most recent share sale for Monte dei Paschi, where some smaller investors managed to get some pretty influential stakes. And now there is some, suspicion or concern that perhaps that share sale wasn't done correctly, and some of the bigger banks that bid, or that wanted to bid, such as UniCredit, didn't get the proper opportunity to try and get the stake when it was put up for sale by the government.
Okay, Paul, thanks so much. Paul Davies there on some of the banking stories we're covering today. Paul is from Bloomberg Opinion. Now, a couple of currency moves. Look, the euro is hitting a new high versus the dollar at 118, so it's extended gains rising some 0.3%. We'll, of course, talk about foreign exchange. At 2:30 p.m. London time, we'll be hosting a policy panel with the world's top central bankers. We'll have all of that live on TV. Terminal users can also get commentary and analysis on T-Live Go. Up next, Bloomberg Brief, and this is Bloomberg.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter. But it's bad for the product. It's not good. After that, I'm never doing that again.
Good morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's 5 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know on this Tuesday. The Vote-A-Rama continues. Senators poll an all-nighter on the $3.3 trillion tax and spending day bill. 8 days to go until the trade deadline. The EU pushes to negotiate while President Trump threatens to up tariffs on Japan. And an all-star lineup in Portugal. Powell, Lagarde, Ueda, Bailey, and Rhee all set to speak at the ECB Forum in Sintra. All right, we have a little bit of breaking news to start the show for you. We are getting Euro area prelim June consumer prices rising 2% year over year, bang in line with the estimates. It was 2%. When it comes to core prices, 2.3%. Again, that was the estimate. The month over month price for you is 0.3%. All of those within the estimate. And that is perhaps good news that it is hanging around 2%. Maybe that solidifies the ECB rate cut come September. You can see the euro has been stronger all morning. It really peaked up right before that CPI report. It's kind of hard to see on this chart, but slightly ticking down. Even still, this is the strongest the euro is versus the dollar since September 2021. In fact, it was the worst first half for the dollar, for DXY, since 1973. That's not what's happening in the rest of American equity. Let's look at what futures are doing this morning. Short Sure, they are weaker, but this comes off the back of 3 consecutive gains for the second all-time high. We're weaker by just a touch this morning, down about 0.1%. Your NASDAQ futures down 0.2%. It was also a really strong quarter and first half of the year for this bond market. The rally is continuing there this morning. We're down by a basis point for your front end. 10-year yields down by 3 basis points, just above 419, the best quarter since February and the best first half in 5 years. Let's look at some individual stocks now, including a big drop from Tesla this morning. With that is Joe Easton. Hey, Joe.
Hey, Danny. So as you say, it is a big drop for Tesla this morning, down almost 5% in the pre-market this morning. If you thought the bromance between Trump and Musk was over, well, it is well and truly now. We've seen Trump online railing against Musk, saying that he gets more subsidies than any other human in history. And those comments hitting shares of Musk's car maker today. As I say, we're close to down 5% on that one. Really, that relationship taking another downturn. Then a couple of crypto-related stocks to bring you. Firstly, Circle. Remember this one of the best performers of the year today, and news that the company could actually go for a banking charter, giving the stock the latest lift on that. So we're up 2%, extending a massive rally for Circle. Then Robinhood, also a bit of a gainer this morning. We did get news of them doing some securitization via the blockchain. So essentially, you're going to be able to buy stocks in other countries outside of the US via the blockchain. Something very complicated. I probably don't really understand myself, but it does sound very exciting for Robinhood investors, and the stock gaining today. And as usual, check out the Before the Bell opening wrap on the Bloomberg terminal for a summary of all these news movers and more. Danny.
Oh, thank you. Excellent work. We'll catch up with you later in the hour. Also in this hour, we'll be speaking to Kelsey Barrow of JP Morgan Asset Management on the Sell America trade, whether it's real or it's ebbed, and Jeff Yu of BNY on the risks ahead for that treasury market. Now on that, Jeff writes, quote, "The rest of the year will tell, especially if the big beautiful bill passes, how attractive U.S. sovereign debt is for investors overseas, or whether or not perceived risk remains high enough to discourage a return to the market in any meaningful way." Jeffrey joins us now. He's senior strategist at BNY. And Jeff, it was a good quarter for treasuries, all things considered, the best since February, the best start to the year, the best first half in about 5 years. Does that suggest that foreigners are still happy and well to be in this market?
Well, they're certainly not unhappy to be in this market, and it really depends on what part of the curve you want to be in. I think a few observations, firstly around April, late April, yes, there was a lot of selling, basically the liquid parts, where foreign investors actually did own a lot, like 1 to 3, 3 to 5 years. But even throughout that period of volatility, they were buying the long dates, right? Because I think the dollar really plays into this. Again, if you're seeing where yields are, quite handsome, but crucially, the dollar has come off 15, 20 big figures, well, 15 big figures against the euro. So for a European investor, that's a lot more compensation for owning this, and they feel they are adequately compensated right now. So a bit of a tailing off in flow towards the end of the quarter, but by and large, they certainly still want to be in this market.
What is the level, Jeff, that we get at for this yield that becomes attractive for new buyers?
So I would, again, combine that with where the dollar is. Let's say you get a 5% or 4.5 to 5 range, depending on where the curve is. I think whether the euro dollar is going to be at 120, versus say 105, 110, say dollar yen at 145, versus say 150, 160. These are going to be the crucial levels. But as long as the dollar limits its gains right now, I think they'll be happy with even a slightly lower yield compared to where we are right now.
Jeff, what do you make, though, of the fact that we have seen yields that have been coming in, stocks at all-time highs, credit spreads back at the tightest from May, but a dollar which cannot find a bid?
So I think the dollar is actually a cornerstone of that right now. So 2 reasons. One is where the Fed is going to be. I think the bulk of the market sees July as a live meeting. So that's limiting the dollar. But secondly, going back to the other asset classes, the fact that July is live and we may get 2 cuts at least for this year. So that is underpinning risk sentiment as well, limiting the tightening in financial conditions, which again is attracting international investors. And to be frank, the onus is on the rest of the world, the Eurozone, APAC, to show that they have growth, to really pull away from US exceptionalism. And so far, I think the jury is still out there.
Jeff, at the moment, as we speak, live in Washington, D.C., there is a vote going through, and you mentioned that the fiscal deficit is going to have so many ramifications for this market, but the question is when. At what point is this a bond market that wakes up? You can see the live pictures there, that wakes up to the deficits coming in, that maybe bullies this, that we see higher interest costs that have real ramifications. At what point does that really start to filter through?
So I think we got that warning towards the end of April and early May already, right? So I do think that the US government is on watch, they're attuned to this, so they want to make sure that relative to growth, and that's the key picture there, it's not about debt servicing on an outright basis, it's relative to growth. So I think it's not about the bill per se right now. The US needs to show that it can still grow its way relative to the debt. If we start to see, let's say, stagflation issues, and we've been here in the UK before, where the bond market has certainly faced more struggles, based on our data, I think that's when I think investors will start to revisit that. So I think right now it's imperative for the US economy, private and public sector, to take advantage of moderate borrowing costs, moderating inflation, to really drive that growth, drive that productivity that Governor Bailey was talking about this morning. So if we don't see the earnings growth, the household spending, and the productivity growth, real income growth, then I think that's where you will see asset allocation start to rotate elsewhere.
Well, to that point, Jeff, maybe it's bad for bonds, but is it bad for equities? Because we will be getting stimulus from this bill. Is it enough to kind of supplant and get that growth engine going that alleviates some of the concern?
So I think it really depends on the sectoral, breakdown. Right now, of course, we always talk about tech. People talk about that being like a secular growth trend, investment trend, as long as an investment growth trend, as long as global investors heading into AI, heading into these sectors is there, then maybe it's a bit more immune to what the government does. But I think it's the household, it's consumption. US ultimately is less of a trade, manufacturing dominated economy, something the president's trying to change, of course, but more of a services-based economy. If that starts to wane, then maybe on the equity side we will revisit that. But for now, let's face it, the data is not showing any sign of that. But again, in terms of US equities, especially for international investors, they don't have alternatives out there. China this morning was talking about the need for prices to actually go up, to stop this cutthroat competition, which is depressing prices. So I think that is holding up US equities as well, lack of alternatives.
All right, Jeff, really wonderful to get your thoughts this morning. Thank you so much for joining us. That is BNY's Jeffrey Yu. And don't miss our live coverage at the ECB Forum in Sintra. So much at stake. Bloomberg's Francine Lockwell will be moderating a panel with President Lagarde, Chair Powell, Governors Bailey, Ueda, and Rhee at 9:30 a.m. Eastern. Just want to recap the latest data we got out of Europe just moments ago. Prelim June consumer CPI rising 2%, in line with estimates for the core. Year over year was 2.3, helping to solidify we're past June, it's July, a September rate cut from the ECB. We're looking at the dollar trading at the weakest versus the euro since September 2021 at 118. Let's get you some other top stories now trending on the terminal this morning. Standard Chartered facing a $2.7 billion lawsuit linked to the 1MDB scandal. Liquidators for Malaysia's sovereign wealth fund alleged that the bank enabled laundering of billions of dollars. Standard Chartered rejected the claims, adding that it cooperated with investigating authorities. Cybersecurity woes are plaguing the U.S. Treasury Department. A Bloomberg investigation found that in a trio of hacks, the Treasury did not deploy cybersecurity measures that could have prevented the attack or flagged the intruders sooner. The findings raise questions about the department's ability to protect sensitive data. Meanwhile, tenants in New York City's rent-stabilized apartments will face a fourth straight year of price hikes. The city's Rent Guidelines Board has approved a 3% rate increase for one-year leases. Tenant advocates argue that the hike will worsen the rent burden. Landlords say the increase, it's too small. Coming up, polling an all-nighter. Senate Republicans face tight margins to get the votes that they need on the one big, beautiful bill. More on that coming up next on your Bloomberg Brief.
flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that not enough guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg. It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We are risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like.
Secretary Scott Bessent speaking to Bloomberg's Sonali Basak yesterday, and senators are still voting on that $3.3 trillion tax and spending bill. We're looking live at Capitol Hill as senators there pull an all-nighter to try to get the votes that they need. Joining us also from Washington, D.C. is Bloomberg's Tyler Kendall. Tyler, how likely does it look done that the senators can get this vote through in the early hours of this morning?
Yeah, hey, Danny, good morning. Well, they would certainly like to because they've been there since 9 a.m. Eastern yesterday. But the thing is, Senate Majority Leader John Thune at the moment still does not have the votes. And we're still watching closely the same 8 Republican holdouts that we've been discussing at this point for weeks. And the issue is that they broadly do agree about the core tenets of this bill, particularly when it comes to the tax cuts, but there are deep divisions when it comes to the spending cuts. And that really is dividing Republicans at the moment as they try to find a way to push this forward. We should also say that our reporting indicates President Trump is starting to get heavily involved in the negotiations. An administration official does tell us that he has been in constant contact with lawmakers on the Hill. I can say that they have gotten some work done overnight. There were 2 key provisions that we were closely watching. Both of them failed or were stripped out of the bill. One of them would have lifted taxes on the wealthy and would have instead used that money for a rural hospital fund. That was seen as a way to get some moderates on board. That provision failed. And another stripped a provision that would have prevented U.S. states from regulating artificial intelligence. We were watching that because that was actually a priority for the tech sector, and they're likely disappointed with the outcome there. Danny, 2 things to keep your eyes on going forward. There is one provision that could curb Medicaid even further by rolling back the expansion under the Affordable Care Act. That could get some fiscal hawks on board. It's likely not going to pass according to our analysis at this moment. But the second one, this one really could be the pivotal one that could shape this entire morning. It is an amendment that would ease some of the rolling back of those clean energy tax credits when it comes to wind and solar in particular, giving a little bit more of a lenient timeline when it comes to the phase out. That could ultimately be enough to get some of these moderates on board because at the moment, Danny, Senate Majority Leader John Thune has already lost 2 votes. He can only afford to lose 1 more.
So assuming that this does get done, Tyler, then it goes back to the House. Are we set up for a collision course in the other chamber?
It looks like we likely are, even though we have heard from House Speaker Mike Johnson all throughout the night that he is urging his counterparts in the Senate not to change this language too much. And really the group that we're going to be watching are the fiscal hawks, because it does appear that the more moderate members, for example, the so-called SALT caucus members, are pretty happy with their compromise to keep that cap at $40,000 just under a shorter duration, 5 years, instead of the 10 years that was in the House plan. So watch closely those House Freedom Caucus members like Chip Roy for example, who hasn't been afraid to lift his voice before and try to put some sort of urging on this administration. At the end of the day, we do likely think that this could get passed with how the Senate is pushing for more deeper spending cuts, but it might mean that the administration makes some sort of other concessions for either other legislation or executive orders down the line that would either curb spending or be a larger revenue raiser to address the national debt.
Tyler, thank you so much for that. And we'll catch up with you later on in the hour with any updates. That is Bloomberg's Tyler Kendall. So that is a deadline coming, a self-imposed one, be it July 4th. Then July 9th, we get the deadline for reciprocal tariffs. Now, on that, the EU reportedly is willing to accept a trade arrangement with the U.S. that includes a 10% universal tariff. In exchange, the bloc wants lower rates on key sectors like pharma and semiconductors. Our team coverage starts right now. Joining us is Bloomberg's Oliver Crook and Brendan Murray. Oliver, let me start with you on this point of Europe. What are the Europeans asking for? How likely does it seem that the Trump administration will agree to it?
Yeah, well, it sounds like the Europeans are sort of coming to this realization that that 10% tariff is not something that's going to move, which is probably arguably something they should have realized a little bit earlier. I think it's been fairly clear from the outset that that minimum 10% tariff was not something that was really negotiable. We had Emmanuel Macron and some others who were really trying to negotiate for that 0 for 0. It seems that they have finally accepted the reality that that is not going to change. In the European mind, that means an unbalanced trade deal, and it's an unbalance apparently they are willing to accept. And in exchange for that, Danny, what they would like is they would like to see a lowering of the steel and aluminum tariffs, which you know are now at about 50%. Also with the auto tariffs that are about 25%. That could be done either potentially through quotas or some other arrangements that kind of brings down the net figure. But what they also need, Danny, is some certainty on what the next trade regime looks like on the pharmaceutical sector, on semiconductors, on aircraft. Those are the three key sectors for the Europeans. And we know from the Trump administration, they are currently still investigating the questions around that. So you can't really strike a deal and it's only partial. It's like paying, a down payment on something and you don't know what the final price is. That's precisely the situation that the Europeans want to avoid, and they need to avoid it pretty quickly because the deadline is about 8 days away when that 50% tariff would come in between the United States and the European Union on July the 9th.
To that point, Oliver, have the Europeans heard from the Trump administration? Is there a willingness to talk about this?
We do not know the answer to that question at this stage. I think that it is a pretty bad sign that we don't have any of the contours of that conversation so close to the deadline. For example, we talked about the digital tax over in Canada. They sort of pulled that away. There are a number of European countries that have digital taxes. Is that something that is going to be part of the negotiations? We've heard the Trump administration talk about a lot of other non-tariff barriers, VAT, for example. These are all things that have not really been fully figured out as far as we can tell, and we're, just a couple of days away. I suspect, Danny, that by the time we reach July 9th, we're not going to have the full deal. It might get kicked a bit down the road.
Well, Brendan, trade negotiations are happening elsewhere, too. It seems like Japan, even though it was one of the early out of the gate, and the Trump administration had early on said, if you were one of the first to negotiate with us and not apply reciprocal tariffs, we'll work with you. But they seem to be at a loggerheads. What is the latest between those talks?
Yeah, exactly. It was just a couple weeks ago that the Trump administration officials were saying Japan was close to the front of the line for its trade deal. But now it looks like it's kind of falling back in that line. And whether they can bring it over the finish line is a real question now, given the tone of the rhetoric that we're seeing between President Trump and Japanese officials. President Trump posted on True Social that he was not happy about the American rice exports that can't penetrate the Japanese market. So obviously agriculture is a big sticking point. The real issue between the U.S. and Japan is cars. Most of the U.S. trade deficit with Japan is involved in cars, and Trump wants to see more of that production reshored. Japanese officials would argue that Honda and Toyota already produce a lot of vehicles in the U.S. and that they have invested billions and tens of billions of dollars in auto manufacturing in the U.S. So we're coming down to crunch time. Japan faces these lower house elections in a couple weeks. They're kind of dragging their feet, blaming the elections and the political pressure that would come with those, and they're not looking to give too much if you listen to the tone from President Trump.
Crunch time for all. Brendan, just quickly, does it seem like we're about to enter a period of a flurry of deals, or is it can kicking?
Yeah, exactly. I think there's going to be a lot of officials, including Europeans, in Washington between now and the end of the week. Of course, it's a holiday-shortened week. Then you have a couple days next week where this could spill into. So I think we're going to see the best final offers put on the table from all of these countries that we think are close, from Japan to South Korea to Taiwan to Switzerland to the European Union. All of these are going to come to the White House, to the Oval Office, on the president's desk, and he's either going to sign them or he's going to kick them back and say, no, here's your reciprocal tariff, or maybe we'll delay for a while and negotiate a little longer.
Brendan, Oliver, thank you so much for your coverage this morning. That is Bloomberg's Oliver Crook and Brendan Murray. Coming up, we're going to take a look at the biggest headlines around the world, including a robotic milestone for Amazon. We'll have your front pages next. You're watching Bloomberg Brief.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment. And it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
You're watching Bloomberg Brief. I'm Danny Berger in New York. Let's take a look at the front pages and what the major publications are running with for their headlines. First up in the Wall Street Journal, Amazon approaching a new milestone. It will have as many robots as humans in its warehouses, deploying more than 1 million robots. Around 75% of Amazon's current global deliveries are assisted in some way by robotics. Next up, a Bloomberg exclusive. Apple is weighing using outside AI tech to power Siri. Sources say Apple is considering using tech from Anthropic or OpenAI. The option would sideline its in-house model. And the New York Times leading with California rolling back its landmark environmental legislation. Governor Gavin Newsom signed 2 bills that scaled back the 50-year-old law, which had been blamed for blocking development and exacerbating the state's housing shortage. Newsom had threatened to reject the state budget unless lawmakers rolled back the California Environmental Quality Act. Coming up, the dollar posts its weakest first half of the year since the 70s as treasuries and equities rally. We're going to discuss these markets with JP Morgan's Kelsey Barrow. That's coming up next. Stay with us on your brief.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook, take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. There has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it. And so far, we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
Middle East and Africa. Vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
It's 5:30 a.m. in New York City. Good morning. I'm Danny Berger with your Bloomberg Brief. Here's what you need to know. The Vote-A-Rama continues. Senators poll an all-nighter on the $3.3 trillion tax and spending bill. 8 days until the trade deadline, the EU pushes to negotiate while President Trump threatens to up tariffs on Japan. And an all-star lineup in Portugal. Powell, Lagarde, Ueda, Bailey, and Ria all set to speak at the ECB forum in Sintra. An all-time high on this equity market yesterday, falling an all-time high the day before. 3 consecutive gains, though, takes a breather this morning with futures lower by about 0.2%, a little bit more for the NASDAQ, about 1/3 of 1%. When it comes to this Treasury market, though, the rally continues. It was the best quarter for Treasuries since February, the best first half of the year in 5 years. We're down a basis point in 2-year yields. 10-year yields down by 3 basis points, just over 419. Let's look at some of the individual stocks moving this morning. Here with that is Joe Easton. Hey, Joe.
Hey, Danny. So I've got significant weakness in Tesla in the pre-market today. We're down 4.8% at the moment, heading close to down 5%, underperforming the rest of the Mag 7. This because the squabbling between Musk and Trump continues. Trump writing on social media that Musk has had more subsidies than any human in history, and that is hitting Tesla's shares today. He's given some pretty mean comments online towards the owner of Tesla, and therefore that is weaker in the market. Then we've got a couple of crypto-linked stocks. Firstly, Circle Holdings. This one we've had on the radar for a while. One of the big performers of the year, in fact, and actually getting an added boost as the company now looking to get potentially a banking charter, so moving further into the banking space. And we had a big gain in that stock yesterday, extending it today as well, up another 1.8%. Then finally, Robinhood, this one looking pretty strong as well. The company is going to start tokenizing equities on the blockchain, so people in other countries are going to be able to go onto the blockchain, buy other assets, including stocks, via Robinhood. A lot of excitement around that, a lot of excitement around the blockchain link. Robinhood up 3% heading towards the open of trading, Danny.
Joe, really appreciate it. Joe Easton there. Now, elsewhere in the world of real currencies, so away from crypto, not that it's not a real currency, the U.S. dollar saw its weakest first half of the year judged by the DXY since 1973. JP Morgan's Kelsey Burrow weighs in, writing, quote, "We differentiate between sell America and continued U.S. dollar weakness. Foreign demand and participation in the U.S. bond market remains robust, but FX flows suggest more foreign investors are hedging their currency risk back to their local market." Joining us now is Kelsey Burrow, fixed income portfolio manager at JP Morgan Asset Management. Sorry, Kelsey, I just realized I'd probably get a bunch of angry people writing me in being like, crypto is a real thing. So I had to start there. I think this is a really interesting distinction, though, because from the damage we saw after the April tariff day, you saw stocks bounce back at all-time highs, treasuries come back to a really strong quarter, but the dollar has perennially been under pressure. So to what degree is that a persistence of sell America versus something different?
Yeah, so I think we do have to differentiate between the currency moves and the underlying assets. And the demand for underlying fixed income has remained very strong so far year to date, despite all the fears of sell America. Whether it be looking at the Treasury auction data, end user demand across the curve, pretty much in every maturity point, with the exception of the 20-year, is stronger now than it was before April 2nd. You look at the credit market, also demand remains robust. Part of that is because we have the most liquid, deep markets. There's limited alternatives. But part of it is also because there's still a lot of opportunity and there's also a lot of income. One of the reasons why returns in bond markets are so strong in the first half of the year is not necessarily because of a lot of a capital appreciation. It's because you've been able to collect carry and there is high starting yields in fixed income again.
There was this narrative, though, that after April was just that the volatility in itself would scare some international players off. Bloomberg, though, did have an interview this morning in Asia with one of the Korean sovereign wealth funds, basically saying we're still buying treasuries and the volatility didn't scare us off. Why hasn't the volatility been an issue?
Right. Well, I think they're still buying treasuries, but here's what has changed, or what we're looking to change over time, which is how much of the FX risks are they hedging back? So what we're looking at are non-U.S. pension funds and the percent of their portfolio they hedge back into local currency. And even now, as you are starting to see more interest to hedge back the dollar risk, so to take less outright U.S. dollar exposure, hedge ratios are still below 10-year averages for most of these non-U.S. large pension funds that we follow. So this trend of strong fundamental demand for U.S. fixed income but weak U.S. dollar can continue.
It is interesting because as equities have rallied, treasuries have rallied, and it feels like that correlation has gone back positive. But the correlation hasn't been positive with gold. As equities have rallied, gold has kind of been flat. Is there a change where gold has really taken the place of treasuries as the diversifier for risk assets in a portfolio?
I'm not so certain. I mean, I think that there has certainly been interest in gold this year. And it's one of the pieces of a diversified portfolio, but it doesn't replace your core fixed income in your portfolio. It doesn't have any income. It isn't linked to any underlying activity or asset. I think what we're more focused on are some of the other parts of the commodities markets, which have bigger impulses for things like inflation, for example. So one of the challenges with the bond market is always inflation, right? And just a few weeks ago, we were concerned about the Middle East and the possibility of seeing $100 oil again. But when you look at the supply-demand balance within the oil market, it says actually the risks are balanced to the downside. We have seen, outside of the tariff impact of inflation, which we do expect to see, a fairly benign inflation backdrop. Again, good for holding income and holding carry in portfolios.
Is there a risk that the deficit upsets all of this, that you get more spending out of DC, you get higher costs on interest, you get financial repression, high inflation, something like that? Is there a real risk, Kelsey, that something like that comes to fruition and the market actually reacts to it? Because the vote-a-rama is happening in DC tonight, and this is a bond market that feels quite unbothered.
Yeah, I think it's unbothered because we've had a number of weeks and actually months to prepare for this. So I would say, yes, the deficit is influencing the bond market. It's influencing the steepness of the curve. It's influencing how high long and real yields are. But I would say probably the majority of that shock factor has already been priced in. And I think you would need to see a significant surprise in terms of what the ultimate bill that passes through the Senate and then goes back to the House and hopefully gets through the House to really get the market surprised. Normally what happens is when the data is good, everybody cares about the deficit because the data is good, there's nothing to worry about. When the data starts to roll over, the deficit goes out the window and the market focuses on the fundamentals. And so this week, I would say it's really more about the labor market data that we're getting on Friday. That's what I think is going to be the major driver of the bond market, and particularly Treasury yields.
Well, we'll get the labor market data on Friday. We'll also get CPI later in July, too. We also have, again, this big, beautiful bill deadline. We have the trade deadline. When you look at the risks that are facing us in July, it is a lot. Is it a kind of market you want to be defensively postured because of the risks ahead?
Well, I think you want to balance continuing to have high quality carry in your portfolio. So owning credit, investment grade credit, owning securitized credit, having some high yield in the areas where, you're comfortable with. But also there's probably some advantage of having some intermediate duration in your portfolio as a hedge against some of the risks. Particularly, I think the risks of a slowdown, a greater slowdown in the labor market, which pushes the Fed or pushes the market to price in a more aggressive Fed.
All right, Kelsey, a lot to chew over the next couple of weeks, and it's in the summer when we're all supposed to be relaxing, so lucky us. Kelsey, thank you so much for joining. That's Kelsey Barrow of JP Morgan Asset Management. And by the way, speaking of central banks, don't miss our live coverage of the ECB forum in Sintra. Bloomberg's Francine Lockwell will be moderating a panel with President Lagarde, Chair Powell, and Governors Bailey and Ueda and Rhee at 9:30 a.m. Eastern. All right, let's quickly get you some top stories trending on the terminal this morning. Standard Chartered facing a $2.7 billion lawsuit linked to the 1MDB scandal. Liquidators for Malaysia's sovereign wealth fund alleged the bank enabled the laundering of billions of dollars. Standard Chartered rejected the claims, adding that it cooperated with investigating authorities. Cybersecurity woes plaguing the U.S. Treasury Department. A Bloomberg investigation found that in a trio of hacks, the Treasury did not deploy cybersecurity measures that could have prevented the attacks or flagged it sooner. The findings raise questions about the department's ability to protect sensitive data. Meanwhile, tenants in New York City's rent-stabilized apartments will face a fourth straight year of price hikes. The city's Rent Guidelines Board has approved a 3% rate increase for one-year leases. Tenant advocates argue that the hikes will worsen the rent burden. Landlords say the increase is too small. Coming up, we'll bring you to our Bloomberg scoop on how Apple is looking outwards to try to stay ahead in the AI race. That's coming up next. Stay with us. This is Bloomberg.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest every trading day, only on Bloomberg.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing.
First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like.
Treasury Secretary Scott Bessent optimistic as ever on getting a bill passed, and Senate Republican leaders are still scrounging around for votes to pass President Trump's $3.3 trillion tax bill. Voting started at 9 a.m. yesterday, and yes, you're looking at frozen-ish but live pictures of Capitol Hill with the votes still ongoing. And also up in the early hours from Washington, D.C. is Bloomberg's Tyler Kendall, who's back with us. Tyler, does this vote look like it's headed to success for the Senate Republicans?
Yeah, hey, Danny. At this point, it's a little too early to say because Senate Majority Leader John Thune still does not have the votes to get this over the finish line. And when we look at the math, he can only afford to lose 3 Republicans before he has to call in Vice President J.D. Vance to cast that tie-breaking vote. And we already know of 2 likely no's. One is Senator Tom Tillis, a Republican from North Carolina, who has raised concerns about what changes to Medicaid, as well as the rollback of clean energy tax credits could mean to constituents in his states. And the other is Senator Rand Paul of Kentucky, who won't vote for any legislation that lifts the debt ceiling and wants to see deeper spending cuts. And that division really illustrates what Leader Thune is dealing with at the moment. He has pretty broad support when it comes to the main priorities of this package, including extending the 2017 tax cuts. But importantly, there's really deep divisions when it does come to those spending cuts. Now, I pointed this out earlier on the program, but there's one amendment in particular that we are closely tracking. It has yet to come up, but it would see a more lenient timeline when it comes to the phase out of clean energy tax credits related to wind and solar. And that really might be enough to get enough moderate Republicans on board. But at the it's a little too soon to say because John Thune is still trying to make some of these backroom deals in order to get enough Republicans to get this bill over the finish line.
Well, some of those clean energy phase outs might have invoked the ire of Elon Musk. And we've seen a real clear spat between him and President Trump on X. Most recently, Trump writing on Truth Social that Musk may get more subsidies than any human being in history so far, and that Elon would probably have to close up shop and head back to South Africa without subsidies. Tyler, is this just palace intrigue, or could this have real ramifications?
Well, I think it's probably a little bit of both. One, this is starting to veer into the personal again with President Trump also appearing to threaten in his post on Truth Social that there should be some sort of investigation because Elon Musk has benefited from government subsidies. He also said that he made clear to Musk when they started working together that he had long been against the tax credits under the Inflation Reduction Act, which we know was considered to be a main policy priority for the Biden administration. But when we actually look at some of the tangible ramifications here, we did get one indication that the money really is starting to flow from both sides. President Trump has threatened to primary Thomas Massie, a Republican from Kentucky in the House, who has said that he will not vote for this bill. And he actually did make good on that promise. The political arm of his campaign operation launched a super PAC against Thomas Massie. But then we had Elon Musk yesterday confirming that he donated to Thomas Massie's campaign, really putting their money where they're saying that they would. And that's going to be a really interesting dynamic to watch if we see money flooding in from both sides. Because, Danny, keep in mind, Elon Musk contributed more than $290 million during the 2024 cycle to both the White House race, but also to congressional races, which made him the largest U.S. political donor during the cycle.
Money going into various campaigns, going out of Tesla shares this morning. Tyler, can we just wrap it up? Because we also have this July 9th deadline coming for trade. Does it seem like there has been progress? Will we get a flurry of deals or just more can kicking?
Well, if you ask the administration, they keep pointing us to the fact that they need to get this legislation over the finish line by July 4th, and then we could expect some trade deals to come after that. And they are telling us to be prepared for framework deals before July 9th. Of course, these wouldn't be fully fleshed out deals, as you well know. These would really be frameworks and perhaps give us some sort of insight into what commitments would look like down the road. Now, a person familiar does tell Bloomberg News that it appears that we are nearing a trade pacts with some of those economies in Asia that we know have been prioritized because they are geographically close to China, including Taiwan and Indonesia. A person familiar also adds that we could be approaching some sort of pact when it comes to Vietnam and South Korea. But Danny, as you well know, we have been getting an update for one of those trading allies that doesn't appear to be on the right track when it comes to President Trump's expectations for trade negotiations, and that is Japan. President Trump is threatening to send a letter setting an effective tariff rate for the country, as it appears that negotiations are going a little bit off the rails there.
Tyler, thank you so much for your coverage this morning. We really appreciate it. A long day ahead for you, I am sure. Tyler Kendall in Washington. Now let's get you to a Bloomberg scoop. Apple is considering using AI tech from Anthropic or OpenAI to power a new version of Siri. It's a move that would sideline its own in-house models as it looks to turn around its flailing AI effort. Joining us with the latest on that scoop is Bloomberg Tech Europe anchor Tom McKenzie. Tom, it was a story that seemed to spur Apple gains late in the day yesterday. So is this success for Apple, or is it admitting defeat?
Yeah, the Mark Gurman scoop, of course, on this story, suggesting that Apple is now working and has been working with Anthropic and OpenAI in terms of whether or not they integrate these large language models, these foundation models from both companies, one or the other, into their products, and specifically into Siri, which they expect and hope to launch in the spring of next year. Is it good news for Apple? On one level, this is a seismic turnaround for a company that, of course, famously likes to hone the whole tech stack. And if it gives the foundation model priorities over to OpenAI or Anthropic, then it's giving up, arguably, that key piece of that tech stack when it comes to AI. There is a debate within Apple as to whether or not to go ahead with this, but we know both Anthropic and OpenAI have been asked to train their models on Apple's own cloud infrastructure. There is a clear gap here, and this is the acknowledgement from Apple. There is a gap in terms of the catch-up that is needed with Android phones and the AI assistants that are already embedded on those phones, and what is needed with Siri and the assistant there on Apple phones. There is a key gap. They haven't managed to close it with their own Apple foundation model. Now they're looking at alternatives. It's created divisions within Apple, but they will hope, of course, those proponents of this measure, they will hope that this will allow them to embed technology that allows that catch-up to happen and happen quickly. Haven't yet fully decided on this. The debate continues, but it is being taken very seriously.
Tom, elsewhere, it just seems like a market that is happy and maybe welcomes a lot of spending when it comes to AI. We also learned that Zuckerberg has been debuting or has debuted his Meta Super Intelligence Group. What do we know?
Yeah, so all of their AI efforts at Meta now will come under this group, the Meta, as you say, Meta Superintelligence Labs, or MSL. It will be headed up by Alexander Wang, formerly the CEO of Scale AI, that Meta invested a little over $14 billion in. So Alexander Wang being propelled to the top of the AI efforts. Under this lab then, under this unit, this specialized AI unit, will sit research, will sit large language models, will sit AI products, all of that coming under that remit. Mark Zuckerberg saying this could be the greatest transformation for humanity. Superintelligence, intelligent AI that is as capable or more capable than humans. He's been going out there looking for that talent, signing checks of $10 million to $100 million for talent from OpenAI, from Anthropic, from Google DeepMind, to try and embed them into Meta's efforts. There's a catch-up story here as well for Meta, because Mark Zuckerberg hasn't been pleased with their latest models and the fact that they haven't achieved some of the technical achievements and metrics that he was hoping for. This is a significant reminder that Meta and Mark Zuckerberg specifically is all in on this bet around superintelligence.
Such fascinating developments with so much money behind it. Tom, thank you so much. Bloomberg Tech Europe anchor Tom McKenzie. Coming up, we're going to set you up for your trading day. We have economic data and a lot of central bank talk. We'll have the latest for you and what you need to pay attention to. This is Bloomberg.
Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Anand, only on Bloomberg.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
You're watching Bloomberg Brief on this Tuesday morning. I'm Danny Berger in New York. Let's get you set up for this trading day. We're going to have a panel discussion with Chair Powell, Presidents Lagarde, Governors Ueda, Bailey, and Rhee. All of that coming from the ECB forum in Sintra, 9:30 a.m. Eastern. conversation you don't want to miss. We're also going to get PMI data. That comes out at 9:45 and 10 a.m. Plus JOLTS, those numbers come out at 10 a.m. All right, some individual stocks on the move. Tesla, one of the big ones to the downside this morning. President Trump threatened on Truth Social to withdraw government subsidies from Musk's companies, with Musk criticizing the tax bill. Those shares down to 4.6%. Wynn Resorts, those are up nearly 3%. It's higher alongside Las Vegas Sands and Macau casino revenue for the month of June rose 19%, way above the estimate that was just over 9. Both the firms have about half of the revenue exposure to Macau. Meanwhile, Robinhood, that's also extending gains at a double-digit closing price yesterday. The firm is tokenizing U.S. securities available to customers in 30 countries, 24 hours a day, 5 days a week. So congrats, you can trade literally whenever you want. Maybe you want to trade this morning. Let's take a look at the euro strengthening more against the dollar near the highs of the day, and it is the strongest versus the dollar since September of 2021. We got European area CPI data in. It was in line 2%, allowing the ECB likely to cut in September, whereas we're unsure whether we'll get that from the Fed. It was the worst first half for DXY since 1973, despite all-time highs for equity markets. Equities, though, slightly taking a breather this morning. All right, that's it for your Bloomberg Brief. Surveillance takes things from here, and you're watching Bloomberg.
Was it easy to get the pandas to come back to Washington, D.C.? Did the Chinese say, we have some extra pandas, we don't know what to do with them, we're going to give them to you?
Well, it was a little more difficult than that. It probably took us, it was about over the course of a year where we had conversations with our colleagues in China, and we were able to get pandas here very quickly. I think it's a testament to the relationship we've built over decades, to the conservation success that we've had, here with our pandas and our panda program. And so it was a lot of conversations, but I think we always knew in the end that we did want pandas at the National Zoo.
How many pandas are there in the entire world?
So this is incredible because this is all due to this panda program, and this is so important. So when we started with giant pandas 50 years ago, there were fewer than 1,000 pandas in the world, right? We're talking in the wild and zoos, fewer than 1,000. And decades later, there are close to 2,000 pandas in the wild now. Actually, I think a little over 1,800. There are over 700 pandas in breeding centers. So as part of this program, we have tripled the number of pandas on the planet.
But still a small number of pandas.
Because of this program, there are more pandas on the planet, more quality panda habitat in the wild, and pandas have gone from being endangered to being vulnerable.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
what started out as just a relief rally is starting to become something real.
Institutional risk sentiment has improved so much that people are willing to put money to work.
The risk in stocks are a little higher today than they were in April.
All the negative things which could happen have dissipated, at least for the time being.
Does it really make sense for equities to be hitting new record highs? I think so. I think that is a pain trade.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Tuesday, the policy volatility continues. Senate Republicans pulling an all-nighter, looking for votes on a major tax bill, as President Donald Trump faces off with Elon Musk over EV subsidies, and the European Union is preparing to accept a universal 10% tariff. It's goodbye Q2, hello Q3. It's a new quarter. It's the same story.
It's the same story of policy uncertainty that seems to be the presiding sentiment and the presiding theme over 2025. We will get clarity in 2 weeks. That is always what happens. Maybe it's going to be 2 months. The real question that I have is, how much have the changes in valuations reset the game? And I'm talking about the dollar that just had its worst half since 1973. I'm talking about stocks that continue to grind higher with people still saying the pain trade is up, given the fact that this policy uncertainty has still not fully been priced in or internalized.
The President of the United States taking on Elon Musk, taking on Chairman Powell, and taking on Republican holdouts staying up all night in the Senate.
There's a number of holdouts right now, and this is what you see Senate Majority Leader John Thune basically going in and out of his office with different individuals trying to see if he can get them to yes. This is a long slog. He continues to say we're close, but he's been saying we're close for the past 5 hours or so, so we're not just that close yet. There's two people I'm watching. One, Senator Ron Paul. Everyone thinks that he's a no, but potentially, if they bring the debt ceiling money down to lift the debt ceiling from $5 trillion to something more like $500 billion, he might be able to go for a yes. And then Senator Murkowski from Alaska, she wants to see a carve out for her state when it comes to Medicaid. If they're able to get acceptable language for the parliamentarian and get a yes on that, she could be a yes to the final bill. He needs one of these two, and these are the two I'm watching this morning.
Tyler Kendall down in Capitol Hill. Tyler's going to join us in just a moment. Also monitoring what's happening in foreign exchange. Lisa talked about the weakness on the US dollar. Need to talk about the strength for the euro. Euro dollar, 118.15, and earlier on this morning, waking up to just a little bit of pushback from the ECB.
Saying that if the level gets above 120, that becomes a problem. Below that, it's okay. Well, we're getting toward that. We've had 8 straight sessions of strengthening of the euro versus the dollar. If today is the 9th, that is going to be the longest streak going back to 2004. Luis de Guindos was the one who came out and really pushed back against this. At the same time, it potentially lowers their inflation. It just also lowers the impulse to tour over to Europe. So I wonder how much this is a tourism issue rather than simply just a currency appreciation.
And exports and trade and all of that, and the disinflation rate. We'll get into it later. Euro dollar 118.13. That's the price action of this morning. Coming up this hour, we'll catch up with Julian Emanuel of Evercore as stocks post the best quarter in more than a year. We'll speak to the former NEC Deputy Director Everett Eisenstadt as the White House says trade deals are looming, and Eric Nelson of Wells Fargo on the dollar's weakest start to the year in half a century. We begin this hour with our top story, an all-night voting session underway on Capitol Hill as the Senate debates President Trump's tax bill. Joining us now is Tyler Kendall from Washington with the latest. Good morning, Tyler.
Yeah, hey, John, good morning to you, but probably not a good morning if you are a U.S. Senator, because they have been in the middle of this vote-a-rama since 9 a.m. Eastern yesterday, because Senate Majority Leader John Thune still does not have the votes to pass this package. And importantly, at the moment, he's trying to work out some of these key deals to get Republicans on board, because they are broadly aligned when it comes to the key pillars of this package, like the tax cuts, but they remain really divided when it comes to those spending cuts. And we're still watching the same 8 holdout Republicans that we've been discussing for really the past few weeks, and they haven't seemed to give any indication that they are going to budge. There are 2 threads that we're watching here in Washington that I'd point you to that could kind of tell us where this morning could be headed. One is that we're seeing the White House really ramp up the pressure here. An administration official tells us that President Trump is in constant contact with lawmakers on the Hill. We're trying to track down exactly which lawmakers he's calling and what sort of deal deals the White House could be offering to get their votes over the finish line. The second I'd point you to is that there's still two key amendments that senators have yet to vote on that could change the trajectory of this legislation. One is an amendment that would roll back the expansion of Medicaid under the Affordable Care Act. It's likely not to pass, but that is considered to be a win for fiscal hawks that were pushing for this to come up to debate. A second amendment, though, does appear to be on track with some more momentum behind it because it has Democratic support, and that would be a more lenient timeline for the phase out of some of those clean energy tax credits, including solar and wind. John, that really could be one of the pivotal pieces in this puzzle to get enough moderates on board for John Thune to get it over the finish line.
Tyler, we need to talk about Elon Musk as well. They're stuck between a rock and a hard place. They've got a decision to make. Do they choose to upset one of the biggest donors to their party, or do they choose to upset the President of the United States?
One of the biggest donors to the party, exactly. He gave more than $290 million during the 2024 cycle, not just to the White House, but also to those down ballot races. And we're really starting to see the money pour in already. Take Thomas Massie, for example, a Republican from Kentucky who is a hard no on this bill on the House side. President Trump has already created a super PAC to primary him in Kentucky, really making good on his threat to put up a challenge ahead of that race. But then we got confirmation from Elon Musk yesterday that he has poured money into the race in favor of Thomas Massie. So they really are on a collision path at this point. But if they do go against President Trump, perhaps Elon Musk could be there to give some extra funds.
Tyler Kendall with the latest in Washington. Tyler, stay close. More from Tyler through the hour. As the voting continues in Washington, D.C., tracking the latest move in Tesla in the pre-market down by 4.5%. Here's the view on Wall Street this morning. Julian Emanuel of Evercore saying it's not yet the time to pile in, writing the following: a pullback is our base case, given the parabolic move already and the risks from tariffs and policy to the economy. Julian joins us now for more. Julian, good morning.
Good morning.
Should we take a beat? How does it feel, the last quarter? What was that like for you?
Look, incredible. In many respects, though, the market actually did what it was supposed to do, okay? You had this incredible surprise reaction to something where we were completely not used to what we were seeing, which was a tariff schedule, higher than Smoot-Hawley. And then you got what you actually didn't get at the bottom in October of 2022, a volatility event, an actual capitulation that really presented the buying opportunity very, very clearly. And from our point of view, the surprise is the unrelenting speed with which the market continues the advance.
Massive move, 20% plus off the lows on the S&P, 30%, something like that on the NASDAQ 100. I sit here and I wonder, looking out 12 months now, can you say with confidence the outlook for earnings is getting better or worse at this point?
It's definitely getting better, okay? Because basically what has happened is you've had this adjustment from tariffs, and now that there is this presumption that you are going to get, and we can talk about the effect on interest rates later or what have you, that you're going to get some form of stimulus that is going to be more favorable to the 2026 picture. Obviously, the 2025 picture remains in flux, and we're going to find that out in a couple of weeks when earnings season starts. But in general, the whole narrative of the economy having avoided a recession is a reasonably positive backdrop.
Let's put the one big beautiful bill on the side for 1 second and just go to the tariffs, which you mentioned are still at the highest going back to the 1930s and haven't fully been priced in yet when it comes to whether it's consumer prices, whether it's companies absorbing it in the profit margins. What makes you think this isn't going to show up in earnings in a material hit to profit margins for a significant number of companies?
Well, so the work that we've done was the expectation that roughly it'd be a 50-50 split. Larger companies will shoulder less, smaller companies will shoulder more of the tariff hit. And yes, it definitely will fall into earnings. But again, there is this presumption that it is the one-time hit and that there will be this transition period, which obviously for the market began in the spring, but we're already sort of pricing through that. And again, what it points to is the resilience of corporate America, the ability to adapt, the ability to move supply chains, and the ability to figure out what a correct pricing strategy is.
Are we putting an economic narrative to a market story, to something that really is big tech names that continue to innovate in a technological boom that is trickling out into other companies at the same time that there are these independent factors that are very real that are affecting other asset classes? And we talked about the dollar. That might be where some of the vigilantes are going, or this question of where the marginal buyer is going to be, how the market responds to negative news in the economy. How much are we making an economic argument for something that is now increasingly divorced from the economy?
Well, again, stepping back, the story of this year, and in large part for from our point of view, the reason that the advance off the April bottom has been as unrelenting as it's been is because we are now finding that corporate America is understanding how to use AI constructively across all industries, not just for cost saves, but for revenue enhancement as well. And this is something that we think is going to continue to proliferate. And when you think about it, is part of the reason, look, we're uncomfortable with where multiples are, which is why we think that you're likely to have a pullback. But on balance, it is something that supports, higher multiples ex ante than what we've seen.
A pullback when, though? Because you talk about a FOMO-driven melt-up. What if you missed that?
So, look, it could be going on right now. But from our point of view, there's enough policy uncertainty out there that I would equate this more to the sort of FOMO that we had in and around the election. Remember, a lot of froth there, led by crypto names, led by names that were tied into the Trump administration. And I think we're seeing a lot of the same thing now. But again, the actual activity supporting a more prolonged period of FOMO hasn't materialized yet. We do think you need to get, less policy uncertainty to get to that period.
What uncertainty unnerves you the most? Lisa mentioned tariffs. Right now we have this debate on the one big beautiful bill, but no one thinks it's not going to pass. It just might be an absolute slog, and it's probably not going to come on July 4th. What's the uncertainty that makes you nervous to really want to add more to your exposure?
So I think it's what the response is going to be in and around July the 9th. That's the tariff story. But again, this other idea that we're seeing the resilience on the corporate earnings front, but if you go back to last Friday, it was really the first indication, with the inflation numbers higher than expected and the income and spending numbers weaker than expected, GDP revised down, that yes, in fact, this theorized pass-through from tariffs might actually, in fact, be hitting.
What's the best outcome for July 9th? Asked this question yesterday. Is it extend and pretend, keep negotiating, or 10% and move on? What's the best outcome for you?
I think well, you'd like certainty. I mean, if you just went to 10 and said that's it, that would be fine. The market would embrace that. But something leads me to believe that it isn't quite going to be that simple in negotiations.
You're not alone, by the way, and I think this is interesting that the market is just sort of happy, and I think was happy several months ago with the idea of a 10% universal tariff, move on to other things.
Then companies can actually price it in. They can rearrange the supply chains. And like Julian said, the adapt and adjust, which you see in so many different companies, is what we've already seen with respect to half being absorbed by them, a little being absorbed by them, and maybe just a small marginal one-time price increase.
And to your point, Jonathan, the market was happy. I was there. It was rallying when the president got up in the Rose Garden and said, here's a 10% across-the-board tariff. It only started to crater when they came out with the massive billboard of the reciprocal tariff rates that were extortion for some countries.
Anchored us all to the extreme, and now we're happy with 10%. And apparently even the EU is now happy with a 10% universal tariff.
With carve-outs, in fairness.
I mean, sure, whatever.
But that's not what we're going to get, because we also have sectoral tariffs. Then you've got countries that are waiting for the 232 investigations to continue.
These countries aren't arguing about the 10% universal tariff. They're not even debating it with the US at all.
Which goes to the question of, if you anchor to the extreme, Is that the way to get people to all accept something that would have been extreme?
It's
say,
a
6 months
massive
ago?
U-turn to when I was in the Netherlands last week, and they said they would not accept a 10% across-the-board tariff. Now, a week later, okay, fine, we'll accept 10%, but we need some help on steel and autos.
Ollie Crook's going to join us a little bit later in the programme to get you the latest from Europe. Big changes on the trade front still expected. Equity futures at the moment down by 0.2% on the S&P, with an update on stories elsewhere. With your Bloomberg Brief, here's Yahira Anand. Hey, Yahira.
Hi, John. Senate Republican leaders continue scrambling for votes to pass President Trump's $3.3 trillion tax and spending bill. They've been up all night, and as you can see in the live picture behind me, are continuing to vote on amendments to the legislation amid deep party divisions over clean energy and Medicaid cuts. 8 Republicans are holding out their votes on the bill. Meanwhile, the European Union is willing to accept President Trump's 10% universal tariff, as you guys were just talking about. Sources telling us here at Bloomberg, the EU wants the U.S. to commit to lower rates on key sectors such as pharmaceuticals, alcohol, semiconductors, and commercial aircraft. The bloc has until July 9th to reach a deal before tariffs on nearly all of its exports to the U.S. jump to 50%. And President Trump is continuing to attack Fed Chair Jay Powell, posting on Truth Social yesterday, Jerome Tule Powell and his entire board should be ashamed of themselves for allowing this to happen to the U.S. If they were doing their job properly, our country would be saving trillions of dollars in interest costs. He says we should be paying 1% interest. That's your Bloomberg Brief. John?
Yahira, thank you. More from Yahira later on in the hour. Handwritten note with all the interest rates around the world. And the United States at the wrong end of it for him.
So just to go back to your point, is this anchoring to the extreme? Like, forget 1 point.
We'll take
2
3.
We'll take 3. Maybe if we get 2, it's okay, you know? But, you know, let's start with 1% interest rates.
Julian's going to stick with us. We'll have more on fixed income and interest rates and what it means for the equity market in just a moment. Up next on the programme, the Vote-A-Rama continues.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. We're all on the same page on how to grow the economy while controlling and bringing down expenses.
Live from New York City this morning, good morning to you all. Equity futures negative on the S&P following back-to-back all-time highs.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question.
Good question.
Great question.
I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
What is going to be the consequence for U.S. markets? We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Later on this morning, 9:30 Eastern Time, a must-watch panel. Check this out. ECB President Christine Lagarde, the Chairman of the Federal Reserve, Jay Powell, the BOJ Governor, and a whole lot more coming to you live from Sintra, Portugal, the world's biggest central bankers, the biggest names on the planet in finance, their views on interest rates and what's happening with this economy following the policy shock of the last few months. In the markets right now, market couldn't care less. Equity futures just a little lower, down 0.2%, all-time highs on the S&P at the close of yesterday's session. At the close of Q2, coming into Q3 on a three-day winning streak. In the bond market, yields down last month, down on the quarter. On 2s, on 10s, on the 10-year right now, 4.1949. We're down another 3 basis points, even with the focus on Washington, D.C., and a big tax bill just moments away. Under surveillance this morning, the Vote-A-Rama continues.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like. We're all on the same page on how to grow the economy while controlling and bringing down expenses.
Here's the latest this morning. Senate Republicans pulling an all-nighter, looking for votes on the big, beautiful bill. In the bond market, no change in the face of all of this. Julian Emanuel of Evercore joins us now for more. Julian, let's continue this conversation. We aren't seeing the pushback from fixed income. We aren't seeing the high yields that so many people anticipated. In fact, yields are starting to break the other way. What's the relationship between your outlook for the equity market and what's been happening in fixed income?
No, it is definitely a mystery. There's no question about it. And it almost makes you wonder as if there might be a time where, let's say this bill passes and then we wake up and yields start moving higher by, a reasonably significant amount. But at the end of the day, if you look at it, the yields have been going sideways for 2 years, okay? Literally somewhere between 4 and 4.5 for 2 whole years. And frankly, that's perfectly fine for the equity market because, again, that removes part of the uncertainty.
Well, okay, they've stayed the same, but the backdrop has been very different economically. People went from a very high benchmark interest rate understanding of the world that was high inflation to one that now, if you put all of the other potential tariffs and other disruptions out of the picture, we would be looking at pretty much close to 2% inflation rate. We're looking at basically mission accomplished. So is this highlighting a new premium that will ultimately challenge U.S. valuations and risk markets in a way that has not fully been appreciated?
Well, there's certainly an element to that. However, the countervail to that is that we are likely to get a new Fed chairman sometime next year that is going to be, let's say, a little bit more accommodating in terms of bringing interest rates down.
Let's say that they're accommodating and taking Sharpie messages of the world's interest rates and saying, okay, we'll cut 3 percentage points in this meeting, regardless of what happens. What happens to the long end in that situation?
You will get a yield curve steepening, the likes of which most investors do not remember that 20 years ago and so on, 2s, 10s was more in the neighborhood of 150 over rather than 50 over, a very rapid steepening. And frankly, when we think about what the risks to the equity market are, 10-year yields going through 5%, far and away at this point, are the most significant risk.
When can that happen?
Again, the psychology right now is telling you it doesn't seem likely, because as John pointed out, counter to expectations, in really the same way the dollar weakness is counter to the expectations of people that thought tariffs would be bullish to the dollar. It really just takes a turnaround in psychology that we don't see. But I would suggest that if the inflation data continues to firm, at the same time, we get more sort of pushback on the direction of tariffs. That's the mix that sends
the dollar move, I think, Julian, speaks to exactly the risks you describe. Just go through the scenario. You face a situation where you do get a Fed chair that's, let's say, is more willing to drop interest rates regardless of what's happening elsewhere. You get the curve steepening you described. You get all the debt issued at the front end with the Federal Reserve cutting interest rates. That's precisely one of the reasons you're seeing the dollar strength that's been developing, Lisa, over the last several months.
What is the fear that this is going to be a Fed that's going to try to monetize the debt, that's going to try to essentially print money to offset this by having rates at a very low level and then just printing money at that level? And how much does it take at this point to create dollar strength, given that that fear has been embedded in the overall investor base?
Isn't the president actually arguing for that right now?
Yes.
Over the last several months?
100%.
Almost explicitly saying that he wants the Federal Reserve to drop interest rates so they can issue debt at the front end and get lower interest rates?
He's saying there is a direct connection between the Fed's rate policy and what the U.S. pays in interest payments. And then Scott Bessent came out and said, yeah, we're not going to term out the debt. We're going to focus on the front end because right now the term premium is just too great. So you put those together, and that is, to your point, explicitly calling for the Fed to help the country lower its interest payments.
In the Sharpie, black and white, you have cost the USA a fortune and continue to do so. He's talking about the net interest we are paying on our debt, which has basically toppled the entire U.S. budget higher than defense spending.
Quick final word, dollar weakness. How much of a tailwind is that for the S&P 500?
It's definitely been significant, and it has definitely contributed, among other reasons, for the large cap outperformance over small cap. In general, it tends to be a positive, but again, there's always sort of until it isn't. And I would suggest, and it's not our base case, that there are going to be issues around getting this bill passed. But if we start getting towards August, and again, not our base case,
sure,
that is where you run into problems.
There's so many reasons for dollar weakness, which I think makes the pain trade of Q3 dollar strength. That's got to be the pain trade of Q3, dollar strength. Who's positioned for that?
I couldn't agree more. I was thinking, people say that there's going to be a stimulative effect. I know Anne Marie would argue with this from the one big beautiful bill. Let's say that plays in with better than expected earnings and economic data. What does the dollar do?
Julian, it's good to see you, sir. Thanks for dropping by.
Thank you.
Julian Emanuel there of Evercore as we kick off the second half of 2025. Up next, the former NEC Deputy Director Everett Eisenstadt as the EU comes to the table for trade talks, plus your movers with Danny Berger, the latest on Tesla.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you
betting all your money in this right now?
When the OpenAI appear, immediately I asked whole corporations study how will you bring generative AI to their job.
The flood of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince, concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
Welcome to the second half, live from New York City this morning. Good morning. Your scores look like this. Equity futures negative by 0.2% on the S&P, following back-to-back all-time highs on a benchmark in the United States. We're coming into Q3 on a 3-day winning streak. On the Nasdaq 100, after a major rally off the lows of April, we're down just 0.3%. With 3 hours until the opening bell, let's get you some morning movers. Here's Danny Berger with the latest. Hey, Danny.
Hey, John. A painful pre-market session for Tesla, already down 4 1/3%. It seems that the social media spat between Elon Musk and President Trump having its ramification on these shares, the latest of which after Elon Musk slammed that spending bill, President Trump on Truth Social seemingly threatening to take away subsidies from Elon Musk's companies, hence the decline we are seeing this morning. To the upside, though, the large casino operators, that is Las Vegas Sands, Wynn, both of them really strong, up more and nearly 3.5% for the two of these. We got latest Macau numbers for those gambling revenues, up 19% for the month of June, year over year. The estimate was just 9%, and for both of these companies, about half of the revenue comes from Macau, so that's lifting the shares this morning. Finally, wrapping things up with Robinhood, after already a 13% gain in the regular session yesterday, we're looking at another 3% this morning. Robinhood announced yesterday that it's going to be tokenizing U.S. company shares, which means that if you're in 30 countries, you can trade these shares 24 hours a day for 5 days out of the week. So congrats. If you already can't sleep at night, you can also now trade equities, John.
Yeah, Danny, I hate it. Absolutely hate it. Danny, thank you. 24-hour trading. The 24/7 stuff kills me.
Well, I think it kills
Needs to
everyone.
stop. Needs to be a close, right? Need a weekend.
Well, it's good that it's actually pretty calm trading, so it's not necessarily like anything is going to happen if you go to sleep. That's what we learned in the past half.
Crypto bros just can't get enough of it, can they?
They can. They're up 30% on the Bitcoin this quarter, so, you know.
Good for them.
Yeah.
I need a break. On our radar this morning, Senate Republicans working through the night to iron out divisions over President Trump's $3.3 trillion tax bill. Senators expected to vote through the morning with 8 major holdouts remaining.
We're almost at 24 hours here when it comes to these amendments. There are really 2 individuals I'm watching right now. Potentially Ron Paul, someone who was a no. If they are able to lower the threshold for how much they're willing to spend to lift the debt ceiling, maybe he gets on board. And then Senator Lisa Murkowski, they're working on language, especially get a carve out for Alaska when it comes to Medicaid. We are seeing that Vice President J.D. Vance has walked into the Capitol. He would only be there if a vote is close, because he needs to obviously be one of those votes, because they cannot lose anyone else, because the margins are so tight. So that says to me, potentially, we're on the cusp of Majority Leader Thune getting one of those holdouts on board, and then J.D. Vance can come for the final tiebreak.
There's a bit of tension in the room at the moment, but the most interesting feud, I think, is taking place beyond Capitol Hill. It's a feud between President Donald Trump and Elon Musk, reigniting basically over EV subsidies. The president saying Musk may get more subsidy than any human being in history after Musk slammed Trump's tax bill for cutting EV credits.
Yeah, and then he went in on the fact that he's from South Africa, not a true American, and then talked about no more rocket launches, satellites, or electric car production, and our country would save a fortune. Perhaps we should have Doge take a good hard look at this. Big money to be saved. Raises a question of, A, has this feud actually ended? Because we saw a sort of uncomfortable resolution to it, but then also how vulnerable Tesla really is. And I think that the company-specific story is actually more fascinating than anything else. There was a belief that Elon Musk's closeness to the president was going to help Tesla. The reversal of that is calling into question the entire regulatory framework for robo-taxis and beyond that really had given a lot of support to these shares.
I totally agree. The stock is down by more than 4%. What's interesting, though, is the policy they're arguing over is a policy they campaigned on for months. this was the policy we all expected.
And this is the point that President Trump put out there. You and I disagreed on that before, and I was very vocal that I did not want this policy. This is also splitting a lot of Republicans on Capitol Hill, and that is part of the debate that is in the bill. How much is this stimulative to economies that are in red states in a way that they don't want to roll back so quickly, given that there is this emphasis on trying to create jobs?
The President of the United States has been super busy over the last 24 hours, that's for sure, talking about needing sleep and stuff. That guy's not sleeping. Ramping up the pressure on Fed Chair Jay Powell yesterday, writing a letter urging the central bank to cut rates by a lot. Trump then posting Powell and the FOMC should be ashamed for costing the U.S. a fortune.
Handwritten letter, so basically they're pen pals now. What I found so interesting is part of that letter, he says, look here, Japan, Denmark, Switzerland, Seychelles. He's like, look at the rest of the world. They're cutting rates. Why are we not cutting rates? But this comes back to what we were just discussing a few minutes ago. The president has been very explicit. He wants the rate cut because we are paying too much on our debt. And for the first time we've seen, when we pay our net interest on our debt, it is bigger than the U.S. national defense budget. And he's looking at that and he's saying, where can we try to trim? Why are we spending so much money on our debt? If he just doesn't, if he cuts the rates, potentially this is where we could save some money. And he's, according to the president, he thinks inflation's over.
If you're reliant on short-term funding, great, you might get those lower rates. If you're reliant on long-term funding, long-term interest rates, you might have a problem. If they start cutting interest rates in response to this, Lisa, we've been talking about this dynamic for months now. If you see a repeat of what we saw at the back end of last year, you bring the front end down and you see the long end go the other way, try getting a mortgage.
Well, and I would add to that, it will be even worse because if people perceive that inflation isn't necessarily dead and that this isn't the prudent economic policy, but it's being done for political questions, political reasons, then all of a sudden you have a framework where people don't want to buy U.S. assets that's lost that credibility. Julian Emanuel said that the biggest risk case for equities was the 10-year going above 5%, and that is what he expects to possibly be on the table in that type of scenario.
10-year this morning, 419 and down another 4 basis points as we speak. Let's get to some better news for the president. The European Union coming to terms with a 10% universal tariff from the United States. Sources telling us here at Bloomberg that officials are willing to accept a deal, but with key exemptions. Joining us now to discuss is Bloomberg's Ollie Krug. Ollie, what are the key exemptions and why the turnaround from the EU?
Yeah, and I think it's a little bit surprising, John, that, 8 days before the deadline is the moment at which the EU has sort of realized that this 10% is not going to move. That seemed pretty clear from the outset. What they would like to see are some exemptions and quotas to bring the effective rate down on auto tariffs and steel tariffs and aluminum tariffs. Remember, those are at about 50%, auto tariffs at about 25%. They'd like to have some workarounds around that. That'll be pushed very hard by the Germans. But what they would also like to do is get some clarity on the sectoral tariffs. For them, it's like they're negotiating blind, right? If you are going to negotiate a trade deal, and then a couple months later, you're going to get hit in the pharma sector, the airline industry, and the chips, and these are the 3 main sectors that the Europeans are most concerned about, then what good is a deal going to be? So that is really what they're going to be pushing in the last few days that this is going to happen. Of course, we remember what happened with Canada and the digital tax, and that sort of got turned around. There are a number of European countries that have digital taxes. Is that something that's going to come into the fray? So we're really in crunch time for these negotiations. About 8 days to go until that July the 9th deadline. And of course, we don't know if the Trump administration is going to come with more afterwards. That's really the scenario that European policymakers would like to avoid.
Ollie, with the latest, appreciate the reporting, sir. Oliver Crook there out of London this morning. Joining us now to extend the conversation, Everett Eisenstadt, the former National Economic Council Deputy Director. Everett, welcome back to the programme. What is your base case for July 9th? Extend and pretend, move on, and drop 10% on everyone? Which one?
Well, I think we're going to see a little bit of everything. Believe there will be an extension of the tariff deadline will be pushed back for some countries. I think we'll have some frameworks announced. But one of the interesting points that was just made that I don't think should be underestimated is the fact that the European Union agreed to that 10% baseline, just as the UK did, United Kingdom. And as you recall, a month ago or so, that was not even on the table for the European Union. So countries are steadily recognizing that they need to adapt to the president's priorities and making that, being pragmatic, they're accepting that and trying to move forward with things that really matter to them.
Everett, 5 days ago, I was in Europe, and they were talking about how they would not accept a 10% universal baseline tariff. So what are they getting for accepting this?
It's a mixed bag. If you think for many of these economies, they just want this to go away and get some kind of predictability. What a lot of the industries are worried about are what's coming down the road. And you've got these sectoral these sectoral tariffs that might come into place under Section 232 national security investigations. We already have very high tariffs on autos and steel and aluminum, and we know more are coming. Pharmaceuticals, you had some of them up there on the big board. Pharmaceuticals, semiconductors, copper, timber, many important components to manufacturing, and they could be fairly disrupted to supply chains for a country, for an economy like the European Union, Germany, and some of these big manufacturing. Knowing where they're going to be in those sectors is very important. So I think they're willing to accept that 10% baseline, but they need to see and are hoping to see some flexibility in those sectoral tariffs.
Let's talk about two you mentioned when it comes to autos, 25%, and then 50% when it comes to steel. How much lower do you think the United States is willing to go?
I don't think we're going to see an overall reduction for any on the writ large across the board on, say, 55%. It may come down some. I think what we're more likely to see are flexibilities built into that number. For example, if you take the United States UK framework, United Kingdom framework agreement, there's room in there to negotiate quotas. And that's not too dissimilar than what happened during the first administration, where there was a 232 tariff, and then countries got some relief through quotas, exemptions for certain products. So I think it will be more of a Swiss cheese approach where you have the whole there, but there's going to be pockets of flexibility built within it.
Everett, how confusing do you think it is for some of the trade partners that the 232 investigations into national security reasons for tariffs hasn't been completed yet? Those investigations are still underway, and it is unclear what exactly they will establish. How much is that factoring into these negotiations as well?
It's such an interesting dynamic because generally in these negotiations, you know what you're negotiating, you know what the table looks like. And what they're negotiating for now is basically, one, to avoid retaliation in a tit-for-tat trade war, which is a good thing because that could be very destructive to the economies. But they're also negotiating to have a seat at the table when those 232 investigations conclude. And you're right, it is very disconcerting for them to be in a position, for countries to be in a position to negotiate on something that you don't know what the remedies are going to be. So you can talk about generalities, you can talk about, that you want to be there, you want to help shape it. But until you know exactly what it looks like, it makes it very, very difficult.
You don't really know what you're negotiating. Everett, thank you, sir. The former Deputy NEC Director, Everett Eisenstadt, which speaks to the reason why they're so willing just to accept the 10%. Because as you pointed out, Lisa, there's other things to negotiate.
And right now, at least it's not 25% or 40% or 80%, or they just get a letter, like the Penguins.
This is trade on July 9th. Do the Penguins get a letter as well?
I assume that they're not negotiating.
Okay, all right. I imagine they're not coming to the table. But who knows these days, okay? Who knows? July 4th is another self-imposed deadline for taxes. We've been tracking events all night in the Senate. Tyler Kendall has more on the nation's capital. Tyler, what's the latest?
Yeah, hey, John. Well, we can confirm that Vice President J.D. Vance is now on Capitol Hill. He, of course, would be that critical tiebreaker vote if it comes to that. We should say, of course, worth reminding on the math, Republicans can only afford to lose three votes. And right now there's likely 2 no's, which means that Senate Majority Leader John Thune is working overtime at the moment to try to get enough Republicans on board. So we could potentially be gearing up for a vote soon. However, I would point out and heed some caution that we've yet to get votes on some critical amendments that could really change the trajectory of this bill, including one amendment that would have a more lenient timeline when it comes to the phase out of clean energy tax credits like solar and wind. So that needs to happen first before we get to any finalized vote on formal passage. And quickly, I would add that we're talking a lot about what the Senate isn't doing, but I would point out something that they did do, which is strip out a provision to prevent states from regulating artificial intelligence. I bring it out because we know that companies like Meta and Microsoft were lobbying for this, and no doubt they're unhappy with the outcome this morning.
Tyler, thank you. Tyler Kendall. With the latest down in Washington, D.C., we'll have more from Tyler in the next hour. We're getting close?
I think we're getting close. Tyler makes a very good point that we are waiting for this amendment from Joni Ernst. And what she's talking about there is when it comes to renewable projects. And this is a big deal. Under the current version of the bill, qualifying projects have to be in service by the end of 2027. What they want to do in this bill, and this would be very much mood music to the likes of Elon Musk and his cohort when it comes to renewables, they want to say, okay, get shovels in the ground by the end of 2027. You could still get access to these subsidies and funds. Not that the project has to be in the works. That is a very big difference.
Making some slow progress down in Washington, D.C. Let's get the latest on news elsewhere this morning. With your Bloomberg brief, let's cross over to Yahara for more. Hey, Yahara.
Hi, John. President Trump has threatened to proceed with higher tariffs on Japan, citing their unwillingness to accept U.S. rice imports despite a shortage. Trump wrote on Truth Social, "We'll just be sending them a letter." The comments come a little more than a week before the July 9th deadline for higher tariffs on dozens of U.S. trading partners. Meanwhile, Apple is considering using technology from Anthropic or OpenAI to power a new version of Siri. Sources telling us here at Bloomberg the company would sideline its own in-house models in a move aimed at turning around its lagging AI efforts. And Boeing CFO Brian West is stepping down. West helped orchestrate one of the biggest capital raises in U.S. history last year. To steady the plane maker, he will leave in mid-August and be replaced by former Lockheed executive Mark J. Malave. Boeing says West will remain an advisor to CEO Kelly Ortberg. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in about 30 minutes' time. Up next on the program, the pushback begins.
We should try to avoid any sort of overshooting. It's much more, the speed of the adjustment than the level. But I think that 117, even 120, we can overlook a little bit, something beyond that.
120 is okay on euro dollar. Anything above that, the ECB raising a flag this morning. We'll have that conversation up next with Eric Nelson of Wells Fargo, live from New York. You're watching Bloomberg TV.
I'm Alex Rodriguez.
And I'm Jason Kelly.
And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more.
We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything. From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg.
Bringing you up-to-the-minute economic news whenever and wherever it happens. I'm Jennifer Zabasaja in Cape Town, South Africa, and this is Bloomberg.
2-day winning streak on the S&P as we enter Q3. Equity futures kicking off the second half just a touch softer, down by 0.2% on the S&P. On the Nasdaq, we're down by 0.3%. Some fireworks in foreign exchange. Under surveillance this morning, the pushback begins.
We should try to avoid any sort of overshooting. It's much more, the speed of the adjustment than the level. But I think that 117, even 120, we can overlook a little bit something beyond that. This is something that we are monitoring, that we are looking at, but we don't target any concrete level of exchange rate.
So here's the latest this morning. The first sign of ECB officials pushing back against euro strength after the US dollar posted its worst first half performance since 1973. Eric Nelson of Wells Fargo suggests there might be more to come, writing, "We expect a more significant slowdown of the US economy later in Q3 and into Q4, which should drive the next leg lower in dollar short-term rates." Eric joins us now for more. Eric, good morning.
Morning.
What do you make of that pushback coming from Europe this morning?
Well, I think it's not really a function of what Europe is doing. It's very much a U.S. rates move, right? So we're now down 30, 40 bips in between short-term, long-term U.S. rates. And that's really what's driving it. So can the ECB do anything about it? I mean, they could always cut rates. That's always the easy solution. But right now, most of the kind of center of the committee and certainly people like Isabel Schnabel are interested in doing no such thing.
What does it tell you that they're worried about the currency already? What does that tell you about the backdrop for inflation in the Eurozone?
Well, yeah, it's already quite weak. We just had some preliminary numbers from Germany, and it looks like we're going to be continuing to drift maybe even a little bit below 2% on kind of a short-term basis. So that certainly got some of the doves worried, understandably so. It's also still, let's be honest, still very much an export, partly more export-driven than most of its peers. So it's a problem for growth.
There are people who heard what you just said and said, wow, that's radical. You just said it's interest rate differentials that have been driving dollar weakness. Is that really true? Or is it the loss of U.S. exceptionalism, the concerns about monetizing debt, this idea of the failure of the dollar to hedge against any potential losses in U.S. assets?
Well, I think those things are all very, I don't want to downplay them, but I think when you look at what happened in April and May, that was in complete divergence from what was happening with rates. And I think part of that was expectations around growth, right? So we had spent the last 3-4 months of the year last year and the first month of this year focusing on U.S. exceptionalism, right? It was U.S. growth upgrades in a straight line versus peers. And since then, it's been a straight line the other way, especially during April and May. Liberation Day is really what drove those U.S. growth expectations lower. And part of that also fed into people selling dollar assets, hedge ratios, and so on. But now, just in the last month and a half, the rates have taken back the baton.
That said, economists love a good horror story, and the horror story is the United States falling off a cliff and the economy falling in the tanker and the rest of the world taking over, and then people take a look at the actual information under the hood, and it doesn't look like that. What if you get a positive surprise in the United States at the same time that Europe is facing some structural problems and potentially a hit from tariffs and, by the way, a hit from the currency appreciation? How lopsided is positioning right now for that type of thing? To John's point, the pain trade being the dollar stronger.
Yeah, I think it depends on which pair you're looking at. So I think where people have been kind of hiding out is in yen. So people have been very much long the Japanese yen. Positioning in euro is not quite as extreme. So I think that gives a little bit of credence, maybe not immediately continuing the trend, but into the second half of the year, it's not quite so crowded. But I think it's important to keep in mind as well, John at the outset mentioned we're pretty bearish on the dollar versus the euro and so on. In the very short term here, we've got U.S. short-term rates around 3% on like a one-year forward rate. You're pricing in a pretty significant slowdown. So this week's data is really important to determine, is that happening or is it more of a slow grind towards softness?
Are you surprised that Europe's capitulating on the 10%?
I think they're in a difficult spot. I think everyone is starting to kind of move more that direction. Some maybe more than others. I mean, I think the part of the issue here for Europe is that there's a lot of people, a lot of cooks in the kitchen, so to speak, right? And I think they want to avoid the worst case scenario of just complete collapse, 50% tariff that Trump has talked about. I think when push comes to shove and they actually come to a point where they're putting ink on the paper, I'm not so sure that they're going to be as willing across the board to accept that. They're going to have to take a lot of quotas, I think, and things like that.
There's going to be exceptions. There's going to be carve-outs, likely, when it comes to if they're willing to accept a 10% base. What's the reaction from the currency the second Trump comes out and does this announcement?
Well, I think it's a little bit of a different proposition now than it was back in April because growth expectations look a little bit closer to, realistic. So there may be a little bit more pushback on the euro strength if you do get a really nasty tariff announcement. But I think the bias here is this is generally viewed as U.S. economic self-destruction on the tariff side. So I think any sort of pullback in euro is probably going to be pretty short-lived.
We haven't seen much destruction. Let's talk about the data. Payrolls on Thursday. The estimate in our survey now coming down to about 110. Is a low number on Thursday a weak number?
I think it's got to be quite weak. I think it's, you look at talking about Bloomberg here, the whispered number, which, gives us a sense of where the kind of cognizant are going.
That anything around 100K these days because of immigration is actually not a weak number. Yeah. Maybe that's still strength. Maybe that doesn't lead to a higher unemployment rate. What are you and the team thinking about?
That's really a key point. Yeah, I think the break-even rate, as you say, is much lower than it was a couple months ago. So, I mean, we have the unemployment rate eventually getting up to 4 or 5, but not soon. And if you look at continuing claims, that's telling you it's harder to find a job, but initial jobless claims are going nowhere. So this could be a very slow deterioration process.
Some tension in the data, at least for the moment. Eric Nelson there of Wells Fargo. We heard from Torsten Slock of Apollo, last week? Sat in that chair. He said maybe get used to 50K on payrolls, and maybe that's just the replacement rate. For unemployment, you might not see it drift higher, even with numbers like that.
So then what do you do with that? Is it a positive thing? Is that a negative thing? How do you gauge numbers that look dramatically different that are coming in at the weakest on a headline level going back to 2020, even though people are saying it's not cheering that quickly? It becomes very complicated, and the dual mandate becomes that much more fraught.
I'm just going to say, if you start printing 50s, I think there will be some screaming down in Washington about lower interest rates.
I would agree with that, but then are you going to tell Amazon to hire more people and fewer robots? Did you see that story earlier today? I mean, they have potentially more robots than people in the next 6 to 12 months, and I'm just looking at this, and I'm like, how do you gauge that out? The technological changes. Make robots great again? I don't know.
That chorus will get a lot bigger. But what's interesting when you say that, you're already hearing from a lot of Democrats, and you have been from the likes of Elizabeth Warren. She lines up with Trump on this, telling Jay Powell that he should have been lowering rates for months.
Didn't she call Chairman Powell a dangerous man once?
Yes.
Do you remember that?
I do.
It feels like a lifetime ago, doesn't it?
I keep going back to, if he listened to all of these politicians, would rates be lower on the long end? And that ultimately is the key question that people are not giving a consistent answer to.
Based on experience, the experience of last year, perhaps not. Equities this morning down 0.2%. Up next, Bob Michael of JP Morgan, Henrietta Trays of Vader Partners, Daniel Ruska of Bernstein, and David Safe of Nomura. Live from New York, the second hour of Bloomberg Surveillance is up next.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Let me break down our CapEx into the buckets that we spend. Big part of it is to expand our reach of fiber. You cannot wait until there is certainty to build that. These have long lead times that require you to have conviction about where demand is going. Another bucket is, as more people are on our network, we also have to add more coverage and capacity. It's almost like a variable expense. Third, we are modernizing our wireless network right now. Through the investments we're making, we are driving down our unit costs over time and providing more capacity to serve the demand that we think is coming.
Do you have less confidence in that 3-year plan now than when you first came out with it, given that some people are having trouble deciding how things are going to look in the next 3 days?
No, I really don't. I look at the nature of our business. It doesn't matter the economic cycle. This is a critical goods or service, and we have every confidence demand for it will remain. Will it be harder in a more challenged economic environment if that ends up being the case? Of course, but remember, we are investing at record levels. Slight moderations of that would allow us to deliver a lot more incremental cash to the bottom line. So I have every confidence we're going to be able to deliver our guidance.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action.
We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
It's the countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
What started out as just a relief rally is starting to become something real.
Institutional risk sentiment has improved so much that people are willing to put money to work.
The risk in stocks are a little higher today than they were in April.
All the negative things which could happen have dissipated, at least for the time being.
Does it really make sense for equities to be hitting new record highs? I think that is a pain trade.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
How was all of that just one quarter? Q2. Let's hope Q3 is nothing like Q2. Equity futures this morning look like this, and good morning. We're down 0.2% on the S&P, following back-to-back all-time highs on a benchmark stateside. On the Nasdaq 100, after a major rally off the April low, we're down just 0.2%, close to record highs across the board. Through the week, anticipating lots of data, including the jobs report on Thursday. On Friday, markets close, but it's a deadline, a self-imposed deadline for what's happening down in Washington, D.C. right now. Live pictures in the Senate as they drift towards a vote on the one big, beautiful bill.
With a consensus coalescing that it might not be on July 4th, as Anne-Marie mentioned, but that they will get something passed despite these 8 holdouts that are lobbying for some sort of specific deal. When you take a step back, you just wonder how much has changed. You talked about this earlier. Are we heading into the second half with the same presumptions? And the answer is maybe not, given that we have a little bit more certainty that we have this bill and that, frankly, the tariff situation does seem to be facing some sort of resolution.
The bill's going to get done. Does it get done in time? Potentially not. Does it look like it wasn't the one in the House? No, it does not, which is why this is going to get even more complicated when the Senate is able to sign, seal, deliver it back to the lower chamber. J.D. Vance, though, is in the Capitol right now. So clearly they are getting close to potentially needing his tie-breaking vote. What Senate Majority Leader John Thune right now is doing is locking up the final senator he needs, because he knows he's not going to have Tom Tillis. He likely won't have Senator Paul, but maybe he will if they're willing to do a negotiation on the debt ceiling. The individual I'm watching is Senator Lisa Murkowski of Alaska. If they can get language that the parliamentarian signs off on when it comes to a Medicaid carve-out, she's likely going to be a yes. And they can get the show on the road.
As the temperature rises down in Washington, the tension builds between Elon Musk and the President of the United States. It's round 2. A second round of this. Tesla's down in the pre-market by more than 4%. The spat continues to build over something that was obvious several months ago, the removal or the phase-out of EV tax credits.
And initially, Elon Musk said it didn't really matter, and that ultimately it might even benefit Tesla. It doesn't really matter to the fundamental picture. Now it does matter quite a bit at the same time that it's one of the key concerns for a lot of even Republican senators, Republican Congress members who see that there is some sort of economic benefit. When you take a step back, it highlights how fraught it is for someone to be perceived as benefiting from being close to the president because fortunes can change. And I don't know if you can really extrapolate out in some sort of generality because this is a very specific situation, but there is this feeling that this is a complete about face for both Elon Musk, the man, and Tesla, the company.
Dan Ives just published. Of course, he's been watching this beef, and he says the best friend forever situation, he says BFFF, has now turned to soap opera that remains an overhang on Tesla stock, with investors feeling the Trump administration will be more hawkish and show scrutiny around Musk-related U.S. government spending related to Tesla, SpaceX, and most importantly, the autonomous future with the regulatory environment. That is why the stock is down this morning.
Spare a thought for these guys. Can we have some sympathy for central bankers? That much this morning, maybe? Small violins? Okay. 9:30 Eastern Time. Chairman Powell sitting down with ECB President Christine Lagarde and Governor Ueda of the Central Bank of Japan in Sintra, Portugal at 9:30. What on earth do these guys do? The fact of the matter is, apart from Chairman Powell, some of those guys have been doing quite a lot.
Yeah, and actually, Christine Lagarde came out in a speech and comments over the past couple of days and talked about essentially scenario analysis, which hints at something, I don't want to say dual mandate-like, but looking at potential risks in a forward glance at potential policy. I just wonder how much they address tariffs, how much they address inflation, and whether inflation is coming in at a time where European inflation came in lighter than expected this morning. I mean, there are a whole host of things that become very complicated when they're looking forward at a time where the crystal ball is quite murky.
The elephant in the room, of course, is going to be the president, who just sent that letter to Jay Powell. They're now pen pals. And Christine Lagarde, who the president has been praising for cutting interest rates. But I have the smallest violin for them because this conference is held in Sintra, Portugal. Absolutely stunning.
Beautiful, 40 degrees. Or triple digits here, stateside and no aircon.
Yeah.
Lovely stuff.
Yeah, I guess that, you know, we can actually feel bad for them.
Imagine maybe they've got some aircon. Who knows? Coming up this hour, Bob Michael of JP Morgan with stocks notching a second quarter comeback. Henrietta Trays of Veda Partners as the Senate pulls an all-nighter. David Seif of Nomura expecting a lackluster 90K payrolls print this coming Thursday. We begin this hour with stock steady after the S&P 500 notched its best quarter since December 23. Bob Michael of JP Morgan writing the markets are in a good place in the aftermath of the Middle East ceasefire and progress on both tariff negotiations and the one big, beautiful bill. Bob joins us now for more. Bob, good morning.
Good morning.
Is the big, beautiful bill beautiful for bonds?
First, John, happy Canada Day.
Oh, thank you so much.
Former central banker Mark Carney would appreciate the acknowledgement. He's had a tough previous week, so...
Are you done? Is there more? You can carry on if you want.
No.
Okay, that's done.
Let's go to your question.
Canada's out of the way, please, if you've got time.
I heard you say earlier, I hope the third quarter is nothing like the second quarter. I wish the third quarter is exactly like the second quarter. Think about it. Yields are lower, equity prices are higher, an overcrowded dollar sold off a bit. It was all good, and there was so much volatility during the quarter that for an active manager, you had a lot of opportunity to move positions around. So I would love that quarter over again. We're not going to get it. So everything is more stable right now.
So, Bob, happy Canada Day. I appreciated that, by the way, and I was waiting for you.
It means a lot to him, clearly.
It did mean a lot, although you didn't break a flag, so I don't know. But I am curious going forward. You said it's going to be a lot more stable, which is problematic for people who want to win on the trading. What makes you think it's going to be more stable when we still have these levels of uncertainty and potentially upside surprises to inflation later this year?
Because there are a lot of policies the administration tried to get out of the way. Everything, everywhere, all at once. It feels to us they're trying to clear the deck before the end of the year so that when you roll into next year, you have a smooth run into the midterm elections. They learned from Trump term one, if you lose the midterms, you lose the second half of your presidency. So I think they want to get all the nasties out of the way, come to resolutions on tariffs, on the One Big Beautiful Bill Act. We'll start tackling things like deregulation, get all the dust settled as we head into the fourth quarter, and then the markets can react to everything. They'll have the information.
Do we put the handwritten note to Jay Powell under the rubric of the nasties? I mean, in other words, is this going to potentially be a threat in the second half at a time when you could potentially get a Fed that does cut rates into potentially a more dovish Fed leadership in 2026 at a time where growth might surprise to the upside with some of the stimulative effects of this bill in Washington?
So the back and forth of the president to Jay Powell is nothing more than entertaining. Jay Powell is not going anywhere. He walks in every day and tries to do what's best for the country. And I believe the FOMC tries to do that as well, although it appears that there are some open mic auditions down at the Improv for the next Fed chair. So put that aside, they're doing the right thing. I wish in these interviews with the Treasury Secretary Bessent, someone would say, you know what, if you want yields to come down in the long end so that mortgage rates come down, you should actually be asking the Fed to hike rates 100 basis points in there. because that will bring rates down in the long end. Because with the kind of softness we're now kind of seeing in the labor market, we haven't seen the full impact on tariffs. We know businesses and household rolled a lot of the spending forward into the first quarter. They're in a pause mode. Hiking rates here is what would really bring long rates down.
Bob Michael, thank you, because we've been talking about this now for months. The experience of last year, they cut rates 100 basis points and yield to the long end actually rose. Do you see a risk of that developing this year, or are things different this time?
I think we're getting past that. I think there was a lot of deleveraging in the long end. I think there was selling. I think what you're seeing now is money's coming into the bond market. It goes into things like income funds and aggregate bond funds, and they buy across the curve, and it's starting to support the long end. The long end looks structurally cheap to the front end now. I think we're past the point about worrying about how the U.S. is going to fund itself.
Are there fundamentals that support that appetite for longer-dated bonds?
Well, the fundamentals are going to come from long-dated buyers, so pension funds and insurance companies that have long-term liabilities that they have to defease. They pretty much own that market, and what we're seeing right now is a sense that yields don't look too bad where they are. When you start looking at the corporate market, the all-in yield looks pretty good. If things do start to slow down, and the Fed actually does start to bring rates down once, a couple times more, because of a softening in the economy, because the labor market's starting to weaken, you're likely to see that parallel curve shift lower that Treasury Secretary Bessent was talking about, so they don't want to miss it.
This sounds like the backdrop that we would have been talking about, the investor buyer base maybe 6 months ago. Supposedly that all changed. Foreign investors fled, even long-term institutions, and you have this real question about vigilantes with their pitchforks coming out and protesting the bill in Washington, D.C. What happened with all of that?
So the foreign investors never actually fled, and we've been saying that for a long time. We deal with a lot of foreign investors. I went to Tokyo a couple months ago, met with a lot of big foreign investors. They continue to put money into the U.S. bond market. There may have been a pause for a week or so, but there was no net selling, and we've seen that in the tick data. We've seen that in the Fed's custody data. They've been coming into the auctions and buying. What they have been doing is thinking about owning U.S. dollars versus their base currency. So they continue to buy U.S. assets, but this time they're less interested in taking the U.S. dollar and more interested in hedging some of that back to their base currency.
So they're not selling dollar assets, they're hedging the U.S. dollar. That's been the theme, hasn't it?
Which led to the surprising occurrence where you saw decent performance in stocks and bonds, but the dollar falling out of bed. And can that continue as sort of the one expression of concern about the U.S. budget and some of the policies?
Bob Michael at JP Morgan's going to stick with us. Lower yields again today. We're down 4 basis points. It's a break of 420 on 10s, 418. With an update on stories elsewhere this morning with your Bloomberg Brief, here's Yahara Anand with more. Hey, Yahara.
Hi, John. Senate Republican leaders continue scrambling for votes to pass President Trump's $3.3 trillion tax and spending bill. They've been up all night and are continuing to vote on amendments to the legislation amid deep party divisions over clean energy and Medicaid cuts. There are currently 8 major Republican holdouts. Meanwhile, President Trump is attacking Fed Chair Jay Powell again, posting on Truth Social, quote, Jerome Tulay Powell and his entire board should be ashamed of themselves, adding, if they were doing their job properly, our country would be saving trillions of dollars in interest costs. We should be paying 1% interest. That message from Trump was also sent to the Fed chair in a letter. And Amazon is taking its automation efforts to new heights. The Wall Street Journal is reporting the e-commerce giant has deployed over 1 million robots in its facilities. That's the most automation the company has ever had and is nearing the count of human workers. Around 3/4 of Amazon's global deliveries are assisted in some way by robotics. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next, shoring up support on Capitol Hill.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the the president's desk to sign on July 4th. We're all on the same page on how to grow the economy while controlling and bringing down expenses.
Joining us in just a moment, Henrietta Trays of Vader Partners, and Bob Michael has a whole lot more to say about that tax bill. Live from New York City this morning. Good morning.
Asia is at the forefront of some of the world's biggest stories.
And we're here, where the action starts in Sydney.
And in Tokyo, get ahead as the global trading day begins.
The Asia Trade, weekdays only on Bloomberg.
David Weston. Join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
Done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The Middle East and Africa, vibrant resources and high-yield investment opportunities abound. Join me on Horizons Middle East and Africa for the stories, newsmakers, and insight from this exciting region. Now weekdays, only on Bloomberg.
Just heard from a Bloomberg subscriber. If you went to sleep in February and woke up today, no change, except for the US dollar. Didn't feel like that, did it? Equity futures right now on the S&P, negative by 0.2%. On the Nasdaq 100, we're down by 0.25%, with all eyes on the nation's capital under surveillance this morning, shoring up support on Capitol Hill.
I'm confident that the bill is going to progress as is over the next few hours, and it'll be on the president's desk to sign on July 4th. So the Senate will vote, pass it over to the House. We've seen incredible leadership, and this is what leadership looks like. We're all on the same page on how to grow the economy while controlling and bringing down expenses.
Here's the latest this morning. Senate Republicans pulling an all-nighter, looking for votes on the one big, beautiful bill. Henrietta Trays of Vader Partners writing, eventually the rubber will have to hit the road, and we expect that the House will roll over and accept the Senate's more material deficit increases. Henrietta joins us now for more. Henrietta, welcome back to the program. Just describe what's taking place in the Senate right now and whether you believe we're pretty close to getting this done.
Yeah, it looks like we're in force-it mode. We've got J.D. Vance going up to the Senate, clearly indicating with some muscle that he's there to break a vote if he needs to and be the holdout. But I want to just emphasize one thing here. Him having to vote for the bill now means that over the last 72 hours, the trajectory of this bill has actually lost a senator along the way. So his vote was not needed for the motion to proceed on Saturday night, and now it is. And that's obviously not a good sign. And I think a big part of that could be the distributional tables that were released by the JCT at about 2 o'clock this morning, which show the top bracket is going to see $12,500 when this bill is passed, and the lowest bracket is going to see $150. So that's really the fallout here. That's what's got Alaska all flipped out. We've got some problems still.
Henrietta, is it, when it comes to the Senator of Alaska, Lisa Murkowski, is she the one that Majority Leader John Thune has to flip?
She's essential to the package. What we always watch, and it's been decades now, is the combination of Collins and Murkowski. And let's not forget that Dan Sullivan is one of the Alaska senators that's actually up next cycle. So when you get 35% of the Medicaid recipients in Alaska that are under risk of seeing their cuts or their health care lost, that's a material problem for the state. But then we still have the IRA issues that are critical to Maine and a whole host of other states as well. So I think we actually have a little bit longer to go before this is all nailed down.
In your note, you think that in the end, the final passage will get Murkowski and Senator Collins' vote. But Senator Collins had an amendment earlier this morning when it would give more money to rural hospitals in lieu of raising the tax rate on those making $25 million or more, and that was struck down. So is she a no now, given her amendment went down in flames?
In my experience, that's more of a messaging document. You're not going to get Republicans to vote for tax increases for any individual brackets. Even President Trump tried to do that earlier on in the year, and the party killed it pretty quickly. So I see that more of as a message and, pretty serious signal to Senator Collins, who is also up for re-election next cycle, that she has another workaround. But the fact, again, that Vance is there means she might be a no vote. And she made it really clear during the motion to proceed on Saturday night that she was only voting to proceed. She did not have support for the underlying bill. So Vance being there suggests that they have lost a senator from the process alone.
Henrietta, then this goes to the House, and you think the House just accepts it. Although we're already seeing some House members come out, the SALT caucus, I don't like what they did to tweak what happened with the SALT cap. You have the House Freedom Caucus saying, actually, this raises the deficit. We're going to be increasing spending. Why are you so sure the House is just going to take this on the chin?
Yeah, and I'm sorry, it's been a long night, but I got to say the SALT caucus has to sit down. I mean, they've gotten enough of their carve out. They got a $40K cap. They've got it up to $500,000 for an income bracket. So they've gotten what they're going to get. That's why the distributional tables are so bad. I would really expect that the Murkowski-Ernst-Grassley bill on the IRA or the amendment has to pass in order to satiate the House IRA supporters, of which there are anywhere between 18 and 30 members. To me, that's a bigger caucus than the SALT conference, who's already gotten as much as they can ask for, much more than I anticipated, indeed. So I think that they need to sit down and we need to move into the IRA place. We haven't even gotten an amendment vote on that bill yet, so we need to see that happen.
We're getting closer. Henrietta, thank you. Henrietta Trace there of Vader Partners. We're getting closer and bond yields are falling, not rising. We're down 4 basis points on 10s, 4.19. Bob Michael at JP Morgan still with us. This is about to pass and bond yields are falling, not rising. Does this nation's deficit and debt matter to the price of treasuries?
No, it doesn't. And I think more bad decisions have been made about buying and selling treasuries on the amount of U.S. debt out there than anything else that's come along. So look, we in the market have gotten our head around, we're going to see a one big beautiful bill. It's going to increase spending over 10 years, 2.8 to 3.2 trillion. I don't know where CBO scoring is at this minute, but it's somewhere in that vicinity. It could even be a little bit higher. We get it. Does that mean that the Fed can bring the Fed funds rate down to 3%? Probably not. Can they bring it down to 3.5, 3.75? Probably, because you still have the tariffs hitting first. That 10% baseline tariff has been in place for several months already. Businesses and households are pausing a bit. You do need this one big beautiful bill to come along and give some impetus to the economy. It could be an interesting balance here. I think we in the markets are over it.
Maybe it's because Scott Bessent is not over it and has been really focused on that 10-year yield and keeping that lower, and a real question around what the Fed will do, what this president will jawbone for in order to keep borrowing costs relatively low for the United States. Does that affect where the bond market is viewing this, the fact that the U.S. might not issue as much in the long end, that they will adjust depending on the market's response?
If I were Bessent, I would take the win. I've said all year it's a shock to me that the 10-year didn't get to 5% and stay there. You've got a 4 3/8% Fed funds rate. They haven't cut rates in 7 months. All these rate cuts that people had, 4, 5, 6 this year, they've had to take off the boards, yet it's been really hard to move the 10-year too far away from a 4.4% yield. That's pretty much flat to the Fed funds rate. So there still is a tremendous amount of demand for bonds. There's a tremendous amount of demand for treasuries. We didn't get to that 5% level despite all the inflation growth impact you could see from policies coming out of Washington. So I think the treasury market's in a really good place right now.
So with due apology to Ed Yardeni, but do you think that the concept of a bond vigilante is a myth and not reality?
I think so. I think it would be nice if we could put on a mask and jump on a horseback and ride through and drive the markets wherever we wanted them. But you know what?
They the good old days, Bob?
They were. But look,
with the Canadian flag.
The amount of bond investable assets no longer sits on broker-dealer balance sheet looking to be traded or hedged or moved or repriced. They're sitting in end client portfolios, in wealth management accounts, in pension funds and insurance companies. That's where the bulk of the AUM is, and that's pretty stable. I look at the amount of cash that's still in the system. I saw an interesting stat a week or so ago. We're watching money market fund assets, that's $7 trillion. When you start adding in checking accounts, deposit accounts, savings accounts, suddenly you're over 21 trillion in liquidity. That's a new indoor record, and it still keeps rising. So there's a lot of money sloshing around in the system. Everyone feels a sense that they've missed something. They want to get in the market somewhere. I've got a call tonight with Australia. I've had many calls yesterday. I've got more. Everyone is asking me, where do we get in? How do we get in? What do we buy? What do you think going forward? Nobody's asking me, how do I get out of the bond market yet? I've been saying that all year, and here we are, lower yields. I'm not that surprised.
What about Section 899? Are people now feeling like they're more willing to get in front of U.S. assets because that's been stripped out of this bill?
That was a concern. I think by and large, the overseas investor looked at that and said, that can't possibly happen. When we get down to talking about the specifics and the unintended consequences of some of these policies, that will be taken off the board. I was more concerned than a lot of our foreign investors were. They proved to be right on this.
Bob Michael of JP Morgan on the bond market. Bob, thank you, sir.
Always a pleasure.
And thanks for the 2 Sundays we spent with you in Q2 as well, which now feel like a lifetime ago, right? Feels like a lifetime ago.
Yeah, he says that he would want a repeat of this. I love spending Sunday evenings with you. Let's hope that there aren't that many more of them.
A repeat of the price action, just to be clear.
Exactly.
Sure, Bob's going to take that. I'm not sure about the work that went into it. Up next on the program, it is Trump versus Musk, Volume 2. Daniel Rusker of Bernstein with EV credits on the chopping block, plus Danny Berger with your morning movers with the impact on Tesla.
to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Key investors, top executives, global innovators. Join me for in-depth conversations with the biggest newsmakers on the day's top stories. Insight with Haslinda Onen, only on Bloomberg.
Bringing you up-to-the-minute news whenever and wherever it happens. I'm Matt Miller, the Circuit de la Sarthe in Le Mans, and this is Bloomberg.
Morning, this is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
Three-day winning streak coming into Q3. Equities pulling back just a little bit. No drama whatsoever. We're down 0.2%. Plenty of drama elsewhere. We'll get to that in just a moment. We're down 0.25% on the NASDAQ 100. With your morning movers, let's cross over to Danny Berger. Morning, Danny.
Good morning, John. And a taste of that drama for you. Tesla shares in the pre-market down just under 5%. It's the back and forth between Elon Musk and President Trump over social media. Elon Musk slamming the bill, making its way through Congress right now. Trump on Truth Social last night, seemingly threatening to take away some of Elon Musk's company's subsidies. Hence, you get the drop in Tesla, showing just how sensitive it is to that. Moments ago, we also got a press release from AMC announcing an agreement with creditors in which it would take out about $223 million of debt. It would use that to pay down a line of current debt that expires in 2026. Maybe a little bit of extend and pretend. Shares down more than 1%, bouncing around a bit this morning. It's also going to be a dilutive event. It's also going to equitize about $143 million of existing debt as well. So that has shares off this morning. Finally, wrapping things up with some sell-side action for you. TD Cowen downgrading the salad chain Sweetgreen to a hold, saying that it's done channel checks and it suggests that stores that are at least 4 years old are going to be facing double-digit declines in same-store sales. It also doesn't like its new strategy of moving to more suburban areas, says it's unproven. So, John, the pushback against $20 salads, it's real apparently.
It is, and the chicken was getting worse as well over the past few months.
There's
just
a real problem.
Throwing that out there. Of course, that's a very personal opinion, but just throwing that out
Anything
there.
else?
When companies go public, these things tend to happen.
My issue is just that the portions get smaller and smaller. So
Much
if you get
smaller.
the salmon, it went from like this to like this.
Portions come down, quality gets worse. And
people are a little meaner.
See that across the board. They're meaner to you. That might be a personal thing. All right. On a radar this morning, Senate Republican leaders pulling an all-nighter, looking to shore up support for the president's tax bill. Vice President J.D. Vance at the Capitol right now. He would cast a tie-breaking vote if needed to get the bill across the finish line.
So the mood music looks good when the vice president shows up to the Capitol. It means that likely we could be close to a vote. They've been doing this vote-a-rama, these amendments, since 9 a.m. yesterday. So this has been a slog, an all-nighter. The individual I'm looking out for is Senator Lisa Murkowski of Alaska. They were trying to work on language to get a Medicaid carve-out for her state. But Henrietta Trey's brought something up that I think might hurt the Republicans going into the midterms. The Yale Budget Lab yesterday, changes to taxes and Medicaid and SNAP spending proposed by the Senate budget bill would result in a decline of 2.9% in income for the bottom of America, but an increase of 1.9% for the top 1%. That is why the likes of Lisa Murkowski and Susan Collins are saying we need some carve-outs for our states.
The Treasury Secretary, Scott Bessent, was speaking to the American media just moments ago. He said the tax bill more than pays for itself. On this spat with Elon Musk, I admire Musk on rockets. I'll take care of the finances.
Yeah, well, the Musk point, I will leave that to the side for 1 second. The idea of the tax bill more than paying for itself really stems from the idea of tariffs on the other side of this. We've been talking about the connection between July 4th and July 9th, and now that's not being accounted for necessarily in some of the budget estimates.
These two stories are connected. The latest on tariffs sounds like this. Some tension between the US and the Japanese. The president contemplating higher tariffs on Japan. The president saying, quote, they won't take our rice, and yet they have a massive rice shortage. In other words, we'll just be sending them a letter.
So this was my rabbit hole today, was rice in Japan, which is actually fascinating.
Stage is yours.
Okay, so in the 1970s, there was incredible oversupply in Japan that led to a plummeting in prices of rice. Some of the rice farmers were incredibly politically connected and savvy, and so they got certain limitations or restrictions that allowed them to only produce a certain amount and really keep prices high. They removed those, but they get benefits if they stick to certain quotas, so they don't produce too much. So this is true, but at the same time, they don't want to accept rice from the United States, even though the price of rice has doubled since 2023 in Japan, causing a real political issue among consumers because, guess what? Those rice farmers are pretty politically connected.
The rice lobby is the third rail for Japanese politicians, the same way when you see a U.S. politician come out and talk about potentially raising retirement age or cutting Social Security, it's not going to fly. What I find so interesting about this whole trade story right now with this administration as we look into July 9th, they're looking at potentially getting a deal with the European Union before Japan. Japan and India were supposed to be right out of the gate, quick agreements. Now it looks like the pecking order is starting to change.
Has shifted. The EU willing to accept that 10% universal tariff. The tension, though, as Lisa pointed out, is going to come later. It's the debate over the exemptions and the tariffs on certain sectors.
Well, especially when you're talking about these personal prides for all of these countries. You talk about chicken in the European Union, you talk about rice in Japan. They're all of these sort of national champions that you have to somehow work out.
The national champion of Europe are chickens. Is that right?
Well, I'm just saying there's a lot of national champions of food.
You're doing so well on rice.
Okay, like how about champagne in France? I mean, going after every single aspect. Cars in Germany. I mean, it's literally every single national champion. Okay, fine. Maybe chickens are not,
You're back in the game. Let's turn to
British
Apple.
chickens, very good.
Yeah, okay. Apple weighing using AI technology from OpenAI or Anthropic to power a new version of Siri. Sources telling us here at Bloomberg that Apple has asked both firms to train versions of their large language models to run on Apple's own cloud infrastructure. Now, this could be a massive shift for Apple strategically, which typically tries to do a lot of things in-house. I also think it's a massive concession that things aren't going so well internally.
Which was the reason why it was interesting that the stock price went up in response to this. People saying, finally, you guys are just really seeing the light, that you aren't succeeding at really competing at the level you need to be competing with, which really goes to the heart of what is the new technological advancement that Apple's going to come to prove that it isn't just the laggard of the Mag 7.
Ed Ludlow on the West Coast in about 40 minutes from now, joining this program. Less on rice and chicken, much more on Trump versus Elon Musk. Musk slamming Trump's tax and spending bill. Trump firing back saying, quote, Elon might get more subsidy than any human being in history by far. Perhaps we should have Doge take a good hard look at this. Big money to be saved. Joining us now is Bloomberg's Craig Trudell. Craig, welcome to the program. Before we get knee-deep in all of the sparring between the two, I just want to understand how different what is being proposed this morning is to what we heard on the campaign trail, because for us around the table, it doesn't sound too different at all.
Yeah, you know, I think this phasing out of tax credits and you know, specifically as they apply to electric vehicles is consistent with what Trump campaigned on. And I do think that there's an attempt here on the part of Trump and you know, Republicans to kind of make this into, oh, Musk just doesn't like that we're cutting subsidies for his electric cars. I do think that we have to sort of acknowledge that Musk has you know, put forward a more nuanced argument here of you know, fine, you know, do away with subsidies for electric vehicles, but let's also do away with subsidies in general. I think he has a much broader beef with just the amount of you know, money that's being, you know, added in this budget, the amount of debt that the country is going into. And he has talked for years about doing away with subsidies. I think there's just, of course, rightfully, you know, a case to be made for the idea that, you know, he at the same time is sort of talking out of both sides of his mouth and saying, well, you know, if we're going to do away with these subsidies, we're doing away with sort of what ought to be the future of the economy and the future of the U.S. economy in particular.
It's certainly hurting the stock this morning. We're down 5% in the pre-market. Craig, thank you. With us around the table, Daniel Ruska of Bernstein, a much followed analyst on this name and across the industry. Daniel, good morning.
Morning, John.
This is what we expected to happen. How does it change the industry?
I don't think what happened over the past 24 hours really changes the industry. What you need to remember is a big portion of the Tesla stock is held by retail investors. And so as you get big news items, maybe things that we've been following for months now, rise to their attention, and that triggers some of the movement, I think.
What does it do to the EV industry in the United States that already has sort of fallen behind when it comes to the amount of adoption?
I think the U.S. is really a bifurcated market, right? On average, we're at 10%, but we've got a couple of states at 20% EV sales and a couple of states close to zero. And I think it will really make it hard for those states that haven't seen EV sales, Mississippi, Alabama, kind of some of those states, to start buying EVs. And so that really puts big pressure on automakers that they're faced with some states where consumers like EVs and buy EVs and some states where they don't.
There are these highfalutin goals that auto manufacturers in the U.S. would achieve a high percentage of all of their cars coming out being electric vehicles over the next 10, 20 years. Are those all gone?
If you go back to that period, 2019, 2021, just when Tesla was taking off, there was a big hype in the industry, at this table, and everywhere else on Wall Street. And I think the automakers got caught up in that to some degree and thought this would go a lot faster, but it didn't. And they've been caught off guard with production plans that really don't fit consumer demand at this point.
What you see happening in terms of the subsidies being taken away, do you think this puts EV makers in the United States at a big disadvantage from, say, like BYD?
It depends on where you compete. I think in the U.S., we're not really seeing competition with BYD, and so you got to look in the U.S. who's getting incentive and who isn't. And I think in the U.S., this is mainly a consumer question. You know, do you want to sell more EVs and do you want to incentivize the consumer? The real strategic risk against global competitors is 5, 10 years down the line, because of course, if consumers don't demand as many EVs, there will not be as much research in EVs in the U.S., and the technology that companies like Hyundai, Kia, but also BYD build will be far superior than the ones the U.S. manufacturers will have.
Would this fight with the president impact Tesla when it comes to the regulatory environment?
Well, as we've said before, the cancellation of EV credits will put a dent in demand, and that will hurt any EV maker in the U.S., including Tesla as well, but everybody else who's been collecting subsidies as well, like GM, for example. We've seen in other countries like Germany or France or Norway, when incentives were kind of taken off, demand drops precipitously, right? And then Norway actually reverted, went back, and now we have a very high penetration in Norway. So it's not to say that this is the end of EVs. It's a big bump in the road. It's probably more like a cliff. But I don't think the U.S. industry will end up just being ICE cars in the end. We will transition to EVs, but it'll take much longer.
It's going to take longer, but you nailed it. The production mix isn't where the consumer is. Who's in the sweet spot? Who's got it right?
Right now, I think everybody's scrambling because everybody was planning with like 40, 45% EV production by 2030, and that's not going to happen. So everybody's on the back foot. Stellantis is, in my view, in the best position because their new technology platform is flexible between ICE, hybrid, and EVs. And so using those same production assets to just make more combustion engine cars is possible, whereas it's much more difficult for somebody like Ford or GM.
Is that your preferred stock?
Across all of them we cover, yes. We're short the lot, with the exception of Stellantis, whom we're market perform on. And that's more the market, right? Tariffs are coming in, consumers weak. We're going to see SAR dropping down. But yeah, Stellantis over everybody else right now.
Just how much are prices going to go up just across the board because of tariffs and some of the production complicated aspects that we hear about all the time?
Tariffs give you about a 6 to 10% headwind on the price. So if you look at the price, 50,000 routed bound in the US, the tariff is between $4,000 and $6,000. OEMs will not be able to eat all of that. They've been internalizing quite a bit. We'll see that in pretty challenging Q2 numbers. But our estimation is that half of that goes to the consumer and half of that will need to be carried by the OEM.
Daniel, enjoyed this. It's good to see you. Thanks for dropping by. Daniel Rusker there of Bernstein. Tesla, the stock to watch in the pre-market, down at the moment by about 5%. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Back with us. Here's Yahara. Hey, Yahara.
Hi, John. We start with the latest on TikTok. The prospective buyer of its U.S. operations that President Trump referred to over the weekend is said to be the same investor group that bid earlier this year. It includes Oracle, Andreessen Horowitz, and Blackstone. That's according to sources. The group's first bid for the app stalled back in April as trade tensions between Washington and Beijing ramped up. Meanwhile, Meta CEO Mark Zuckerberg announcing a major restructuring of its AI group, which includes a series of new hires. We have been reporting on this, but now it's official. Meta's AI efforts will fall under a new group called Meta Superintelligence Labs. Alexander Wang, former CEO of Scale AI, will lead the group as Meta Chief AI Officer. And the WNBA is expanding. The league has announced new teams in Cleveland, Detroit, and Philadelphia with a record expansion fee of $250 million each. Each team will launch between 2028 and 2030. The WNBA is also in the midst of negotiations with its union for higher pay and minimum facility requirements for players. That's your Bloomberg Brief, John.
Yahara, thank you. More from Yahara in the next hour. Up next on a program, a shaky employment picture.
There's probably a bit of a back and forth on the data front. You know, the employment market is probably, at least in our estimation, the shakiest parts of the current setup. In this environment, what may go wrong is a softening, weakening labor picture.
Up next on a program, David Seif of Nomura. David looking for a soft number this Thursday morning. Live from New York City. Good morning.
Africa has been silent in telling those global stories. And that's where we have a mind full of stories that we can mine and mine and mine for years to come. And I think investors realize that, and they understand that there's real potential. And as I said earlier, independent films are making a huge comeback. So you're looking at your $5 million movies, your $6 million movies, and this film fund that we're setting up is looking at films, you know, we're looking at financing films between a budget of $2 million to $8 million. So we truly believe that we will get a return on investment. And it's about managing expectations. We're not saying to investors we're going to go out there and we're going to sort of start making films that are going to bring you $1 billion return on investment. That's not to say there can't be outliers. The world has seen this happen time and time again.
Of investment agreements.
Deals were once again on display.
The Saudis are open for business.
The cessation of sanctions against Syria.
Another big victory for the Crown Prince. Concerned that none of the guardrails may be set up just yet.
Headline after headline.
Trust Bloomberg for on-the-ground coverage.
The numbers will be quite substantial.
Up-to-the-minute reporting.
Driven the price of oil down.
And the analysis you need.
He's basically going to vault this region into the same sort of sphere as the US and China.
No one covers geopolitics like Bloomberg.
At a time when policy in Washington is driving Wall Street, we draw a distinction between the rhetoric and the action, bringing you market-moving guests and original reporting. This is Bloomberg Surveillance.
Get your fixed income fix. Watch Bloomberg Real Yield around the world right here on Bloomberg. Context changes everything.
The Treasury Secretary Scott Bessent speaking just moments ago with this to say on the Federal Reserve. Maybe the Fed is waiting too long to cut interest rates. Well, the man himself can speak for himself a little bit later this morning at 9:30 Eastern Time. Chairman Powell on a panel in Sintra, Portugal, alongside his peers, the ECB President Christine Lagarde, Governor Ueda of the BOJ, among others, at a time where he's getting some increased pushback from this White House. In the equity market at the moment, the S&P 500 shaping up as follows. Equity futures negative by 0.2% on the S&P. On the Nasdaq, we're down by 1/4 as we anticipate more economic data through the week. Under surveillance this morning, a shaky employment picture.
There's probably a bit of a back and forth on the data front. You know, the employment market is probably, at least in our estimation, the shakiest parts of the current setup, meaning there's a lot of underemployment. We think that businesses writ large are still very cautious. In this environment, what may go wrong is a softening, weakening labor picture.
So here's the latest this morning. Investors counting down to June payrolls out on Thursday. The estimate in our survey expecting 110K jobs added. David Seif of Nomura falling below consensus, writing, we expect a lackluster non-farm payrolls of just 90K. The US labor market is clearly cooling, but it is not collapsing. David's here with us in New York. David, good morning.
Good morning.
90K is a low number. Is a low number a weak number?
Well, that's interesting. The question is what has happened to trend NFP, or what is the NFP necessary to keep the unemployment rate steady? And it does seem to have fallen quite a bit in the past couple of years due to immigration coming down more than anything else. And so probably trend NFP is still over 100K, but it's not much over 100K. So is this a weak number? Yes, if I have to answer in one word, but only a little bit if I'm allowed to go a little longer than that.
Here's another way of asking the question. Yeah. If we get 90K, is unemployment going up?
Well, we think it's going to go up to 4.3, but really that's a very small change. So we had 4.2 in the last print, but it rounded down to 4.2. So we're talking about just a tiny increase. And really, you know, our expectation for the second half of this year is we're going to have an average NFP only in the mid-80s, and unemployment rate's only going to go up to about 4.4% on that. So really just doesn't take as much to keep the unemployment rate steady anymore because there are fewer workers entering the economy each month.
To John's point, if we do get smaller numbers, and they aren't necessarily weak per se, but sort of the new normal, where there just is less dynamism, was this the real picture that we can look for going forward, where there just is less hiring, less firing, less job creation, less job destruction, less motion in the U.S. labor market than there has been traditionally?
Yeah, well, there's definitely a lot less motion. I'm not sure that the 90K is really the best indicator of it. You know, when you look at NFP, you're just looking at the net number. You're looking at the number of people who lost a job and the number of people who got a job. What's really been interesting and really been going on since 2022 is that the gross numbers, the gross flows into new jobs and out of jobs have both come down a lot, or at least the number of people being hired has come down a real lot. So if you have a job right now, even with the cooling economy, even with the cooling labor market, you're about in as good shape as you've ever been. If you are one of the unlucky few who has lost your job, or arguably even worse, if you're in a cohort like college grads who's looking for a job, things look a lot worse for you than you would expect from a 4.2 or 4.3% unemployment rate.
I guess the question is this a sign of weakening to come, or is this a sign of an ossification of the U.S. market that's new, that's more like Europe and less like the U.S.?
Yeah, it does look a lot like Europe, and I think that the jury's still out on that. Is this a permanent thing, or is this what we're going through in this cycle? I think what we saw in 2020 is companies in the United States vastly overfired. They came to regret that pretty badly a couple of years later, and you had companies scrambling for jobs for workers in 2022. And now there may be a sort of pendulum swinging the other way. Now they're reluctant to get rid of people more so because they remember that. I will say that, you know, it's obviously great to have job security, but part of what has really defined American exceptionalism is the churn in the labor market, that companies will renew. There's sort of this creative destruction at all sorts of different levels. And if you do lose a job, it's not the disaster that it would be in many other countries because there's so much hiring going on.
What does the Fed do with this?
Well, I don't think the Fed does that much about sort of a slowing gross numbers. The Fed has to really focus on the overall unemployment rate and, of course, on inflation. And so I think that really with only one instrument, the Fed funds rate, to hit two different targets already, it doesn't want to start creating more targets for itself, so to speak.
Is there good reason to believe the dual mandate might be in conflict by the time we get to the end of the year?
Well, I mean, the Fed is being pulled in two different directions right now, no question about that. That's par for the course. So labor market's cooling, that makes them want to cut, and I think that the Fed would have continued cutting already this year had it not been for the prospect of tariff-induced inflation. And now I think Powell has pretty clearly communicated that this is a wait-and-see mode, and so we think they need a few more months of no inflation before they would be comfortable cutting again, unless there's a real negative surprise on the labor market.
He goes beyond that, though. He doesn't just say it's a wait-and-see situation. He says the data and the economy is solid enough, and that's a reason for us to wait. We can wait. Do you describe it as solid?
I think that solid is it's fading a little bit, the word, but I do think it's still fair to say that. I mean, 4.3% unemployment, that's still really low. I mean, the Fed's never exactly defined what quote-unquote full employment is, but this has got to be pretty close to what it is. So we think the unemployment rate's going to creep higher, but got to remember that the Fed's still well above its mandate on inflation, and so to the extent that it has to prioritize hitting both of them, it has to focus on the one where it's further away from its target.
That is precisely the argument that Esther George, the former Kansas City Fed president, made on this program just yesterday. David Seif there of Nomura. David, thank you.
My pleasure.
Appreciate your time. Looking ahead to payrolls Thursday, of course, not on Friday because of the long weekend here stateside and the July 4th holiday. The number we're looking for on Friday in our survey, putting together all the estimates from economists, 110K. David, they're looking for something closer to 90. Also tracking the latest down in Washington, D.C., looking ahead to this self-imposed deadline on Friday, July 4th, to pass the tax bill. The President of the United States speaking just moments ago.
Right, he's walking out to Marine One. He stopped to talk to reporters. Obviously, they're asking about what is going on right now with the One Big Beautiful Bill. He says we're going to get there. He says he thinks they're doing well. When he asked about, do you think they're cutting too much? I don't like cuts. Obviously, this is not going to be good for the president going to the midterm elections for his party.
Which raises the issue of how much they're going to backtrack, backfill, push out some of the deadlines of the expiration of certain benefits, and leave the deficit in a much more significant case. I mean, again, all roads point to Washington, D.C. spending more and spending it with debt, and that seems to be the likely path of travel here.
I think you asked a few months ago, where are the hawks? Where are the fiscal hawks? Don't appear to be in the Senate, do they?
There's a few, one or two, but no, they're all fiscal hawks until it comes to their state. And I spoke to Steve Dennis this morning, who's our Senate reporter. I think he's taken a nap now. He's been up all night. And he said, Amory, name me a state, I'll find you pork. They're all getting something to get their vote.
Bond yields are lower this morning. We're down by about 2 or 3 basis points at the moment, a break of 420 in the last 24 hours. Up next on the program, in the third hour of Bloomberg Surveillance, we'll catch up with Cameron Dawson of New Edge Wealth, Clay Griffin of MoffettNathanson, Blarina Urucci of T. Rowe Price, and Colin Martin of Charles Schwab. Live from New York City, the second half of 2025 officially begins. This is Bloomberg.
Davos, you were asking a question of President Trump, and he didn't quite answer the question, and he asked you a question. So the question he asked you was something like, why are you not banking certain groups? What is the answer? I don't think he gave you a chance to really answer that question, but what is the answer to that question?
Well, first off, the Bank of America has 70 million consumer customers and millions of small businesses all over the country, all over the world. And so we bank everybody. But the real question was about overregulation, frankly. And so as you look, what's happened is because the interpretations of AML, Anti-Money Laundering, BSA, Bank Secrecy Act, KYC, know your customer's customer, you know, there's a lot of burden upon the banking system to both report suspicious activity reports and do a lot of analysis and we have to close accounts, so we can't tell people why we did it. And often we're told by authorities to close accounts. That creates confusion. Another area comes up in this discussion is in the crypto area where the regulator said you can't bank crypto operating companies, employees of crypto companies, et cetera. We are allowed to do, we bank everybody, but the operating company, they said that's a high-risk activity. Ask us for authority, and guess what? You would have never gotten the authority. So that came up as an issue. So at the end of the day, it's about getting these regulations right.
It's the world's second largest economy with a growing influence in global affairs. Bloomberg The China Show brings you the unmatched expertise you need to keep track of breaking news, in-depth market analysis, and the most influential newsmakers in and around China.
We need to do more to engage the market more. We're risk on. I think we caught a little sweet spot.
Massive savings right now.
It's already a different game.
Bloomberg The China Show. Weekdays around the world, right here on Bloomberg. Context changes everything.
As Bloomberg's global financial correspondent, I get to meet the people shaping the way money flows around the world. And I want to bring you with me. Now we're playing.
Yep, now we're playing. First and foremost, I am a capitalist. The capitalist system is the best system in the world. There isn't another one that works as well.
Citigroup moves $4 trillion a day.
5.
Wall Street used to be a place.
I love all these new Wall Streets. Y'all Street, Wall Street South.
Now it's more of an idea.
The optimism here is infectious.
You think our New Yorkers are negative?
Yes.
Anything that trains people to understand probabilities and just think through things with a greater degree of nuance is a service to humanity.
I hope you survived the day.
I did. It was a busy day.
Technology is embedded in every aspect of our lives.
And laying the foundation for the future.
From finance to defense, AI to entertainment.
And from the road to the stars. Bloomberg brings you the latest stories of the people and companies pushing the tech sector to new frontiers.
And the politics that shape global tech markets.
I'm Caroline Hyde in New York.
And I'm Ed Ludlow in San Francisco.
Watch Bloomberg Tech every weekday.
Only on Bloomberg Television.
Bloomberg loves earnings.
I know it's like your Super Bowl, right?
I can't wait. It's like opening presents in the morning.
All right, it will be exciting.
Nobody covers earnings like Bloomberg.
We've seen an economy that's beginning to slow. It's being hit by policy changes that businesses are trying to digest.
There's probably a bit of a back and forth and on the data front.
We're not actually making progress on inflation.
If the unemployment deteriorates, I think the Fed will react to that.
The markets, I think, are still looking for a smoking gun. To me, that could be a negative payroll print.
This is Bloomberg Surveillance with Jonathan Farrow, Lisa Abramowitz, and Anne-Marie Hordern.
Live from New York City this morning, good morning to you all. The third hour of Bloomberg Surveillance starts right now, as does the second half of 2025, coming into Q3 at all-time highs and pulling back just a little bit on the S&P. We're down a few tenths of 1% across the board here, down a third on the NASDAQ 100. The attention for all of us right now is on the Senate as they look to pass the one big beautiful bill. The president speaking just moments ago, Anne-Marie saying the tax bill will hopefully pass today.
He's seeing some good momentum when he's hearing about. He says we think we're going to get there when it comes to this bill. They are still debating it. We are still waiting on a number of amendments. One critical amendment from Joni Ernst when it comes to what is going on with solar and wind renewable subsidies that potentially could get more moderates on board. The individual I'm looking out for, yes, the vice president is there, so maybe we're close. But the individual I'm looking out for is one holdout when it comes to Senator Lisa Murkowski of Alaska. They've been trying to work out a carve-out for Medicaid funds in her state of Alaska. If they're able to get that language over the finish line, she could be a yes, and this can go back to the lower chamber.
The individual I'm looking out for is Elon Musk. The stock I'm looking at right now is Tesla. Near session lows and down by more than 5%. The president on Elon Musk just moments ago asked about deporting the CEO of Tesla, saying we'll have to take a look.
This coming after his tweet fest or truth fest over the past 24 hours, talking about how this one South African can come in here and has gotten so many subsidies that DOJ should really take a look at all of the potential benefits that Tesla has received and Elon Musk's companies has received from the United States government. I just want to take a step back and show how quickly things can change for specific companies, for specific policies, and it raises the question, yes, we seem like we're stable when you just look at the gains in the S&P 500, but what this type of volatility does for the dollar going forward, as well as potentially individual names.
Rhetoric is very hot. We have the President of the United States saying he's going to look into deporting an individual. What I would say, though, is something that Craig Trudell said earlier. Elon Musk has been super consistent when it comes to subsidies. He's like, if they're not going to be for my industry, they shouldn't be for any industry. Why do we also have subsidies for the oil and gas industry if we're not going to also have them for the EV industry? He's been against them writ large across the board, because now Republicans are saying the only reason he's coming out is because of the EV subsidies, which, to their point, they have been campaigning on for over a year.
It's also fair to say they've been consistent too, to your point. Their stock is down by more than 5%. A theme of the program this morning, the president taking on Elon Musk, taking on holdout Republicans, also taking on Chairman Powell. Later on this morning, in about 90 minutes from now, call it 87, Chairman Powell sitting down in Sintra, Portugal with some of his peers, working out the path forward for monetary policy.
Do you think he's going to write a handwritten note with a Sharpie?
Should ask him, did he return?
Inflation? Did he return it? Yeah, and hold it up saying, I am in wait and see mode. You know, at a certain point, you have to wonder what new can he say. We have heard that he does seem open to September for a rate cut, which is the de facto pricing in markets. We've heard from other Fed officials. So how far is he away from what the Fed wants? Well, the Fed, from what President Trump wants? Well, President Trump wants a 1% Fed funds rate, which he is not going to get. And if he does get, good luck to long-end treasuries.
To John's point yesterday, maybe Jay Powell needs to turn around and say, set your tariff rate, and then I could set a new interest rate. To the point that he had on the hearing was not just the impact of the tariffs, but what are the tariffs going to be? We're talking about the one big beautiful bill this morning because they have this self-imposed deadline of July 4th. Next week, it is all trade.
Print out the statement, get a Sharpie and sign it. JP?
JP.
Something like that.
Yeah, I can just imagine that. You know, you don't want him, you don't want President Trump saying, deport Jay Powell. I mean, honestly, how much more do you need these catfights to really get?
We want it to settle down.
Yeah, I think so.
For market participants, they couldn't care less. We've talked about this a million times. All-time highs on the S&P 500. Coming up this hour, we'll catch up with Cameron Dawson of New Edge Wealth, following the S&P's best quarter since 23. Clay Griffin of MoffettNathanson as Apple looks beyond Cupertino for solutions. And Blarina Urici of T. Rowe Price as President Trump ramps up the pressure on the Federal Reserve. We begin this hour with stocks taking a breather after posting fresh record highs. Cameron Dawson of New Edge Wealth writing, we still see the equity pain trade being higher thanks to relatively light positioning, which creates the potential for a continued chasing of strength. Cameron joins us now for more. Cameron, good morning.
Good morning.
Pain trade's higher. Does it come with narrow leadership too?
I think it does, simply because we're seeing narrow leadership within the earnings line. Because earnings revisions higher are really being driven by Mag 7 and growth names, it suggests that you continue to see this narrow leadership, and you see it in the equal weight S&P 500, making a new relative low versus the market, not just this year, but actually undercutting the December low. So yes, there's broad participation in the market. There's 72% of names are above their 50-day moving average, but the magnitude of the upside is just in a handful of names.
You talked about the E, the earnings revisions improving for that cohort of stocks. What about the P? What's the price of the story now?
It is times like this that we have to remember that valuation is not a good timing tool, and that there are occasionally short-term periods that cause valuations to defy gravity. We think that we could be in one of those short-term periods because sentiment is not stretched. There are still more bears than bulls in the AI bull-bear index, and positioning is still light, 20th percentile in that Deutsche Bank consolidated positioning. That can cause a chase into markets. We're already trading at 22.1 times forward, so you have a scenario where if you get that chase, further multiple expansion, earnings maybe stay stable, that's when we're looking out in the next couple of months, you could see more volatility. But near term, you get the chase.
So if you see things as expensive, but potentially likely to go more expensive, What do you do with that?
Yeah, we think that we have to stay up in the quality sphere. You have seen a huge rally in low quality, high beta names. So if you look at the lowest quality parts of the market, it's had more than double the return than the rest of the market. That's not something we want to chase, because what you're inviting, if you chase that, is a lot more downside volatility when eventually the valuation hits a ceiling. So we stick to high quality, we stick to our knitting, looking for very small pockets at this point of relative value. Hard to find, but I think that remains very important.
If Bob Michael is correct, and the bond vigilantes never existed, and the horseback riders just, have basically retired, at what point do you see lower yields ahead on the heels of lower inflation and a Fed that is geared up to cut, potentially acting as a tailwind to multiple expansion?
This is always the danger with ascribing narrative to price action. Because when we looked at bond yields rising, we said it must be deficits that are causing bond yields to rise. In fact, what we saw instead, like going back into the fall of last year, it was economic surprises soaring higher. So you've seen economic surprises turn much lower. People have been cutting their GDP growth estimates. Those have started to tick back higher, but I think that that's the core reason why we've seen this move in bond yields lower. So it all depends on the backdrop of the data in order to tell us where we think that the bond market will go.
I want to talk to you about policy, because they're debating this bill. You say never has so little cost so much. Yeah. Is this going to be stimulative at all for the economy?
We think very minimally. It's so different than 2017, where people were seeing a big step change function difference in individual tax rates as well as the corporate tax rate. And you go back to that time, you had a big uplift in the earnings line for corporate taxes for the S&P 500 in being able to drive that upside in EPS growth. This bill, you don't get any of that. We would consider things like accelerated depreciation being just a continuation of prior policy. You're seeing the continuation of prior policy on individual taxes. So on a net basis, this doesn't do much, and yet it costs so much.
So it's basically just an extension of policy, which we've been talking about for months. Yeah. What would be stimulative to this economy right now?
Yeah, well, the question is, how much has the industrial policy that you saw over the last couple of years been stimulative? And those are the things that you're actually starting to walk back with the walking back of some of the IRA provisions. All you have to do is look at non-residential construction structures of manufacturing. They have skyrocketed over the past couple of years because of that industrial policy, and that's the exact thing that they're starting to walk back from.
Payrolls Thursday. Is bad news good news?
Yeah, that's a big open question. I think bad news is good news for the bond market, but it remains to be seen for the equity market. Because if it is such bad news that we start looking at the labor market data and saying, ooh, this could be much weaker than expected, we need to cut GDP growth forecasts, we need to cut earnings growth forecasts, that's when bad news is bad news for equities. But if it's just a little bit lighter, then equities likely rally on this hope that maybe we get rate cuts sooner.
Mike Wilson of Morgan Stanley had this to say: the equity market isn't going to wait for the obvious signal in terms of a more dovish shift in monetary policy from the Fed. Stocks will get in front of it.
And that's really the bet for a lot of the bulls, is that any kind of weakness will be met with cutting and then some, and some sort of Fed response, policy response that will give some sort of further fuel to an equity market that hasn't even been trading on economic fundamentals.
I'm sure you saw Hatzius yesterday and the team over at Goldman bringing forward the call for the Federal Reserve to September now. That's their first cut call for this year.
Yeah, and that's pulling it up a month. And the reason why is because they do believe that there is going to be this weakness, but also because Fed officials are telling us. They're saying we're open for September. We need a couple of months, and that's what they're going to get by the time September rolls around.
Payrolls a few days away. The estimate in our survey, 110K. Later on this morning, look out for jobs. Look out for jobs, job openings. That's going to be important. I know it's a little bit dated, but just following that low churn story that you described earlier in the program, just how frozen is this labor market?
I'm really concerned about it. I have to be honest, especially for college graduates, and not just because I have children who are getting toward that age in any way, shape, or form. But you just wonder if the market is less dynamic, do people have less confidence that if they lose their job, they can go out and find something else? Do they have less confidence that they can keep spending at the rate that Americans like to traditionally spend? It just calls into question some of the economic models of the United States.
You certainly see that in the labor differential at the Conference Board Consumer Confidence Survey, that's for sure. Cameron, appreciate this. It's good to see you. Thank you. Cameron Dawson there of New Edge Wealth, looking for higher equity markets and narrower leadership. Let's get you an update on stories elsewhere this morning with your Bloomberg Brief. Let's cross over to Yahara for more. Hey, Yahara.
Hi, John. Senate Republican leaders are looking for votes to pass President Trump's $3.3 trillion tax and spending bill. They've been up all night and are continuing to vote on amendments to the legislation. Vice President J.D. Vance is now at the Capitol. He would cast a tie-breaking vote if needed to get the bill over the finish line. Meanwhile, Israeli Prime Minister Benjamin Netanyahu says he'll travel to Washington next week. According to a statement from his office, he plans to meet with President Trump, Vice President J.D. Vance, and Commerce Secretary Howard Lutnick as he looks to reach a deal on trade. Netanyahu is also expected to speak to the president about negotiating a truce to end the war with Gaza. And China's largest coffee chain touched down in the U.S. Luckin Coffee opened its first U.S. location in New York City yesterday. The chain surpassed Starbucks to become the biggest coffee retailer in China back in 2023. To celebrate its debut, customers who use the app can get their first drink for $1.99. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara later in the hour. Up next, the morning calls. Plus, Clay Griffin of MoffettNathanson as Apple looks beyond Cupertino for help on AI. From New York, this is Bloomberg.
Why do the biggest names in business choose Bloomberg Television?
That's a great question.
It's a very good question.
Interesting question. Good question. Great question. I so appreciate that question. You certainly ask interesting questions.
Bloomberg Television. Top experts, great questions.
Jumpstart your trading day on Bloomberg Open Interest.
2 hours of single stock stories that are driving the opening bell action. We'll take you to Wall Street, Main Street, the C-suite, and beyond.
These are companies that are growing their market.
The great companies in the U.S. are the companies hitting the cutting edge. That's a different story.
Get the inside track on what's buzzing in markets.
With the players who are shaping the narrative.
If you have bad earnings reports, you're going to get punished.
They're not buying what the industry is selling. Join us on Bloomberg Open Interest. Every trading day, only on Bloomberg.
What is going to be the consequence for U.S. markets?
We are basically deep in the European earnings season.
Take a look at how we're faring when it comes to Asian markets.
Live from New York City this morning. Good morning. Attention on Washington, D.C., the President of the United States.
And I hear it's going okay. We'll move it along. But we'll be back here pretty early.
What do you think the president on the bill used in warning some Republicans not to go too crazy with the cuts? Are there parts of the bill or amendments that you think cut too much?
We're going to have to see the final version. I don't want to go too crazy with cuts. I don't like cuts. There are certain things that have been cut, which is good. I think we're doing well. We're going to have to see. It's very complicated stuff. Great enthusiasm, as you know. And I think in the end, we're going to have it. What do you think, Caroline? Yeah, I think
What do you think about Zoran Mamdani having such a hard time condemning the phrase globalizing intifada?
I think he's terrible. He's a communist. The last thing we need is a communist. I said there will never be socialism in the United States. Now we have a communist. So I think he's bad news. And I think I'm going to have a lot of fun with him, watching him, because he has to come right to this building to get his money. And don't worry, he's not going to run away with anything. I think he's frankly, I've heard he's a total nut job. I think the people of New York are crazy. If they go this route, I think they're crazy. We will have a communist for the first time, really, a pure, true communist. He wants to operate the grocery stores, the department stores. What about the people that are there? I think it's crazy.
What happened to Elon Musk?
Who?
What happened to Elon Musk?
Nothing. You know, he's upset he's losing his EV mandate, and he's very upset about things, but you know, he could lose a lot more than that. I can tell you right now. Hey, Elon can lose a lot more than that. We hope it's going to happen, and we're looking forward to happening sometime next week. We want to get our hostages back. We want to get the hostages back.
What if the big beautiful bill doesn't pass? You have to go through item by item by item and pass this stuff one at a time, or you can just try again?
I think we're going to get there. It's tough. We're trying to break it down so it's really good for the country. Trying to get a lot for everybody, and it's a big bill. And smaller bills would have been easy, but they wouldn't have been as good. I think it's going to do okay.
And what the alligator Alpha says is the idea that if some illegal immigrants, in this case, they just get eaten by an alligator or a snake or something.
I guess that's the concept. This is not a nice business. I guess that's the concept. If snakes are fast, but alligators are, we're going to teach them how to run away from an alligator, okay? If they escape prison, how to run away. Don't run in a straight line. Run like this. And you know what? Your chances go up about 1%. Okay? Not a good thing.
What are you going to talk to Netanyahu about next Monday?
Well, he's coming here. We're going to talk about a lot of things. We're going to talk about the great success we had. I mean, we had an incredible, in Iran, we had an incredible success. Like really nobody's had in many, many years. That was a precision war strike, and the word obliteration can now be used because the Atomic Energy Commission said you can't even get into the place. It was demolished. It was really demolished. It was a great, brilliant strike, and how to go forward. We're also going to talk about Gaza. We want to get the rest. We got a lot of hostages back, but we're going to talk about Gaza. I don't know. I think we'll have to take a look. We might have to put Doge on Elon. You know what Doge is? Doge is the monster that might have to go back and eat Elon. Wouldn't that be terrible? He gets a lot of subsidies, Peter. But Elon's very upset that the EV mandate is going to be terminated. And you know what? When you look at it, not everybody wants an electric car. I don't want an electric car. I want to have maybe gasoline, maybe electric, maybe a hybrid, maybe someday a hydrogen. If you have a hydrogen car, it has one problem. It blows up, you know? So I'm going to give that one to Peter. I'm going to let Peter test it out. The hydrogen cars, and when they blow up, it's serious. They find you 5 blocks away. It's that good.
How are the trade talks going? Are there any countries we can expect to see before the July 9th deadline?
Everything's going well. Honestly, everything. This is very complicated because it's very big, a lot of different areas. Look, the Republicans have their heart in it. The Democrats they just want to destroy our country. A Democrat wants to destroy the country. They won't vote on it. They don't vote on anything. This is the biggest tax cut in history. Everything is the biggest in history. It's the best bill we've ever had. We can't get one Democrat vote.
When do you think you'll get final? When do you think you'll get final?
Nice guy, Peter. What do you think?
Very nice guy. When do you think you'll get final passage of the bill?
Hopefully soon. Hopefully today, if we can. Final passage. When I say final is let's take Senate at a time, okay? But I think Senate could be today, and we go over to the House.
And what about Senator Murkowski? Is there any way to placate her?
Who knows? You tell me. You tell me. Is there? Alaska's done so well with me. There's never been a president better to Alaska than me. But it doesn't mean people appreciate it. Have a good time.
President of the United States there, just speaking outside of the White House, departing just moments ago with some comments on a number of issues. We'll pick out two. One on the tax bill. The tax bill will hopefully pass today. The other on Elon Musk, some really punchy language on the Tesla CEO, captured by the stock this morning. That name is down and down hard in the pre-market. On the West Coast, joining us now is Bloomberg's Ed Ludlow. Ed, some renewed tension between the President of the United States and Elon Musk.
Yeah, the Trump trade can go both ways, right? We talked about the Trump trade in November ahead of the election result being a sort of boon to Tesla stock, and now in the session, the stock has held its declines at I think, down 6% in the pre-market. Basically, I'd reiterate, the president was asked the question, would you look at deporting Elon Musk? And the president answered in the affirmative that he would have to look at it. I find this difficult to report on and follow, John. I mean, Elon has talked in interviews. It was referred to in Walter Isaacson's 2023 biography that Musk had taken the oath of citizenship in 2002 in Los Angeles County at the fairgrounds. So he's a U.S. citizen. So that's the kind of volatility of the relationship that's weighing on the stock. The EV and incentives part of the big, beautiful bill, it seems disconnected and separate. And on that point, at least, Elon Musk has been a lot more consistent. Elon Musk has said and maintained for some time that he'd be fine if they did away with those direct consumer incentives, because he's felt that Tesla has a competitive cost base, it has pricing power, and it would be a great advantage to Tesla over other American automakers if those incentives went away. Obviously, the president's statements, not just this morning, but in prior weeks and months, would contradict that.
Well, Elon Musk is saying that they should go, if they go away for the EV companies, they should go away for other parts of energy like the oil and gas world as well. The rhetoric is obviously very hot when you hear the president talking about and respond to this question of deportation. He said Doge is the monster that might have to go back and eat Elon. What else could the U.S. government do to hurt Elon Musk or one of his companies?
Well, if you remember the Thursday and Friday where the war of words took place on X, between the president and Elon Musk, what we tried to do was calculate the exposure that Elon Inc. has to federal contracts, right? Because that was the threat put in place by the president. And, you know, on the Tesla side, that's more insulated. There is some element of incentive or government subsidy beyond direct consumer incentives. That largely has supported Tesla in its manufacturing base. On SpaceX, a big chunk of SpaceX's revenue is contracts with the Department of Defense, with NASA, the space agency. So there's exposure there. But again, like I kind of bring this back to DCAMH and the big, beautiful bill. Elon Musk is often inconsistent, but on these issues, he would argue he has been consistent. He's very worried about the national debt. And in the campaign, when Elon Musk went on the road for the president, he said, and he has said since, I supported you in the idea that you would address this issue. And he, you know, clearly has an ideological point of difference with the president. And I see some headlines from the Treasury Secretary as well on the idea of how this bill addresses that national debt pile.
Yeah, I think his line this morning was stick to rockets and I'll do the finance. Ed, thank you, sir.
Sure.
Ed Ludlow, thank you on the West Coast. More with Ed on Bloomberg Technology at 11 a.m. Eastern Time. No doubt following this story. If you speak to the analysts on this story, they'll tell you this is what we expected. But it's the mood music around the stock that's driving this name lower this morning, and the mood music not great this morning. We're down by close to 6% in the pre-market. Up next, we'll catch up with Blarina Urucci of T. Rowe Price as President Trump sends a message to Fed Chair Jay Powell, plus Danny Berger with your morning movers with more on Tesla. Live from New York, this is Bloomberg.
countdown to the market open as we bring you the first trades across Europe.
We'll debate the most important stories and what will drive the big investment decisions throughout the morning. I'm Guy Johnson.
I'm Kriti Gupta.
And I'm Anna Edwards. Join us every weekday morning for the opening trade, live at 7 a.m. here in London.
Only on Bloomberg. Context changes everything.
From the world of politics to the world of business, Joe Matthew and Kaylee Lines deliver news, insight, and analysis live 2 times a day, every trading day. Balance of Power at 1 and 5 Eastern, only on Bloomberg. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. ETF IQ, only on Bloomberg.
David Weston, join me for the next generation of Wall Street Week, telling stories of capitalism from business, markets, economics, tech, and climate. Each week, we'll go on the road for a look at what lies behind the headlines of today and what will likely be the headlines tomorrow.
Above all else, it's a mission.
It's done nothing but grow immensely. To me, that's an extraordinary sign.
We can be the change that we want to see.
Watch the all-new Wall Street Week. More than what you need to know, it's what you need to think about.
The opening about 60 minutes away. Equity futures negative by 0.4%. This session lows at the moment on the S&P, following a really decent run of gains on the S&P 500. Back-to-back all-time highs coming into Q3. With 60 minutes until that opening bell, let's get you some morning movers and cross over to Danny Berger for more. Hey, Danny.
Hey, John. The pain is not letting up for Tesla. Looks like it's at a new low for the morning, down nearly 6%. You were just speaking with Ed Ludlow about this. And we heard from the president moments ago, re-upping this threat, saying maybe we should have Doge look at Elon Musk's company. Underlying all this, and Trump took to Truth Social also to make a similar type of threat, let's call it, to remove some of the subsidies for Elon Musk's businesses after he criticized the tax bill. So those shares, again, down nearly 6%. Also falling in the pre-market this morning, Warner Brothers Discovery, those shares down nearly 5%. According to people familiar, the Advanced Newhouse publishing house, also controlled by the billionaire Newhouse family, will be selling about a $1.1 million stake in Warner Brothers Discovery. We don't have the reason why behind it. We know that this is a company that will be engaged in a breakup, but Newhouse is the second biggest shareholder, owns about 8% of the company. Finally, wrapping things up with a move to the upside this morning. The big casinos doing really well here in the pre-market. Las Vegas Sands up 5.7%, Wynn Resorts up 5%. We got some numbers from Macau of revenue figures, those coming in 19% for the month of June year over year. The estimate was for just 9%. So gambling alive and well in that region. It makes up about half of the revenue of these companies. So improving this morning, John.
Danny, appreciate the update. Danny, thank you. A few of the names to look for going into the opening bell about 60 minutes from now. Also looking ahead to Fed Chair Jay Powell speaking in about 60 minutes' time. Let's turn to the Fed as the president continues his criticism of the Fed chair.
The president sent this note to the Fed chair. It says, Jerome, you are as usual too late. You have cost the USA a fortune and continue to do so. You should lower the rate by a lot. Hundreds of billions of dollars are being lost, and there is no inflation.
Joining us now to discuss is Bloomberg's Mike McKee. Mike, good morning. The chairman gets an opportunity to counter that later.
I suspect he will not jump at that opportunity, although I'm sure it will be offered. The question is, what does he really say? Now, if he wanted to make an argument against what the president's press secretary was saying and what that note said, it would be very easy to do so, courtesy of this chart, which John Authers produced today for his Bloomberg newsletter. You've got here the Fed funds rate and the 10-year yield. The government's debt load is based on the longer end of the curve, not the shorter end of the curve. Well, look what happens when the Fed cuts the short end of the curve. Since September of last year, the 10-year note yield has only gone up. So lowering the rate didn't do anything to save the government any money, and probably would not do so, as many bond strategists have told you. We are likely to see a curve steepening ahead. Now, what does he say at Sintra, and what do the others say? Well, they've all got their own problems, so it might be more of a group therapy session. But I want to point out this quote from Jay Powell. We're getting a gradually cooling economy, a gradually cooling labor market, progress on inflation, 4% unemployment, 2% growth. We're kind of getting what we want to have. Well, that was him 1 year ago at Sintra. The situation seems to have not changed at all in terms of the economic conditions, but boy, the outlook sure has changed. So what does he say?
And Mike McKee, he says the economy right now is solid. Does the data actually speak to that?
No, well, the data suggests that the economy has been to this point relatively solid, but the soft data suggests that things are starting to slow down. We have seen a rise in jobless claims. We're forecast to see real slowing in job growth on Thursday. And we are looking at ISM numbers coming out today and on Wednesday that would suggest as well that things are slowing down. The question is it slow or is it a fall?
Mike McKee, appreciate it. Mike, thank you, sir. Or as Lisa, you've said continuously, cool versus cooling, weak versus weakening, two very different things.
At a time when you can expect the actual number to be a lot lower, what do you do with just a completely stagnant labor market? Is this acceptable for an economy that has come to rely on that kind of churn? That, I think, is going to be a deeper question and one the Fed's going to talk about more, I'm sure, in Jackson Hole.
Joining us now to talk about it right now is Blarina Urici of T. Rowe Price. Blarina, let's talk about it. The low churn dynamic that Lisa just gave a nod to. How much longer can we stick in that kind of situation, that kind of dynamic?
It's a very interesting dynamic for the U.S. economy right now. When you look at the flow of data up to date, you really see the labor market has loosened a lot, and that's come at the back of slowing demand for workers. I am not too concerned. We're not seeing a big pickup in the unemployment rate, but it does tell you that if the Fed were to base monetary policy purely on the progress made on inflation so far and the cooling in the labor market, I think they would be much more comfortable signaling cutting interest rates later this year. But the key here was what Mike McKee was alluding to earlier, that the outlook has changed so much, and most of the risks point to upside to inflation. And so the Fed has come so far, I think they're very reluctant to undo all the progress we've made and cut prematurely. And again, what matters for the economy and for the long end of the curve is if monetary policy is appropriately set or not. And we saw that in last September when the Fed cut interest rates by 50 basis points, but the long end went higher. And that was basically telling the Fed that, wait a minute, the economy is resilient. Why are we cutting interest rates? I think this is not setting us up for success for the risks going ahead. And I think the Fed wants to avoid that situation this year.
There's been a tone shift, though, and John alluded to it when he started talking about the Goldman Sachs note that came out, Jan Hatzius and the team, that brought forward rate cuts and see a greater number of them this year. Fed members themselves are saying it looks as though the inflation impact from the tariffs will be more of a one-time shock than they will some sort of protracted inflationary impulse. And you aren't seeing any kind of inflationary read-through from the labor market that is cooling, if not maybe even showing signs of cracks. Are you also coming around to that kind of a conclusion where it seems to make sense for the Fed to cut more and sooner?
So my baseline for the Fed this year is 2 cuts, 2 25 basis point cuts starting in September. I think the market has fluctuated between 1.5 to 3 cuts at different points of the year. The question is, can the Fed bring forward interest rate cuts to the July meeting? I think that's something that the market is not really prepared for. I don't think we have enough time to see a deterioration in the data that would push the Fed in that direction. So then what would make the Fed and the market price, let's say 3 or 4 cuts for this year? I think we would need to see a pretty big increase in the unemployment rate. Otherwise, even though the labor market is not a source of inflation right now, if you have a 1 or 2 time shock to inflation, even though it's not supposed to be persistent, it can de-anchor inflation expectations. So I'm looking at the unemployment rate here because that's the only way that you get the labor market to push the Fed off the fence. And when I'm thinking about the unemployment rate, there are 2 components that matter. One is labor demand. and hiring and firing. I think labor demand has cooled significantly, but we're not seeing mass firing yet. And then I also think the break-even rate of employment has come down a lot. The break-even rate of employment is that which keeps the unemployment rate steady. It doesn't go up, it doesn't go lower. It's come down a lot because net migrant flows have decelerated in the last 12 months or so. And so with weaker labor supply, it's much harder to get the unemployment rate to increase a lot unless you have mass firing. So I think we're here at an uneasy equilibrium. And so for me, it makes a lot of sense for the Fed to tread carefully. So I feel comfortable with keeping 2 interest rate cuts in my outlook for this year.
What's the potential for upside surprises later in the year, particularly once the One Big Beautiful Bill has passed and once people have more certainty around what the tariff outlook looks like?
So in terms of inflation upside surprises, I see 2 pivotal moments. In the next 2 to 3 CPI reports, I'm looking for signs that we're getting significant pass-through to consumer prices from higher tariffs. What we see so far is import prices have not budged. So that's telling me that exporters into the US are not adjusting prices. So then that leaves domestic firms and consumers as the agents that are going to bear the brunt of the tariff increases. We also have a weaker dollar, so the currency is not helping us on the inflation front. So I'm looking at the CPI reports for upside risks, and that's the one-off shock that everybody's talking about. But then we have the One Big Beautiful Bill. I think there is a real chance that this stimulates demand in the near term. So then the next risk that I see to inflation is in 2026 from fiscal policy. I think we learned our lessons from the supply chain disruptions and from the fiscal bill post-COVID that they can push inflation higher. I don't think the size of the shocks right now is as big as it was back then, but I do think it's realistic to expect some upside to inflation.
Look at that.
Yeah, so I think that Bernie Ricci of T. Rowe Price, thank you so much. Right now, John will get his mic all set up, and let's get you an update on stories elsewhere this morning. Here's a Bloomberg Brief with Yahira Anna and Yahira.
Hi, Lisa. Let's start with Tesla shares. They are down nearly 6% after President Trump took aim at Elon Musk over EV subsidies, posting on Truth Social that the Tesla CEO might, quote, get more subsidy than any human being in history. Just earlier, Trump also said he would look into deporting Musk, who was born in South Africa but holds U.S. citizenship. Meanwhile, President Trump is heading to Ocho-P, Florida to visit the Dade Collier Training and Transition Airport, now known as Alligator Alcatraz. It's a new 1,000-bed detention center being built in the isolated Everglades airfield west of Miami. Trump will take a tour of the facility and then hold a roundtable with local officials. And the pass rate for the second level of the CFA test soared well above the decade average in May, according to a statement from the CFA Institute. 54% of candidates passed, up from a 39% success rate for those who took the test back in November. The May results are higher than the 10-year average of 45% and the second highest since 2020. That's your brief.
We fixed that, Yahira. Thank you. Don't use rechargeable batteries. They're no good. That's the lesson from this morning.
Is this like an electric vehicle commentary?
That is exactly the comparison.
Oh, yeah?
Why are we using rechargeable batteries here at Bloomberg?
Range anxiety? Is that sort of similar?
Well, something like that. We'll have that conversation in the commercial break. It'll be a good one. Up next on the programme, we're setting you up for the day ahead, plus Colin Martin and Charles Schwab as investors await remarks from Fed Chair Jay Powell.
AI should be for everybody, from leaders to the working on floor. And we can save 90% of time, 50% of workforce. AI is core in centers of change. And therefore, we invest heavily to AI. Actually, we started more than 10 years ago because we think the machine in the past helped our hand and legs. Now the machine helps us in brain.
Are you betting all your money in this right now?
When the OpenAI appeared, immediately I asked whole corporations study how will you bring generative AI to their job.
Tune in to Bloomberg Business Week Daily.
We got to talk crypto.
From the magazine that helps global leaders stay ahead.
What's the conversation around your company?
Bringing you insight on the people, companies, and trends shaping today's complex economy.
Planning very big things.
A new level of premium.
Plus global business, finance, and tech news as it happens.
The floodgates of innovation are going to open up.
You can't fake passion. You either are or you aren't.
Bloomberg Business Week Daily, only on Bloomberg.
Making money isn't about drowning in emotions. It's about understanding what's actually happening. Markets are the best way to glean signal from noise, and that is what we try to do every morning. This is Bloomberg Surveillance.
U.S. jobs numbers are released. Bloomberg has the report under surveillance with crucial data and expert analysis at terminal speed. Nobody covers Jobs Day like Bloomberg.
Equities negative this morning. We're down by about 1/3 of 1% as we kick off Q3 in the second half of 25. We're down 0.5% on the Nasdaq 100. The single name to watch this morning is Tesla. The spat between Elon Musk and the president ramping up once again. Tesla down through most of this morning by something like 4, 5, 6%. As we count you down to the opening bell, a few things to look forward to through the rest of this week. At 9:30 Eastern Time, Fed Chair Jay Powell and ECB President Christine Lagarde speaking at the ECB Forum in Sintra, Portugal. At 10 a.m., ISM Manufacturing and JOLTS data. Wednesday, the ADP employment report. On Thursday, U.S. trade balance and another round of jobless claims, plus the big one, the payrolls report. And then before we get to the weekend, we're hoping to pass that tax bill down in Washington, D.C. Joining us now to talk about it, Bloomberg's Tyler Kendall in the nation's capital. Tyler, what's the latest?
Yeah, hey, John. Well, we heard from President Trump a short time ago saying that he thinks they're on track for the Senate to pass this by today. But at the moment, they still don't have the votes. As Senate Majority Leader John Thune, our reporters on the Hill tell us, is convening with some of those key holdouts to try to strike some sort of deals here in order to get this done. We know the White House is going to be laying on the pressure. An administration official tells us that President Trump has been in contact with lawmakers, and they've already deployed Vice President J.D. Vance to the Hill, who would be there poised and ready to cast a tie-breaking vote if it does come to that. Now, it was interesting to hear that President Trump was asked specifically about one holdout, Senator Lisa Murkowski, whether or not he knew what it would take to get her over the finish line. He said that he didn't, but I can tell you that we're closely watching one key amendment that hasn't come up for a vote yet, but would likely pass. It's looking like it's getting momentum to pass, and it would likely get Lisa Murkowski on board because it would be more lenient with the phase out of clean energy tax credits. While that amendment hasn't come up yet, John, we can say that the Votorama has officially broken a record. It is the most amendments ever introduced in a Votorama. We are currently on amendment number 45.
You're watching Senator Murkowski and you're still counting. We're all watching Elon Musk and a stock that's still dropping. Tyler, this tension, where's it come from this time around? Because this was widely expected. The president campaigned on this very issue.
Right, and that was the point that President Trump himself made in his post on Truth Social yesterday, saying that he has been open with Elon Musk, that he has long taken issue with the clean energy tax credits under the Inflation Reduction Act. Now, President Trump himself said that he thinks that this was spurred by the EV mandate. But in his words, he thinks that Musk has a lot more to lose than that. And he actually threatened the government subsidies that Musk's company receives as being potentially on the chopping block, saying, quote, Doge is the monster that might have to go back and eat Elon. We're going to have to see how this actually shakes out here, because we know that it is pitting Republicans between President Trump and the biggest U.S. political donor in the 2024 cycle.
Tyler, thank you. Some real tension. Don't see it in this bond market, though. Tyler Kendall, thank you. Yields are lower by just a single basis point. The 10-year still around 420. Let's turn to the bond market and the Federal Reserve. Colin Martin of the Schwab Center for Financial Research writing, expectations for the number of Fed rate cuts this year continues to increase despite the relatively stable labor market. Colin joins us now for more. Colin, good morning.
Good morning.
Can you explain that then? Why is that happening?
Well, I think it has to do with the idea that inflation actually continues to move lower despite the fact that tariffs are in place. If we take away the tariffs, which we can't do, of course, but absent the tariffs, the Fed probably would have cut already. And if we look at what's going on in the inflation data right now, we're still seeing that dichotomy between services and goods. And we are seeing a slight pickup in the goods inflation, specifically things coming in from China. But we're seeing a lot of disinflation or maybe even deflation on the services side. So the inflation data suggests that they could be cutting absent those tariffs. But the labor market's still holding up. I mean, maybe that starts to change soon. But what I think is really remarkable is if you look at that unemployment rate, 4.4% to 4.2%, that very narrow range for 13 straight months. It's expected to increase a little bit when we get the report on Thursday, but if it doesn't, if it's 4.2, that's 14 straight months. The labor market's holding in. We're seeing, the low hiring, low firing, but that's okay for the economy to kind of continue to chug along right now. So that's doing okay. I think the concerns in the second half of the year, now that it is July, is what happens next. And will we start to see the weakness in that labor market, given that the tariffs have to have an impact somewhere. If they're not passed along to the consumer, does that impact margins, which therefore might impact the labor market? So right now, we're kind of stuck between the rock and a hard place. But all signs are suggesting we get rate cuts later this year.
If we rewind to April 2nd, the narrative was the tariffs will cause the inflation rate to surge, and deficits will ignite bond vigilantes with their pitchforks to never buy U.S. bonds ever again. Are we saying both of those things are not true?
Well, on the tariff front, that's the confusing part right now. If you look at Fed expectations, even though there is kind of some vocal members who think we can be cutting soon, if you look and dive into the Fed projections, the median projections suggest inflation should increase. And even if you look at that range, the lowest expected inflation, core inflation rate by the end of the year is still 2.5%. So there's still an expectation that it should increase prices. We just haven't seen it yet. So there's this idea that maybe people imported goods, early in advance of this, they haven't chosen to pass it through. We think there has to be some sort of impact at some point. Of course, not the full effect of the tariffs, but some of it should get passed along, especially when you add in the fact that the dollar's declined. So you have that working against you as well. On the bond vigilantes, they don't care right now. We've long held that debts and deficits are not a key driver of the direction of long-term interest rates. We've always focused on monetary policy and growth and inflation expectations. We dialed that back a little bit recently just because our debt continues to grow, and there doesn't appear to be any interest in Washington to fix the situation.
Okay, hold on a second. I'm sorry to jump in here. So deficits, they do matter. We've been talking about this all year. When do they matter? I mean, it's expanding right now, and no one seems to care. Bond yields are actually lower on the day.
Yeah, we don't have the number for when it matters because there just hasn't been the relationship. So how we've been framing it is, because we get this concern from our clients at Schwab all the time. We hear about it, especially with everything going on in Washington. Is this going to send long-term yields significantly higher? And we say they're not. We don't expect the 10-year to get to 6, 7, 8% anytime soon. What we have thought, and which actually hasn't been the case over the past handful of days, is that maybe it keeps them elevated. We thought maybe the 10-year goes to that 5% range, or maybe hovers between 4.5% to 5%. So instead of falling in line with potential rate cuts later this year, maybe the fact that debt needs to continue to rise, we need to attract new buyers to buy those, maybe that just kind of keeps them where they are. But that's been proven wrong over the past couple of days as well.
Would the bond market push back on a Fed chair that they don't see as credible? An extension of Trump, an extension of the White House?
You know, that's we've been talking about that a lot. What happens if we get what the administration's been hinting that they could do in terms of, you know, shifting their issuance from coupons to T-bills, or a huge drop in the Fed funds rate? I mean, we've heard things from 200 basis points to 350 basis points. That would pull short-term rates a lot lower, I would think. But I think that could weigh on the long end. We might see long-term yields fall initially just based on that supply-demand imbalance.
But I'm not talking about what the new Fed chair might do next year. I'm talking about the fact that, is this person seen as credible to the institution?
Yeah, that concerns us. We worry about a lack of Fed independence, and we know that can have bad impacts if the Fed chair and the committee as a whole are doing things that are more based on short-term goals that the administration wants versus what their dual mandate suggests, price stability and maximum employment. We do worry that that can have an effect on the Treasury market, specifically long-term Treasuries. The dollar market, we could see the dollar continue to decline if that were to happen. So that is a worry of ours, and it could send long-term yields a little bit higher.
Haven't they totally and utterly failed to hit the price stability side of their dual mandate for the last several years?
They have. We're moving in the right direction, though.
Directionally, yes. But isn't that the ultimate criticism of them and this Fed chair? I know that he's celebrated a lot on Wall Street and by economists that work on Wall Street, but ultimately he's fallen short, or rather fallen above, where he should be for a long, long time now. And if you go back a few years ago when he delivered that speech at Jackson Hole, 8 minutes of pain, then there wasn't any pain and everyone celebrated. Not sure why they celebrated. Inflation never went back down to target. It was never mission accomplished, was it?
Yeah. Well, technically, no. You're right. Definitionally, we have not gotten 2%. If anything, though, that calls for the rate to stay where it is, or arguably higher. And that's, I think, where you get the lack of confidence in the market, because you're right, we're not at that 2% goal yet. They're projecting it to continue to move higher at the end of this year if the tariff, in fact, plays a role. And yet there are these calls for rate cuts. So, you know, it is tough. Totally. And I think if we were to get a new Fed chair, or just the committee as a whole, and they start cutting rates and we're still above target, I think that's a risk.
That's the ultimate issue, which is why the criticism, to your point, is kind of misplaced to this Federal Reserve. They cut rates 100 basis points last year. Rates went up at the long end, so did mortgage rates. That's the thing you need to get your teeth into. Bob Michael at JP Morgan was talking about the same thing earlier this morning.
And it might be the consequence of cutting, certainly as much as President Trump would like. It really goes to this question of how you trust data, because remember, last year the SOM rule was triggered and it was a head fake. And the Fed took that on its face and it cut rates significantly. And maybe in retrospect, the Fed chair doesn't think it was a mistake, but it raises a question: what data do you follow to understand that dual mandate when you're looking at inflation at a fuzzy moment and when you're looking at the labor market at a fuzzy moment?
The chairman of the Federal Reserve about 35 minutes away, alongside some of his peers, including the ECB President Christine Lagarde and the BOJ Governor Oweda. Look out for that a little bit later. Colin Martin of Charles Schwab, thank you, sir. Good to see you, Colin. Appreciate it. Thank you. Coming up tomorrow, Brian Nick of New Edge Wealth, Wei Lee of BlackRock, Sarah Hunt of Alpine Saxon Woods, and Jim Karen of Morgan Stanley from New York City. That does it for us this morning. Good morning to you all, and thank you for choosing Bloomberg TV. This was Bloomberg Surveillance.
This is Bloomberg Daybreak Europe. I'm Tom McKenzie in London. These are the stories that set your agenda.
Taking you from the U.S. market's close to the overnight session in Asia, we'll walk you through what you need to know to kickstart Europe's trading day. Live from our European headquarters, we bring you the day's top market-moving stories, unmatched expert analysis, and on-the-ground reporting from across the continent. Tune in to Daybreak Europe, only on Bloomberg Television. Context changes everything.
There is a nice confluence between the long-term investor and what we're trying to do. We have an operating principle that's in our handbook: take the long view. When we went public, we put a timeline up on the screen for the whole company in an all-hands meeting. And that timeline went from founding to 100 years out. And the IPO was one dot in 1 year on that timeline. And we tried to orient the employees to, this is a wonderful event, this IPO, but it's a moment in time on a very long journey.
This is a company that you want to exist in 100 years.
We do.
Wall Street doesn't think in...
No, they think in like hours. Yeah. And what I've learned of Wall Street, and particularly Wall Street investors, when they say they are long-term investors, that means they'll keep your stock for like a month. there has been one instance where I did something that was just for short-term stock, and I felt so bad about it that I don't think I'll do it again.
What was that?
There was one quarter, a few quarters ago, we were not going to beat the quarter. We were going to probably just hit it, and so far we beat every quarter. So we were all like, wait, what? Our perfect record. We're like a 4.0 student that is going to get a B for the first time. This is not good. And I decided that for a short period of time, at the end of a lesson in our app, we would show 2 ads instead of 1. Turns out that by itself was good enough to beat the quarter, but it's bad for the product. It's not good. After that, I'm never doing that again.
I'm Alex Rodriguez. And I'm Jason Kelly. And we're back with more episodes of our show, The Deal.
The theme of this season, On the Road. We're bringing you more behind-the-scenes conversations with the biggest names in sports, business, and culture, like Melody Hobson.
I started to study women's sports like an 11-year-old studies baseball statistics, and I got dangerous in seeing up arrows.
Susie Wolf.
When you're competing, you're not thinking about any fear or any worries of what could happen.
Josh Harris.
You can't do a good deal with a bad person.
Jay Batt.
At the end of the day, there's never been a better time to be a student athlete.
And more. Stay tuned.
Bringing you up-to-the-minute geopolitical news whenever and wherever it happens. I'm David Gura in Alberta, Canada, and this is Bloomberg.
I would if I were you. Oh, we're looking at futures that are lower to start the second half. 30 minutes until the start of the cash trade. I'm Matt Miller.
And I'm Katie Greifeld. Bloomberg Open Interest starts right now.
Coming up, Vote-A-Rama continues. Senators poll an all-nighter on the $3.3 trillion tax bill. And President Trump and Elon Musk are at it again. The commander-in-chief says the Tesla CEO has taken more from government subsidies than any other human in history. And Apple may enlist help from Anthropic or OpenAI to power a new, smarter, more capable version of Siri. The bar is low.
Right. I want to go back to the second thing you said, though, because you take a look at Tesla shares pre-market dropping in a big way after President Trump threatened to withdraw government subsidies from Elon Musk's companies. That's after the Tesla CEO threatened to primary lawmakers who support the president's tax bill. You add it all together, Tesla shares currently down 5.7% pre-market, Matt.
It's all just one big casino. And casino stocks are higher after monthly gaming revenue in Macau exceeded analysts' expectations in June. You can see Las Vegas Sands, Wynn Resorts, and Milco are all rising this morning, especially Milco, up 10%, Katie.
All right, let's get back to that tax bill because Senate Republican leaders still scrounging for votes to pass President Trump's $3.3 trillion tax bill. Voting started 24 hours ago, and the president is hopeful.
Hopefully soon, hopefully today, if we can. Final passage. When I say final, let's take Senate at a time, okay? But I think Senate could be today, and we go over to the House.
Joining us now is Bloomberg's Washington correspondent, Tyler Kendall. Katie's here, obviously, as well. So, Tyler, what have they achieved in the past 24 hours?
Well, that's actually a pretty interesting question because we have achieved a few different things, including that, for example, senators have voted against a key provision that would have allowed states to regulate artificial intelligence. That's something that big tech companies are likely upset about this morning. But when it comes to actually making a crucial movement towards passing the entire reconciliation package, we're really not making much movement at all. Senate Majority Leader John Thune still does not have the votes, and we're still tracking the same 8 key Republican holdouts. And we should say, broadly speaking, most of these Republicans do agree about those core tenets of of this package when it comes to the tax cuts, but they seem to be on very opposite sides when it comes to the spending cuts. And there's a few different key threads that we're watching here in Washington, which could inform how we see the rest of the morning develop. One is pressure from the White House. You heard President Trump there. An administration official does tell us that he has been in constant contact, calling lawmakers directly about this bill. And they actually have already deployed Vice President J.D. Vance, who's waiting and ready to cast a tiebreaker vote if it comes to that. He is currently on Capitol Hill talking directly with these lawmakers. And the second is that I would point you to one key amendment that we are still looking out for. This could actually be pivotal to the trajectory that this bill ends up taking. It is an amendment that would have a more lenient timeline for some of those clean energy tax credits that are being phased out when it comes to wind and solar. That might be enough to get a moderate like Senator Lisa Murkowski on board and ultimately this bill over the finish line. I will quickly leave you with, when you asked what they have accomplished, they have actually broken a record, which is the longest ever vote-a-rama with the most amendments. We are currently on amendment number 54, Matt.
All right, Tyler, you have a long night, might have a long day ahead of you. That is Bloomberg's Tyler Kendall. Let's also talk a little bit about Tesla, because the stock is sputtering after that feud between President Trump and Elon Musk reignited on social media. The president posted that the Tesla CEO gets more subsidies than any human being in history. That post came after Musk bashed Trump's spending bill, threatening to unseat any lawmakers who support that bill if it's the last thing he does on this earth. Joining us now with the latest is Bloomberg Tech co-host Ed Ludlow there. So this has been simmering for a while. You think back to the breakup, if you wanted to call it that, about a month ago. It was over these issues.
Yeah, June 4th, 5th, and 6th. On the subsidies issue, Bloomberg at the time, that first week of June, calculated it's not just subsidies, but subsidies, grants, and other incentives were about $25 billion. The New York Times has subsequently said across all of Elon Inc., but it's predominantly Tesla and SpaceX, it's a number nearer to $40 billion. The main sort of point of tension here is that what we used to call the Trump trade in the context of Tesla, that was a boost to the stock prior to the election in November, and at points in the first half of the year where the president's commentary supported the idea that Musk's close alignment to the stock would support its broader objectives, is kind of reversed. The Trump trade is now very difficult for Tesla. But again, you know, it's a little bit of the president said, Musk said. With the point of the big, beautiful bill you just went through with Tyler, Elon Musk has at least been consistent that he's welcomed scrapping incentives for direct-to-consumer incentives for Tesla, because he feels that Tesla's lower cost base makes it more competitive against other American car makers.
In terms of this fight, though, it does look like the super genius who started Tesla is being outsmarted by President Trump. He caved in and pulled back his Epstein, which had to be his trump card, right? His Epstein accusations early, although his stock is still worth, $1 trillion.
Yeah, there were essentially three claims from the president this morning outside of the White House, right? The first was he was asked a question by a journalist, would you look at deporting Elon Musk? And the president answered in the affirmative. I would point out that Musk has spoken in interviews over about a 20-year period, but it was also in the 2023 biography by Walter Isaacson that Musk is a U.S. citizen and claimed he took the oath of citizenship in 2002 in Los Angeles County. The president also said he would look at Doge and Doge turning back on Elon Musk and reviewing those federal contracts and subsidies we just discussed. But the kind of core thing here is ideological. Musk has been consistent. He believes that he's worried about the national debt pile and not worried about EV incentives that benefit Tesla. The president says the opposite, that Musk is upset about scrapping direct-to-consumer incentives, and that you will also have seen the headlines from Treasury Secretary Bessent this morning, where he, I'm paraphrasing, but essentially says, Musk is really good at rockets, leave the finances to me. But that is the point of tension that is still there, and as Katie pointed out, has been there for a number of weeks.
Did they actually get into a fist fight? That was, reported, or that was a rumor that I saw on social media Has your reporting uncovered any truth behind that claim?
Well, my reporting has very clearly reflected that cabinet members had real problems, not just with Musk on an ideological basis, but just operationally within the wings of the White House, in that he had access to the president and advised him on X and XYZ, and then other cabinet members would have a point of difference with the president. What we did report, if you take the case study of Jared Isaacman and his nomination for NASA administrator being pulled, when Elon Musk left Doge, various White House officials, Sergio Gore is one of the ones we named, that were very anti-Elon, basically moved quickly to say Jared Isaacman is a close ally and confidant of Elon Musk, a historic business partner of his. We don't want him to run NASA, so they moved to convince the president, based on his historic Democratic affiliations, that he should pull the nomination. There are other examples about that. I get that in that example, Sergio Gore is not... you guys see the red head? Sorry, we just broke that while we're on air.
Well,
I
tell
just
us
broke the
about
story.
it, Ed.
Yeah, sorry. There's a lot going on this morning. Sources tell us, my colleagues and I, that what has happened in the last 7 days is Musk has gone back into Tesla, and after Omid Afshar was essentially fired, Musk is now overseeing sales. So all of this sales apparatus that had reported into Omid, Elon now has direct oversight. And what sources tell us is the reason that's important is we obviously get sales data this week. Globally, I think it will come in the next couple of days. But Europe's particularly troublesome right now. Elon Musk is now directly overseeing sales responsibility for the United States or North America and Europe. And what I'm also hearing from sources, and my colleagues have reported with me, is that Tom Zhu, who runs the Asia business out of Shanghai, now will oversee global manufacturing operations. So this is kind of idiosyncratic to Tesla and what's going on inside, but it's happening. And the Tesla investors will know these names and try and work out who's steering the ship.
Rearranging the deck chairs, but there's one captain and owner of this yacht. Ed, thanks so much for joining us. Bloomberg Tech co-host Ed Ludlow. He will kick off his program at 11 a.m. Eastern time. Don't miss that. Let's get to another Bloomberg scoop after the one that Ed has delivered. We got news on Apple considering using artificial intelligence from a third party, Anthropic or OpenAI, to power a new, potentially capable version of Siri and sidelining its own in-house models. Anurag Rana of Bloomberg Intelligence calls the potential move judicious in wake of Apple's struggles to implement AI in its own operating system. Anurag joins us from Chicago. So I just don't understand, Anurag, why this $3 trillion company that's made everything we desperately need to live hasn't been able to achieve very much at all with Siri in the past. It's been like 14 years that Siri's been out.
Yeah, I think this is an area. I mean, Siri has the most potential amongst everything that we see on the Apple ecosystem, and they have not been able to deliver it. And, one reason could be that they really don't go and snoop around our personal data. I don't know the reason why they have not been able to deliver, but the fact is they have not been able to deliver. But the news from yesterday is really good because you are getting the latest technology and probably the best technology without spending billions in capex. So I like that. I think it's a good thing for Apple if they're able to pull it off.
Yeah, so as you say, judicious in your reaction piece, is this Apple accepting defeat in some ways? Obviously, they're not giving up on AI. Obviously, they're just looking to go externally. But the narrative that's formed around Apple is that they're behind, that their homegrown efforts haven't been able to cut it and excite investors and excite users of their products. And you could make the case that this is proof that the company sees that as well.
Yeah, and Mark's really reported on this very well. And, we all know the frustration that's happening within Apple as it relates to AI. But, frankly, as a shareholder, if you are a shareholder, would you be worried about this thing? Would you be worried that they're not so great in search and other technologies? At the end of the day, if their ecosystem gets better by a third-party technology and they can do it without paying a lot of money at it, I don't have a problem with it because look at the free cash flow line, look at the capex line. Unlike somebody like an AWS, Meta, or a Microsoft, their capex line has not ballooned up in the same manner, or it's not going to go up at the same manner over the next few years. Why won't shareholders like it, frankly?
Right, and as a user, you won't know and you won't care.
Yeah.
As long as it works seamlessly, you'll be happy and continue to buy the product. Although Katie hasn't upgraded her iPhone in also as long as Siri's been alive.
I never will. Yeah, this is pretty much 14 years old. Anurag, really appreciate your insight. That is Anurag Rana of Bloomberg Intelligence. Now, coming up, we'll ask HSBC's Max Kettner why he sees the beginnings of a melt-up in risk assets as a weaker dollar boosts earnings. And then,
later this hour, Fed Chair Jerome Powell joins his global counterparts for a panel in Portugal. We'll bring you their comments live from Sintra. This is Open Interest.